Some, such as arch-conservative Milton Friedman, even believe that central banks caused the Great Depression by restricting the supply of money. Monetary policy during the 2008 crisis did much to disprove his theory. Central banks everywhere massively increased the money supply. In Friedman's theory, the economy would have quickly been back to full employment and even would have faced inflation. Instead, economic growth in Japan, Europe, and the United States was anemic, and many countries even faced deflation. Standard wisdom among conservative bankers, including at the ECB, constrained what central banks did even more. Conservative economists like Friedman believed that central banks should exercise no discretion, simply increasing the money supply at a fixed rate, or when that theory failed to stabilize the economy, to increase or decrease the money supply according to a simple formula dictated by the inflation rate. So, too, the set of instruments, it was argued, should be limited. Central banks should only buy and sell short-term government bonds. German members of the ECB board resisted quantitative easing, QE, entailing the buying of long-term bonds, some of which might not even be government bonds, long after policymakers in the United States and Japan had augmented their toolkit with QE. QE was supposed to stimulate the economy by lowering the cost of long-term borrowing, lowering the exchange rate, and increasing the value of the stock market. In practice, these effects turned out to be small. These limitations greatly weakened the scope of what the ECB could do, even beyond the limitations imposed by the inflation mandate. Especially after the crisis, the ECB, the most important economic institution in the Eurozone, had an impossible task: to restore all of the countries of the zone to full employment with its hands tied behind its back. The lack of fiscal policy, with limited spending by the EU as a whole and debt constraints facing each of the countries, put a special burden on monetary policy. Even with no constraints, the ECB's powers, its ability to maintain growth and employment throughout the Eurozone, were limited. But rather than asking how to maximize what it could do, the economic conservatives dominating the construction of the ECB focused on imposing limitations on it. They fixated on the downside risk of an excessively exuberant ECB leading to inflation, not the upside potential of higher growth and employment. Broadening the ECB's instruments to include regulatory policies, like capital requirements and capital adequacy standards for banks, might be used to create a more nuanced financial policy, sensitive to differences in the economic situation in different countries. Discretionary regulatory policies could have allowed the ECB to influence lending in individual countries in different ways. While with the euro there is a single euro interest rate for effectively riskless bonds throughout the region, I have explained how firms borrowing in different countries can face markedly different costs of capital. Those in weak countries face a higher interest rate, when they really need a lower one. At least by providing scope for the banks in weak countries to lend more, one can reduce the magnitude of the tilt in the playing field so that credit in weak countries would not contract as much as it otherwise would. Faith in markets by neoliberals not only meant that monetary policy was less needed to keep the economy at full employment, it also meant that financial regulations were less needed to prevent excesses. To conservatives, the ideal was free banking, the absence of all regulations. Milton Friedman persuaded Chile's oppressive dictator Augusto Pinochet to try it beginning around 1975. The disastrous results were predictable and predicted. Banks recklessly created credit, and when the credit bubble eventually broke, Chile entered a deep recession. It would not be until long after, more than a quarter century, that the debt Chile undertook to get out of this mess was finally repaid. More recently, the Great Recession was a textbook example of the dangers of under-regulated markets. Central banks can play an important role not only in preventing the financial sector from imposing harms on the rest of society, negative externalities, such as credit card abuses and excessive risk-taking, but in helping ensure that the sector does what it is supposed to: providing credit, for instance, to small businesses. To be fair, there are disagreements among economists about these issues. Keynesians are especially sensitive to the waste of resources, the human suffering, the long-term costs of lower growth, all of which result from unnecessarily high unemployment. Both in its structure and its functioning, the ECB made a political choice that reflected the views of economic conservatives. The political nature of monetary policy. As we noted in the preface, monetary policy, as technical as it may seem, has long been recognized as being political. Inflation reduces the real value of what debtors owe, helping them at the expense of creditors. No wonder, then, that bankers and bond market investors rail so strongly against inflation. On the other hand, the fight against inflation typically entails raising interest rates, which lowers growth and hurts employment and workers. Balancing inflation and unemployment is, or should be, a political decision. In the 2008 crisis, hundreds of billions of dollars were effectively given, or lent at below-market interest rates, by central banks in the advanced countries to commercial banks in the most massive government assistance program to the private sector ever conceived. This program of corporate welfare for the suffering banks was greater by an order of magnitude than any welfare program constructed by any government to alleviate the suffering of ordinary individuals. Much of the money was provided through central banks, not appropriated by parliaments or national congresses. Again, an intensely political act without democratic accountability. If monetary policy were simply a technocratic matter, it might be left to technocrats. But it is not. There are large distributive consequences. Indeed, central banks may have played an important role in increasing inequality. Increasing inequality. Today, in most countries around the world, inequality is viewed as one of the greatest threats to future prosperity. At Davos, where the world's economic leaders come together every January, recent surveys of global risks have consistently placed inequality at or toward the top of the list. Inequality is important because divided societies don't function well. It leads to a lack of cohesiveness that has political, economic, and social consequences. In my book, The Price of Inequality, I explained the mechanisms by which greater inequality leads to poorer economic performance, lower growth, and more instability. Since then, a wealth of studies at the IMF and elsewhere has corroborated this perspective. Unfortunately, central banks everywhere, and especially the ECB, have largely ignored their role in creating inequality. Their excessive focus on inflation, even when their mandates are nominally broader, has led to higher unemployment, which has increased inequality. Central bank policies have helped ratchet wages down. In recessions, real wages typically fall, but then in the recovery, just as they start to increase, inflation hawks scream about the risks of inflation, interest rates rise, and unemployment increases to a level making further wage increases difficult. But the role of the ECB in increasing inequality was worse. Central bankers have enormous influence that goes beyond monetary policy narrowly defined. For instance, to setting interest rates and the money supply. The head of the ECB is looked to for setting the economic agenda, and not surprisingly, there is a tendency to focus on their narrow remit, inflation, thinking that by controlling inflation, growth and prosperity will be advanced. Jean-Claude Trichet, the ECB governor during the run-up to the crisis, perhaps in his pursuit of the ECB's mandate of stable prices, used his influence to push for policies that increased inequality. In the early days of the crisis, from 2008 to 2011, he repeatedly argued that there should be more wage flexibility, a euphemism for saying that wages should be cut, part of the blame-the-victim approach to unemployment discussed in Chapter 4, in which workers are blamed for their unemployment. for asking for wages that are too high and for employment contracts with a modicum of security. Of course, wage cuts were, in the short run, interests of corporations and their owners. I say short-run interests because he should have realized post-crisis Europe faced a lack of demand and that cutting wages would weaken demand and deepen the recession. Trichet went so far in a secret letter to Spain's Prime Minister José Luis Rodríguez Zapatero, which Zapatero published in his memoirs, to hint, actually more than hint, that he would be willing to help Spanish banks if, and only if, they agreed to enact labor market reforms that would lead to lower wages and less job protection. Zapatero apparently refused, but, interestingly, introduced reforms that had much the same effect, and the assistance was forthcoming. Distribution, politics, and the crisis. The political nature of the ECB became especially apparent with the euro crisis. Who was blamed? Who was saved? And under what conditions? Most dramatically, the bank decided not to act as a lender of last resort for Greece in the summer of 2015. As Greece negotiated with the Troika, the country's banks were forced to shut down, and behind the scenes the ECB threatened to impose further costs on Greece if it didn't knuckle down to the Troika's demands. The ECB had become Europe's sledgehammer, the tool by which Greece was forced to accede to what the Troika wanted. More generally, as the ECB decides on what collateral to accept and with what haircut, for example, to provide a loan of €70 against the collateral of a €100 bond, it may be deciding on the life and death of a financial institution. And when a country is in crisis, with many precarious banks, the ECB effectively decides on the life and death of the country's banking system. No decision could be more political. There is no technical manual available. Such decisions are a matter of a judgment of the future viability of the institution. But in reality, it is a judgment strongly colored by the political consequences of alternatives. The prioritization of banks over citizens was as evident in Europe as it was in the United States during the crisis, and at times almost as evident in his successor, Draghi, as it was in Trichet. As Ireland's crisis emerged in 2010, Trichet demanded that Ireland assume the liabilities of its bankrupt banks, and the cost of restructuring the banks led to an increase in Ireland's debt-to-GDP ratio from 24% in 2007 to an estimated 95.2% in 2015. While there is some debate about whether Ireland would have assumed some of these debts without intervention, there is little question that some of the debt was assumed only because the ECB made it a condition for getting assistance. Indeed, the Troika was divided on the matter. The IMF believed that the government should not have had to bear all of these liabilities. There should have been deep debt restructuring, with bank shareholders and bondholders bearing more losses. Ordinary laws of capitalism require the government should not have assumed any liabilities until shareholders and bondholders had been entirely wiped out. The ECB apparently worried about the effect that forcing shareholders and bondholders to bear more of the costs in Ireland might have had on other European banks. But they should have worried about this before the crisis, ensuring that European banks were adequately capitalized and had not engaged in excessive risk-taking. The critical issue is this. The Troika was asking ordinary Irish citizens to pick up the tab for regulatory failures of the ECB and other regulatory authorities within the Eurozone. To me, this is unconscionable, as it seems to most Irish people with whom I have discussed the matter, but evidently not to the bankers in the ECB. Governance. Among the critical decisions any society has to make are those related to governance. Who makes the decisions and to whom are those who make decisions accountable? And how transparent is the decision-making process? Many of the criticisms of the European Union, in its current form, relate to governance. But in the case of the Eurozone and its most important institution, the European Central Bank, the problems of governance are especially severe. This is partly because financial markets have successfully sold the idea that independent central banks lead to better economic performance. Europe has taken this mantra to an extreme. The central question of governance is the extent of accountability of the ECB to democratic processes. There is, in fact, a wide range of degrees of de facto and de jure independence. In the UK, for instance, the government every year sets the inflation target, but that country's central bank, the Bank of England, has independence in implementing the target. While in principle the U.S. Federal Reserve is independent, in fact, some of its central bankers have understood very much the limits of that independence. As Paul Volcker put it, Congress created us, and Congress can uncreate us. The crisis of 2008 provides perhaps the best test of the hypothesis of the virtues of central bank independence, and those countries without independent central banks performed far better than those with. Capture. The main reason for this difference in performance is simple. There is no such thing as a truly independent institution. All institutions are captured to some extent or another by some group or another. We would like a central bank to reflect the broad interests of society, but central banks in most countries, including the European Central Bank, are captured by a small group, the financial market. Both the interests and beliefs of the financial market differ from those in the rest of society. Although for a long time, both in the United States and Europe, those at Goldman Sachs and other large banks have been trying to sell the idea that what is good for Goldman Sachs and the other big banks is good for all, it simply isn't true. And anyone who subscribed to this idea was surely disabused of it by the Great Recession and the abuses of the financial sector. Many, if not most, of the central bankers came from and/or went to the financial sector after they finished their tenure. Draghi himself had spent years at Goldman Sachs before moving on to the Bank of Italy. In many ways, this is natural. One needs and wants expertise in finance, and much of that expertise resides in those who have worked in the financial sector. While even then most didn't buy into the idea that what was good for Goldman Sachs was good for the economy, it was not that difficult for these democratically unaccountable central bankers to go along with ideas such as self-regulation. It appealed especially to those who believed in meritocracy and technocracy. Running a central bank was, in this view, like running a mine. Put a good engineer or economist in charge and all will be well. But our earlier discussion made clear that the decisions central bankers make are not just technocratic. There are potentially large distributive consequences, and so long as that is the case, there cannot be full delegation to technocrats. Moreover, the one thing economists agree on is that incentives matter. The revolving door meant that it was in the interest of central bankers to do what they could to help their friends in the financial sector, from whence they came and to which they would go. Helping friends in banks needn't even be a conscious decision, though it surely has been in some cases. Rather, the mere proximity and entanglement of central bank leadership and staff with the private financial markets, an inescapable symptom of the revolving door, ensures a convergence of priorities and perspectives. This is sometimes referred to as cognitive capture. Self-regulation turned out to be a joke. Those in the financial sector did not have the incentives, and in many cases even the skills, for self-regulation. Even in the best of cases, the banks would have no incentives to take into account the externalities that their actions, or their failures, would have on others. But it should have been obvious that the incentives of banks and bankers were to engage in excessive risk-taking and socially unproductive, and in some cases destructive, activities. It was willful neglect that central bankers in Europe and America failed to take this into account. Consequences of capture. Every aspect of central bank policy, both in Europe and America, in the run-up to the global financial and the euro crises, and in their aftermath, reflected the capture of the central bank by the financial sector, with perhaps the most dramatic manifestations occurring in the midst of the crises themselves. In 2012, Greece needed to restructure its bonds. Prudent banks had bought credit default swaps, CDSs, as insurance against a default in the bonds they owned. A CDS can provide the bondholder with a payment equal to the loss he would otherwise face if there is a default. When bonds are restructured, new bonds are issued in exchange for the old. The new bonds typically stretch out the repayment period, but there is also a write-down, with the nominal value of the new bonds markedly lower than that of the old. If this happened, the CDSs would make up for the losses. There are some ways of restructuring that trigger the CDSs, that is, which result in a payout. Of course, a bank that bought a CDS as insurance would want the restructuring to be done in a way that the insurance policy paid off, and a good regulator would want the banks who hold risky bonds in their portfolio to have insurance and that the insurance pay off. The ECB, however, insisted that the restructuring be done in such a way as not to trigger the CDSs. Their position was unfathomable, until one realized that, 1. While some banks had bought insurance, CDSs, against the loss of the value of their bonds, other banks, typically big banks, had sold CDSs. When someone buys insurance, there has to be someone else on the other side of the market selling insurance. Obviously, when the insured against event occurs, the firm/bank selling the insurance is worse off. These banks had sold CDSs as non-transparent gambling instruments. And 2. The ECB was more interested in the big banks that were engaged in selling insurance, essentially gambling and speculating on whether Greece could pay off its debts, than in the ordinary banks that had bought insurance. Central banks as political institutions. These examples, as well as our earlier discussions about monetary policy decisions about inflation versus unemployment, make it clear that central banks, including the ECB, make political decisions. They face trade-offs. There are large distributive consequences of their decisions. There are different risks associated with different policy choices. In the United States, when they gave money to the banks, they could have imposed conditions, such as that the banks lend to small and medium-sized businesses. In Europe, they could have demanded that Ireland not bail out its banks, rather than that it do so. They could have demanded that the Greek restructuring be done in a way that the CDSs paid off. Not even the leaders of the ECB would deny that they face such choices. But if trade-offs exist, the people making them need to be politically accountable. In Europe, the governance is even worse than in the United States. Europe pretended that it could get around the problem of governance by giving the ECB a simple mandate, ensuring price stability, also known as fighting inflation. Inevitably, there are going to be judgments about what price stability means, 0 inflation or 2% or 4%, and in making those judgments, policymakers will have to consider the consequences of different targets. If pursuing a 2% inflation target versus a 4% target were to lead to much slower growth, I doubt that many voters would support that target given the chance. There are winners and losers in most economic policies. In making their decisions, policymakers in the ECB have to make judgments with distributional consequences. These are not merely technocratic issues, like the best design of a bridge. Slightly higher inflation might lead to lower bond prices, even as it led to higher employment and wages. Bondholders would be unhappy, even if the rest of society celebrated. But central banks that are not democratically accountable almost always pay more attention to the views of the bondholders and other financiers than to the workers. At one point, the European Commission thought that if Spain's unemployment were to fall below 25%, there would be an increase in inflation. Later, they revised that number down to 18.6%. Others think these conjectures absurd, but here again there are trade-offs, this time in who bears the risks. By acting as if the critical threshold is a high number, like 25% or even 18.6%, when it is in fact lower, one condemns unnecessarily large numbers of people to unemployment, and the higher unemployment results in lower wages for many workers. Those in the financial market and business sector might welcome these lower wages. Workers obviously do not. There is a political agenda in pretending that setting monetary policy is a technocratic matter best left to experts from the financial sector. Reflecting the mindset of those in the financial sector, these experts respond to the apparent trade-offs in a markedly different way than would ordinary workers. Removing central banking from political accountability, at least in the way that it has been done in the United States and Europe, effectively transfers decision-making to the financial sector with its interests and ideology. The crises themselves should have shown that it was not expertise and wisdom that the wizards of the financial market brought to the table. The deregulation agenda that financiers pushed in Europe and America was really about rewriting the rules and regulations of the financial market in ways that advantaged those in the financial markets at the expense of the rest of society. It was not about creating a financial market that would lead to faster and more stable growth. And that was why what emerged was lower growth and increased instability. The neoliberal argument for central bank independence. The neoliberal argument for central bank independence, the argument that prevailed at the time the ECB was established, seemed to be predicated on three critically flawed assumptions. First, that all that mattered was inflation. Secondly, that fighting inflation through monetary policy was a purely technocratic matter. And thirdly, that central bank independence would strengthen the fight against inflation. I have already explained what was wrong with the first two hypotheses. The third hypothesis was based on a deep distrust of democracy. It was feared that democratic governments would be tempted to inflate the economy before an election. A stronger economy would help get the government re-elected, with the price of inflation paid afterward. Only by taking monetary policy out of the hands of politicians could this kind of inflationary pattern be broken. And with confidence that the technocrats assigned to limit inflation would fulfill their mandate, inflationary expectations would be brought down, and thus economic stability ensured. Democratic electorates are, however, more intelligent than this hypothesis gives them credit. Indeed, governments have the same incentive to spend before an election. No one has proposed taking away the spending power from government to ensure that they don't misbehave, and, in fact, Democratic electorates have strongly punished governments that overspent. Fiscal responsibility, in some cases excessive fiscal responsibility, with a focus on deficits that exceeds practical sense, regularly features in elections. Beyond independence. Even if one believed that an independent central bank would result in better monetary policy, one could have constructed a European central bank that was more representative, that is, which viewed the inherent policy trade-offs, including the hidden trade-offs, in a more balanced way. Some countries have recognized this, for instance, forbidding those from the financial sector from being on the board of the central bank, since they have a vested interest and particular perspectives on monetary policy. Some countries require that there be representatives of labor, since they often see the world through a different lens than do those in the financial sector. The Eurozone has done neither. This tilts the balance, even given the ECB's inflation mandate. A more hawkish concern over inflation, an insufficient concern over the consequences for growth and employment. Concluding comments: economic models, interests, and ideology. A central thesis of this book is that certain ideas, certain economic models, shaped the construction of the Eurozone. These ideas are at best questionable, at worst wrong. In computer science, there is an old adage, garbage in, garbage out. So too, in the construction of institutions, institutions built on faulty ideology are not going to work well. Economic institutions built on flawed economic foundations are going to serve the economy poorly. This chapter has amply illustrated this in the context of monetary policy in the central institution of the Eurozone, the ECB. While the single mandate and the narrow view of the instruments at their disposal may have narrowed the set of actions that the ECB could undertake, the ECB has been, to say the least, controversial. It has been charged, especially within Germany, with acting beyond its mandate and acting improperly. Even though in its construction, conservative ideas predominated, since the crisis it has used new instruments and undertaken new responsibilities, which conservatives say go beyond its remit. It has been sued for its program of buying government bonds, for engaging in quantitative easing, and for its new supervisory roles. The ECB is governed by a board, the members of which have views about what the bank can do and what the bank should do that markedly differ. The Germans have consistently argued for a narrow construction, and in spite of common wisdom, that they enjoy hegemony in the Eurozone. The ECB has, on a number of times, most notably with the undertaking of QE, taken actions vehemently opposed by Germany, both on grounds of policy and that the actions are beyond those allowed to it. Institutions evolve. The problems confronting Europe and the world today are different than what they were when the Eurozone was designed. Even when the Eurozone was founded, inflation was not the issue. The world had moved into a new era, with inexpensive Chinese goods helping to dampen prices. It was clear that growth and employment would be among the issues of the future. The 2008 crisis reminded everyone why some central banks were created in the first place, to maintain financial stability, a responsibility that had been almost forgotten in the years when an obsession with inflation dominated the scene. The strong restraints on the ECB clearly limit its ability to adapt in ways that it could and should. The ECB's narrow mandate and narrow set of instruments puts Europe in a distinct disadvantage. The ECB has had 3 heads in its short history, each with a distinctive style, each leaving his mark. Trichet will be remembered for his colossal misjudgments, in particular raising interest rates at moments where the economy was contracting. He demonstrated a commitment to fulfilling the ECB's mandate, fighting inflation, come what may. The costs of these mistakes were palpable. He played a disastrous role in the development of the euro crisis, forcing the Irish government to assume the liabilities of its banks. The Irish people were unjustly forced to pay the price for others' mistakes, a double injustice because it was in effect a transfer of money from the poor to the rich. But Trichet knew where he stood. He was an ally of the bankers against ordinary workers, constantly demanding wage cuts that would lower their standards of living. If Trichet did much to undermine the Eurozone, could it have survived if he had remained in office? Mario Draghi is given credit for its survival, with his famous 2012 speech promising whatever it takes. Few speeches in history have had such impact, bringing down interest rates on sovereign bonds throughout the region. The speech was magical in another way as well. No one knew whether the ECB had the authority and resources to do whatever it takes. A few academics and pundits worried what would happen if the promise was tested, if there was a run against Italian bonds. If suddenly there was a shift in mood and investors came to believe that the ECB did not have the resources to sustain high prices for the enormous numbers of outstanding Italian bonds. What would happen if Germany successfully opposed the ECB doing whatever it takes? In short, No one knew whether Draghi was an emperor with or without clothes. It was, of course, in no one's interest to find out, or at least not at the time. And so long as it was not shown that the emperor had no clothes, remarkably, the market acted as if he did, whether he did or didn't. There are choices. Quantitative easing, which was grudgingly adopted, with strong opposition from some members of the ECB board, has not restored Europe to robust growth. Neither has it resulted in massive inflation, as its critics once feared. Over the nearly 2 decades since its creation, the ECB has not been able to assure full employment and economic stability for all of Europe. That might be asking too much. Given the diversity among the countries, critics of the Eurozone would say that that was an impossible task. But it has not even achieved reasonable growth, employment, and economic stability on average. Chapter 3 vividly described the Eurozone's dismal performance. It has had a double-dip recession and repeatedly faced threats of deflation, with an unacceptably high level of Eurozone unemployment. In the brief history of the ECB, we have seen costly misjudgments and the use of its enormous power to obtain outcomes that benefit the banks and the major powers within the European Union at the expense of citizens and the weaker countries. This should be deeply troubling. The main point of this chapter is a simple one. There are alternative ways of structuring central banks with different mandates, different instruments, and more importantly, different governance that are more likely to lead to better economic performance, especially from the perspective of the majority of citizens. Doing this should be high on the agenda of reform for the Eurozone. It is one of the essential tasks if the Eurozone is to be restored to growth and prosperity. Afterword. Developments in monetary theory and policy over the past third of a century. The Eurozone is a monetary union, so it is important to understand the ideas concerning money and monetary policy that prevailed at the time the Eurozone was created and subsequently. This section describes the evolution of the dominant doctrines over the past third of a century. Ideas that were fashionable at the time the Eurozone was founded, such that all that a central bank had to do was focus on inflation and that would ensure growth and stability, are now widely discredited among both academic economists and policymakers, including those at the IMF. Yet these ideas are set in stone in the ECB, and still widely held within powerful groups inside the Eurozone. This puts the ECB in a difficult position. Following its mandate puts it on a course that is opposed by large fractions of European democracy. It is important to have rules, but having the wrong rules, as we noted earlier, can be a disaster. In recent decades, central banking has been dominated by a succession of beliefs. One might call them religious beliefs, for they are held with firm conviction, even passion. And this is so, even though the empirical evidence underlying them is at best weak. The good news concerning central bankers is that their religions evolve, even if they change their beliefs very slowly in response to evidence against the currently fashionable doctrines. Monetarism. At one point, the religion was called monetarism. All central bankers believed that one should increase the monetary supply at a fixed rate and, accordingly, monetary authorities should keep their eye on the money supply. Monetarism was never really a theory. It was based on an alleged empirical regularity, that the ratio of the money supply to the volume of transactions, called the velocity of circulation, was fixed. There was no theoretical reason that this should be so. No sooner had Milton Friedman announced this new law of nature than nature played a trick on him and on the countries that followed his dicta. The velocity of circulation started changing. Those of us who had studied more deeply the nature of financial markets understood and predicted these changes. New forms of financial instruments, like money market funds that we now take for granted, were coming into play, and there were changes in the regulations governing financial markets. Monetarism swept the world of central bankers as the cult of the day. It was based on a simplistic model. It could be grasped easily by central bankers with limited abstract capacities, and it provided rich opportunities for empirical testing. There was enough ambiguity in the theory to lead to heated discussions. What was the right definition of money? How should it best be measured? What was the right measure of GDP? How should it be measured? Interestingly, conservative central bankers following such doctrines actually exposed the economies for which they were responsible to real risk. At the time the experiment with monetarism began, its full implications were not known. At the time, the late 1970s, the United States faced what was widely viewed as an unacceptably high inflation rate. Paul Volcker, newly chosen to head the Federal Reserve, responded with this new tool. Interest rates shot up beyond anything that had happened before, and beyond what most had expected, the Fed fund rate eventually reaching 19%. But while this new theory seemed to work in bringing down inflation from 13.5% in 1980 to 3.5% in 1983, the medicine had serious side effects. America's deepest recession since the Great Depression, with unemployment reaching 10.8% in 1982, in spite of a massive stimulus from fiscal policy with the large 1981 Reagan tax cut, and debt crises throughout the world in countries that had borrowed in the 1970s to offset the effects of the oil price rise, in the perhaps reasonable belief that so long as interest rates remained within the realm of what had happened in the past, they could manage things. The result was the lost decade of the 1980s in Latin America. Inflation targeting. As this monetarism religion waned in the onslaught of overwhelming evidence that it did not provide good guidance, even ignoring its noxious side effects, a new religion took its place: inflation targeting. If inflation was the only thing that central banks should care about, it made sense for them to target their policies to inflation. Never mind about unemployment or growth. That was the responsibility of someone else. Countries around the world adopted this philosophy, and with conservatives loving rules, there developed a rule named after John Taylor, with whom I taught at Princeton and Stanford, and who was to go on to be the Undersecretary of the Treasury for International Affairs in the Bush administration. His rule, the Taylor Rule, prescribed by how much the central bank should raise interest rates in response to a level of inflation in excess of its target. One didn't really need a board to set interest rates, just a technician who would calculate the inflation rate, government statistical offices do that, and then plug the number into the formula. The interest rate would pop right out. The money supply should be increased or decreased until that target was reached. One didn't have to ask why inflation was high, or whether the disturbance to the economy was temporary or permanent. Those judgments, made by mortal government appointees, would inevitably be more fallible than the infallible rule. Countries following such a simplistic policy also had disastrous results. When food prices rose very rapidly in 2007, inflation, especially in developing countries where food is such an important part of the market basket, rose too. But it made no sense to raise interest rates. Raising interest rates would not lower food prices. The problem of food prices was global. But even in a moderately sized country, raising interest rates would have a negligible effect on global food prices. The only way the monetary authority could have an effect on inflation was to drive down other prices, have deflation in the non-traded goods in the economy. And the only way to achieve that was to cause those sectors to go into depression by raising interest rates very high. No matter how important one thought that inflation was, the cure was worse than the disease. The European Central Bank never went so far as to go to either the extreme of monetarism or the Taylor rule, but it did something almost as bad. It focused exclusively on inflation. After all, that was its single mandate. And for a long time it continued to use as an indicator of its monetary stance, whether monetary policy was loose or tight, the rate of growth of the money supply, a holdover from the days when monetarism reigned king. Quantitative easing. When the Federal Reserve put interest rates down to zero, and still the economy did not recover, it felt it could and should do more. One idea was to purchase long-term bonds, driving down the long-term interest rates and providing more liquidity to the economy. This was called quantitative easing. The ECB was slow to introduce quantitative easing. It did so long after the United States and even after Japan. Even as it undertook QE, the ECB may not have grasped why quantitative easing had such a limited effect in the United States, and why, therefore, the benefits would likely be still weaker in Europe. The problem in quantitative easing in the United States from 2009 to 2011 was that the money that was created wasn't going where it was needed and where the Fed wanted it to go, to increase spending in the United States on goods and services. Important credit channels, especially to small and medium-sized businesses, were clogged. So the money naturally flowed to foreign countries, especially economies that were already growing strongly and beginning to face inflation. They didn't want the extra money, and they created barriers to these flows, imperfect, but still somewhat effective. The three main channels through which quantitative easing helped the economy were all weak. A slight weakening of the value of the dollar helped exports, but these effects were eventually countervailed by America's trading partners. Mortgage rates were reduced as long-term interest rates fell, but the monopolistic banks, and bank concentration after the crisis was greater than before, took much of the lower interest rates and simply enjoyed it as extra profits, and the stock market bubble led the very rich to consume a little more, especially of luxury goods, many of which were made abroad. What the economy really needed was more lending to businesses, but big businesses were already sitting on $2 trillion of cash and were essentially unaffected by QE. And because the Fed and the Obama administration had fixed their attention on the big New York banks and other international banks, the ability of the smaller regional and community banks to make loans remained impaired. The result was that years after the crisis, such lending remained before its pre-crisis level. By the time that the ECB considered undertaking quantitative easing, it was known that it was a weak instrument. The ECB could and should have realized that the benefit it would get from the exchange rate was likely smaller than what the United States had gotten. First, because everyone was now doing it, Europe wouldn't get the benefit of competitive devaluation. Secondly, the emerging markets had set up controls to ensure that they were not disadvantaged. Thirdly, and most importantly, little domestic demand would be created unless the credit channels were fixed, and in this respect, Europe was much worse off than the United States, as we saw in the last chapter, with dramatic decreases in SME lending and a shrinking of the banks in the periphery countries. The ECB could have taken more aggressive measures to ensure that the money didn't go into credit bubbles and that more of the money went into supporting new businesses and expanding old businesses. Their philosophy of trusting the market may have made them hesitant to do so. Some were worried that QE would result in inflation. But massive QE had not resulted in inflation in the United States, and there was even more of a reason not to be worried about incipient inflation in Europe. Much of the money was held by banks. The problem was that the banks were not lending out money. Much of the money that the Fed and the ECB helped create simply stayed within the Fed and the ECB, or in any case, didn't lead to more lending. Since the additional liquidity was not leading to more spending, it could not lead to more inflation. There were, however, other risks associated with this massive expansion of central bank balance sheets. One was that it could lead to asset price bubbles, just as the earlier easy money policies had contributed to the real estate bubble. The breaking of those bubbles in turn might lead to economic volatility. The Fed at least had tools to deal with such a problem. It could raise margin requirements, the amount that investors had to put down when they made an investment in, say, a stock or commodities. And in the aftermath of the crisis, it even had a mandate to do so. It was required to ensure not just low inflation, high growth, and full employment, but also financial stability. Unfortunately, the European Central Bank, with its mandate formulated in the period of neoliberal ascendancy, focused just on inflation, leaving it to others to worry about the stability of the financial system. The natural rate hypothesis. Monetary policy, in the way it has been managed in Europe and the United States, has proven of limited effectiveness in the restoration of robust growth. Long ago, Keynes had argued that when the economy was in a recession, or worse, depression, that was likely to be the case. But there has been a strand in economics which has questioned more broadly the effectiveness and desirability of an active monetary policy, one directed at maintaining the economy at full employment, more broadly, and these ideas have been especially influential among conservatives. Critics of an active monetary policy argue that if one tried to get the unemployment rate below a critical level, called the natural rate, and hold it there would be ever-increasing inflation. This theory greatly narrowed what central banks should do. If one was committed to avoiding superinflation, at most one could have a short period of unemployment below this threshold, to be offset by another period while it was above. In this view, central bankers faced no trade-offs. Their job was simply to keep the unemployment at the natural rate. This theory has been increasingly questioned. If one looks at the data, one can't see a systematic relationship between inflation or the increase in inflation and unemployment. If there is a natural rate, it is a movable target and we almost never know where it is. Thus, policymakers have to guess, and in making that guess, there are big trade-offs. A risk of much higher unemployment than necessary versus a risk of somewhat higher inflation than we might desire. Thus, even if the simplistic models that say there is no trade-off between unemployment and inflation were correct, once we take account of the fact that we don't know what the natural rate of unemployment is, there are trade-offs. The risks of underestimating the natural rate and overestimating it are borne by different people. Central bankers in Europe and America have managed these risks, focusing more on financial markets than on workers, and in doing so, there has been an unambiguous loss in output and an increase in inequality from what otherwise would have been the case. Chapter 7. Crisis Policies. How Troika Policies Compounded the Flawed Eurozone Structure, Ensuring Depression. Those outside of Europe, and many in Europe, have been appalled at the unfolding drama in the crisis countries, especially Greece, Spain, Portugal, and Cyprus. Pictures abound of middle-class individuals suddenly in jeopardy, retirees whose pensions have been cut to the bone, and young people, college graduates, who have looked and looked for a job and can't find one, living in homeless shelters. These stories tell us that something is wrong. So, too, do youth unemployment rates of 30% or more. It wasn't this way before the euro. My wife and I gently tried to confront the Prime Minister of one of the northern European countries at a private meeting in 2013. Was he aware of how bad things had become? News articles that fall and winter had described formerly middle-class families in Spain and Greece scavenging for survival, unable to afford to heat their homes in winter, even eating out of garbage cans. His cold reply, delivered with a gentle smile, was that they should have reformed their economy earlier. They should not have been so profligate. But of course, it was not these individuals who had been profligate who had failed to reform. Innocent citizens were being asked, forced actually, to bear the consequences of decisions that had been made by politicians. Ironically, often politicians from the same political party of the right that the Troika seemed so fond of. The lack of empathy on display at that dinner, the lack of European solidarity, has been in evidence repeatedly. Bad enough was the scolding and flippancy of those like the Prime Minister we spoke to, as the guiltless citizens of the worst-hit countries suffered real privation. Yet the biggest display of callousness has not been in any politician's comments, public or private, but in the actual policies that the Troika has foisted on these countries in their moments of desperation. These policies have compounded the crises, weakened the hard-fought bonds of European unity, and magnified the inbuilt frailties and flaws of the Eurozone's structure. Astonishingly, even with the avalanche of evidence that the Troika's programs have failed the people of the countries they were supposed to help, its leaders have been claiming success for their austerity. This stretch of imagination, that Spain, Portugal, and Ireland were success stories, could only be achieved by wearing blinders that hid all but the most limited economic indicators from view. Yes, the Troika's 2010 to 2013 economic adjustment program for Ireland had brought the country's financial sector and government back from the brink of total economic collapse. But the austerity the Troika imposed helped ensure that Ireland's unemployment rate remained in double digits for 5 years, until the beginning of 2015, causing untold suffering for the Irish people and a world of lost opportunities that can never be regained. For comparison, the United States unemployment rate peaked at 10% for just 1 month in 2009 during the Great Recession. And Ireland was one of the best cases. In 2011, the IMF bailed out the Portuguese government as it faced spiraling borrowing costs in the wake of the global financial crisis. Its cash injection of €78 billion came with strings attached, of course. The government was required to lower its deficit from nearly 10% of GDP in 2010 to 3% in 2013. Barring strong economic growth, the only way to achieve that reduction was austerity, reductions in government spending, such as lowered wages for public servants and increases in taxes. Without such assistance, of course, Portugal would have had to have even more drastic cutbacks because it, too, was cut out from capital markets. The IMF has also claimed its Portugal program as a success, and indeed, if all one cares about is the lending rate for the government, the bailout achieved its aims. Portugal went from paying 13% on its 10-year bonds at the end of 2011 to paying less than 3% by the end of 2014, when the program ended, among other improvements to the government's fiscal position and borrowing abilities. Yet, austerity kept the fundamentals of the economy feeble. By 2015, GDP per capita was still down an estimated 4.3% from before the crisis. Unemployment was still above 12% in early 2016. Growth predictions in the next years are sluggish. The IMF estimates that GDP will not expand more than 1.4% annually at any point in the next several years. The government might be borrowing with more ease, but the Portuguese people never experienced a real recovery. Although Spain's 2012 bank bailout didn't come with direct conditions requiring reduced government spending or higher taxes, after 2008, the country still swallowed the austerity snake oil being hard sold on the continent. A common-sense look at the data and the hundreds of thousands of indignados who marched in the streets of 2011 showed that these policies' legacy of evictions, wage cuts, and unemployment was anything but a triumph. Yet, in mid-2015, with nearly a quarter of the Spanish workforce still unemployed, the German Council of Economic Experts, along with many other austerity boosters, was claiming Spain as the prime example of the virtues of austerity. It was with these fundamental perversions of the definition of economic success that the Troika blundered forward to its worst misadventure yet, in Greece. There, its program has been wrong, destructive, and almost unbelievably narrow-minded. More than that, it has bordered on inhumane. Still, in 2015, the Troika doubled down on its man-made disaster. For instance, as Greece entered its third program in the fall of 2015, Europe demanded that Greece end a program of forbearance against those who owed money on their mortgages, in order to save great swaths of its population from homelessness and deeper destitution. Greece had implemented a temporary ban on home foreclosures when the crisis set in. The ban was still in effect in 2015, but with many amendments that had reduced the scope of loans it covered. The Troika often masquerades its demands as simply proposals, things that the crisis country should consider, but they are more than proposals. Greece had to accede to them. There are negotiations, but as the story of the foreclosure proposal illustrates, in the end, typically what is agreed is little different from what was originally proposed, though there may be a few cosmetic changes, a face-saving gesture to enable the crisis country government to swallow the bitter medicine. The leaders of the Troika appear to believe that those not paying their mortgages are deadbeats who are exploiting the foreclosure ban to take a holiday from their bills. Be tough, and the deadbeats will pay. The reality, though, is otherwise. With the Depression, with hundreds of thousands out of a job, hundreds of thousands more having to take massive pay cuts of 40% or more, most of those not paying can't pay. Europe was betting that toughness would yield a bonanza for the banks, and the amount Europe would need to recapitalize them would be reduced accordingly. More likely, though, is that thousands of poor Greeks would join the homeless, and the banks would be saddled with homes that they could not sell. Greece pleaded with the Troika to soften its draconian demands, but the Troika held fast, ordering severely watered-down protections. Only those with an income below €23,000 a year would still be fully protected. Of course, families with such a low income typically don't own a home, so the exemption meant little. Greek officials capitulated and wanly claimed the majority of Greeks would be eligible for some protection, a claim that seemed thin. What was unambiguous was that many on the brink of destitution had been pushed a few more inches toward the edge. The technocrats of the Eurozone were not focused on the statistics that captured this suffering, nor did they see that beneath the cold statistics were real people whose lives were being ruined. Like the airplane bombing from 50,000 feet, success is measured by targets hit, not by lives destroyed. The technocrats were interested in different statistics, interest rates and bond spreads, how much extra those in the crisis countries have to pay to borrow money, budget and current account deficits. Unemployment rates sometimes seemed just a measure of collateral damage, or, more positively, a harbinger of better times ahead. The high unemployment rate would drive down wages, making the country more competitive and correcting the current account deficit. Perhaps the one advantage of the Troika's Greek tragedy is that it provides a paradigmatic example of the problems with the Eurozone's policy response to the global financial crisis and its aftermath. While in this chapter and the next I discuss the case of Greece in special detail, it should be kept in mind throughout that the policy mistakes the Troika forced on Athens in its time of need are simply amplified versions of those it established through pressure, cajoling, and loan conditions in other crisis-hit countries. The imperative to do something. As the crisis in the Eurozone unfolded in early 2010, the leaders of the currency union had to do something. Bond yields were soaring. Long-term Greek interest rates started the year at 6% and reached 12% by December. The real crunch, however, arrived when it came time for Greece to borrow more, to finance its huge fiscal deficit, 10.8% of GDP in 2010, and to repay loans coming due. No one would lend, and if the government couldn't borrow, they couldn't repay what was owed. Default was the next step. But if Greece defaulted on its bonds, those who owned the bonds would be put into a more precarious position. German and French banks, let alone Greek banks, that held significant amounts of these bonds might themselves become insolvent. Worse, because of the lack of transparency in the financial market, no one knew exactly how each bank would be affected. Some banks that had not lent to Greece may have lent money to other banks that had, so they too might be at risk. Some banks had bought insurance against losses, but some banks had gambled, taking bets that Greece would not default. It was a mess, and it was a mess that could spread. The world had just experienced a dose of this kind of contagion. In the aftermath of the collapse of Lehman Brothers, the entire world went into an economic recession as financial markets froze. It was not clear whether Greece was small or large relative to Lehman Brothers. Most importantly, it was not clear whether it was systemically significant. In Chapter 1, I described how, as each country went into crisis, the Troika formulated a program supposedly designed to bring the country back to health, and for the countries that had lost access to international credit markets to regain access. Here was the critical flaw. A focus on access to capital markets and the repayment of debts owed, rather than the restoration of growth and an increase of living standards of the people of the country. Not a surprise. Finance ministers naturally focus on financial markets. But the European project was not supposed to be about financial markets. They were simply a means to an end. The means became an end in itself. As one program after another unfolded, as one country after another went into crisis, two things stood out. One, each country that undertook one of the programs went into a deep downturn, sometimes a recession, sometimes a depression, from which recovery was at best slow. And two, these outcomes were always a surprise to the Troika, which would forecast a quick recovery after an initial drop, and when the predicted recovery didn't occur, Troika proponents would argue that it was still just around the corner. Figure 7 shows, for instance, in the case of Greece, what the Troika thought would happen as a result of their initial program in May 2010 and what actually happened. They realized that there would be a downturn, but they predicted a quick turnaround. By 2015, just 4 years later, the economy was nearly 20% below where they thought it would be. These dismal forecasts made it clear the Troika's grasp of the underlying economics was abysmal. While the Troika now might want to shift blame, the country had not done what it was told to do. The truth is otherwise. Greece's depression wasn't because Greece didn't do what it was supposed to, it was because it did. So too for the other crisis countries. Their downturns were largely because the countries had faithfully followed the Troika's instructions. This and the next chapter explore more closely what Europe did to achieve such adverse results. I look at the programs imposed on the crisis countries and show that these programs would inevitably lead to deep recessions and depressions. I also explain why the negative effects were even larger than what most of the standard economic models had predicted. There were alternative policies that would have set these countries on the road to recovery, a growth policy rather than austerity, and a deep debt restructuring. This chapter will focus on the macroeconomic policies, those aimed directly at the budget, at deficits, and debt. It is the macroeconomic policies that have resulted in the downturns, recessions, and depressions plaguing Europe. The next chapter continues the discussion of the programs, focusing on the structural policies that were imposed on the countries, policies directed at reforming particular markets in an attempt to make the crisis countries more competitive. Much of the discussion of this and the next chapter focuses on the Greek program, simply because that program highlights more clearly than any of the others the problems of all of the programs imposed on the crisis countries, and because it illustrates most clearly the mindset of the Troika. The macroeconomic framework of the crisis programs. The leaders of Europe like to think of the crisis programs as providing both symptomatic relief, getting over the immediate problem, and creating the basis for long-term adjustment. More accurately, one can think of the programs as mechanisms to ensure that debtors pay the costs of adjustment and creditors get repaid. Added to the mix is a large dose of politics. Some of the creditor countries, particularly Germany, did not want its taxpayers to know the costs that might be imposed on them. They wanted their citizens to believe that they were going to be repaid, even if that was essentially impossible. There is a high price associated with such a charade, with most of the costs borne by Greek citizens, for instance. But even Germany is likely to bear some of the costs because of the reduced probability of repayment. Politics affects creditors and debtors alike, and Greece provides the best example of this interplay. Germany and the Troika imposed harsh conditions on the government of George Papandreou after it had uncovered and transparently disclosed budgetary chicanery by the previous Greek government. The punishment paved the way for the return of the Samaras right-wing government that had actually put Greece in its impossible position. In effect, rather than punishing the party that had acted badly, the Troika had rewarded it. It was even worse. When in power, the Papandreou government had begun a process of curtailing the power of the Greek oligarchs, who had a controlling interest in banks and the media, and were exploiting the linkages between the two. But the New Democracy Party of Samaras was closely linked with the same oligarchs, and it was no surprise that upon his return to office, the Papandreou reforms were reversed, without a peep out of the Troika. Thus, the Troika programs were counterproductive when it came to encouraging the most fundamental reforms that were widely seen as necessary for long-term shared prosperity in Greece. Fiscal balance can be restored by cutting expenditures and raising revenues. The social and economic consequences depend greatly on which expenditures are cut and how revenues are raised. Under Troika programs, not only was there too much emphasis on restoring fiscal balance, but they also went about restoring balance the wrong way. The programs resulted in more adverse effects on output, employment, and societal well-being than was necessary. The IMF especially should have known that poorly designed tax measures can backfire, tax revenues can fall, and so too can economic output. In the sections that follow, we take up different aspects of the macroeconomic policies imposed on the crisis countries. Austerity, the myth of the Swabian housewife. At the center of the macroeconomic programs was austerity, a contraction in government spending and an increase in revenues. While the authorities in Europe seemed surprised by the strongly adverse outcomes that were so much worse than their models predicted, I was surprised that they were surprised. As we have noted in earlier chapters, austerity has never worked. Thinking about austerity. In some ways, it was not a surprise that the leaders of the Eurozone would demand that Greece cut its deficit. The crisis in Greece seemed to stem from the fact that the government couldn't borrow more, and the country had had a very large and unsustainable deficit for years. This logic, though, did not apply to Spain, for instance, where the crisis arose from the banking sector, and where, as we have repeatedly noted, the country had had a surplus before the crisis. The crisis had caused the deficit, not the other way around. The obvious immediate goal was to make it so the countries wouldn't need to borrow more, and that's where the austerity programs fit in. Cut expenditures and raise taxes enough, and there would be no need for outside finance. But such matters are not so simple. Austerity leads to economic slowdowns, lowering revenues and increasing social expenditures on items like unemployment insurance and welfare. Any improvement in the country's fiscal position is much less than expected, and the suffering is much greater than expected. This is the fundamental difference between the Swabian housewife, which Germany's Chancellor Angela Merkel so famously talks about, and a country. The Swabian housewife has to live within her budget, yes, but when she cuts back on her spending, her husband doesn't lose his job. If he did, the family would obviously be in much worse shape. Yet that's exactly what happens when austerity is imposed on a country. The government cuts spending and people lose their jobs. There is a better analogy than the Swabian housewife, and that is between a country and a firm. In the case of firms, we focus on the balance sheet. No one would ask about the size of the liabilities. They want to know what the assets are and what the net worth is. If a firm borrows to buy assets that increase its net worth, it's a good move. Countries that borrow to finance investments in, say, infrastructure, education, and technology can be better off, and especially so if there are underutilized resources, unemployment. Austerity is then bad both in the short run, it leads to higher unemployment, and in the long, it leads to lower growth. Primary surpluses. The Troika focused its attention on the size of the primary surplus in the crisis countries, the excess of revenues over expenditure net of interest payments. This was understandable given the interests of creditor countries like Germany. They wanted to be paid back, naturally enough. But obviously a country that is borrowing can't repay. The only way the government can repay what is owed is if it runs a surplus. That such a surplus would normally lead to a weak economy is obvious. When the government has a surplus, it is taking away from the purchasing power of its citizens more than it is adding back through its spending. Thus, it is contributing to a lack of demand. Sometimes, something else can make up for the shortfall. The United States had a primary surplus in the latter part of the 20th century under President Clinton, but it had an economic boom driven by the tech bubble. The high level of investment sustained the economy, but when the tech bubble broke, the country quickly went into recession. Germany, of all countries, should understand this. At the end of World War I, Germany was made to pay reparations by the Treaty of Versailles. To finance the reparations, it would have to run a surplus. Keynes correctly predicted that German reparations and the resulting German surplus would cause a German recession, or worse. The depression in Germany that followed had disastrous political consequences, not just for Germany but for the entire world. For a while, Germany avoided the depression by borrowing from the United States to sustain demand, but with the Great Depression in the United States, this source of funds was cut off, and Germany, too, went into depression. Given the history, it is shocking that Germany and the Troika have demanded that Greece and other crisis countries maintain large primary surpluses. In the case of Greece, it insisted that the primary surplus reach 3.5% by 2018. Even the IMF knows that such a target will only extend and deepen the country's ongoing depression. The current program allows easier targets for 2015 to 2017, but if Greece complies with the agreement's primary surplus target for 2018, no matter how faithfully it fulfills the structural reforms, no matter how successful it is in raising revenues or cutting back on pensions, no matter how many are left to die in underfinanced hospitals, the depression will continue. The design of the austerity programs. The basic design of the program sets fiscal targets, scaling down the primary deficit and eventually reaching a primary surplus. In the earlier agreements between Greece and its partners, the fiscal targets were almost never met, simply because the Troika was using fictional forecasts. Now, in the memorandum of August 19, 2015, if the targets are not met, as they almost surely won't be, additional doses of austerity become automatic. While previously austerity led to contraction, there was always the hope that the Troika would relent as it saw the magnitude of the contraction induced. Now, it's a built-in destabilizer, which guarantees a deep downturn. As the economy weakens and tax revenues fall, tax rates will have to increase, and this will depress the economy still further. Even conservatives in the United States have argued that when the economy weakens, tax rates should be reduced, not increased. And as the market comes to realize this, the adverse effects will be all the larger. Hidden agendas. Even if one were fixated on the fiscal deficit, there are fiscal policies that could stimulate the economy without increasing current deficits. These deploy the principle of the balanced budget multiplier. If one imposes a tax and spends the resulting revenue, so the deficit is absolutely unchanged today, the economy expands. The expansionary effect of the spending outweighs the contractionary effect of the tax. And if the expenditures are well chosen, say on teachers rather than wars, and so too the taxes, say on the wealthy, then the balanced budget multiplier can be large. $1 of increased spending can induce much more than $1 of increase in GDP. Furthermore, if the money is spent on long-lived investment goods, increasing productivity, the resulting increase in future tax revenues puts the government's long-run fiscal position in a better shape. Some Eurozone countries have done the opposite. France, for instance, has lowered the corporate income tax and to offset the decrease in revenues, cut spending. The balanced budget multiplier predicts that the result will be a contraction in the economy. What France has been betting on is that the lowered corporate income tax will lead to more investment, improving aggregate supply and demand. But what is holding back investment in France and elsewhere in Europe among large corporations is lack of demand for their products. Without demand for their products, firms will not invest, even if the tax rate were close to zero. Moreover, even if there were demand for the company's products, both theory and evidence questions the importance of the corporate tax rates as a driver for investment. The reason is simple. Most investment is financed largely by debt. What firms care about is the after-tax cost of these funds. If they have to pay 10% interest, but the tax rate is 50%, since they can deduct all of their interest payments, the after-tax cost is only 5%. In effect, the cost of the investment is shared with the government, which picks up half the tab in the form of reduced taxes. The higher the tax rate, the lower the cost of funds to the firm. By itself, this would suggest that the higher the tax rate, the more investment. But, of course, higher taxes also reduce the returns from the investment. What matters is the balance between these two effects, and a close look at that shows that there is little effect on investment. If France wanted to stimulate its economy, it should have lowered taxes on corporations that invested in its country and created jobs, and increased them on those that did not. That the balanced budget multiplier was virtually never even discussed with respect to the Eurozone crisis implies a hidden agenda, downsizing government, decreasing its role in the economy. This conclusion is reinforced as we look more closely at the details of the austerity programs. Increasing revenues. The programs had two key ways of raising revenues: taxation and privatization. Designing tax increases. Normally, the IMF warns of the dangers of high taxation. They worry about the disincentive effect, the discouragement to work and savings. Yet in Greece, the Troika has insisted on high effective tax rates even at very low income levels. For instance, they insisted on and secured a value-added tax of 23% on a large number of products and services, which, combined with an income tax that even at very low levels of income is at around 22%, made for an effective tax rate close to 40%. All recent Greek governments recognize the importance of increasing tax revenues, but mistaken tax policy can hasten an economy's destruction. In an economy where the financial system is not functioning well, where small and medium-sized enterprises can't get access to credit, the Troika demanded that Greek firms, including mom and pop operations, pay all of their taxes ahead of time, at the beginning of the year, before they have earned any money and before they even know what their income is going to be. The requirement is intended to reduce tax evasion, but in the circumstances in which Greece finds itself, it destroys small businesses. While the Troika has talked about structural reforms with positive supply-side effects, this measure alone probably has a stronger negative supply-side effect than all of their structural reforms put together. Such draconian measures inevitably lead to more tax evasion, again seemingly in contradiction to another major thrust of the Troika programs. This new tax requirement seems at odds, too, with another of the demands Greece has confronted, that it eliminate its withholding tax on money sent from Greece to foreign investors. Such withholding taxes are a feature of good tax systems in countries like Canada and are a critical part of tax collection. Evidently, it is less important to ensure that foreigners pay their taxes than Greeks do. This measure takes on special meaning when it is noted that allegedly one of the largest non-payers of taxes is the German company that managed Athens Airport until 2013. According to some, this company is hundreds of millions of euros in arrears. Obviously, if one thinks that the government is not good at collecting taxes, an irresponsible foreign investor will try to get his money out of the country without paying taxes. Possession is 9/10 of the law. In this case, it may be 10/10. It then becomes very difficult for the government to recover such amounts. There is, among economists, broad agreement about the central ingredients of a good tax system. A good tax system should not distort the economy any more than is necessary. That's why taxes on land and natural resources are desirable. The amount of land doesn't change, no matter what the tax imposed. More generally, a good tax system levies taxes on items where impacts on demand or supply are limited. With high and increasing inequality, a good tax system has to be sensitive to who bears the burden. It should be disproportionately on the rich, not the poor. Finally, well-targeted taxes can help restructure the economy, for instance, by promoting renewable energy and by discouraging polluting activities. The Troika's tax demands, say in the case of Greece, violate these principles. Tourism provides another instance where the Troika's tax demands are likely to be counterproductive. Especially in the niche in which Greece competes, tourists comparison shop. Greece was concerned about a higher value-added tax's impact on tourism, especially in the country's islands, which face high transport costs. High taxes would lower demand for Greek tourism, simultaneously hurting employment, GDP, and Greece's current account, and tax revenues might actually decrease, but the Troika would hear none of this. Many of Greece's problems in tax compliance are similar to those among small businesses everywhere, especially so in a cash economy. Yet, Troika policies effectively encouraged those in countries with financially precarious governments to move their money out of banks. The Troika undermined tax collection in other ways. When taxes are viewed as imposed by outsiders at high levels, in ways that make no sense, for example, exempting foreign transfers from withholding taxes, forcing small businesses to pay taxes a year ahead of time, resentment builds and trust and voluntary compliance erode. The taxes are not viewed as the product of democratic consensus, but as the imposition of foreigners, hypocritical foreigners, who do not even pay the taxes they owe. And then, when the numbers and pay of tax collectors are cut, along with their job security, there is inevitably demoralization of those responsible for tax collection. There were alternative taxes more consistent with the basic premises of a good tax system. Property taxes can be a good thing, a key part of a good tax program, but the Troika couldn't even get that one right. The one asset in a country that is not movable is its land. Not only is land not movable, but it is inelastically supplied. The amount of land does not decrease when one taxes it more. There has long been a strong presumption in favor of land taxes. Under the Troika programs, Greece had adopted a new property tax, but with their small property the only thing separating many ordinary Greeks from outright poverty, the tax was deeply resented. The strict enforcement of the tax against unemployed people with no source of income would mean the loss of their major asset. What should have been deployed was a progressive property tax on all large property holdings. A problem which the Troika should have recognized early on was the absence of a comprehensive national property register. But this gap could easily have been remedied. Individuals could have been asked to declare all of their property holdings with a description. For example, the number of rooms, whether there is a pool, and a value. Modern technology, including satellite imagery, allows the verification of at least some aspects of the description. Individuals who do not report accurately their holdings could be threatened with the loss of their property, and a special tax could be levied on large houses and on pools, but not so large that it would pay people to fill in their pools. The government could be given the right to purchase the property at, say, 125% of the declared value, providing a clear incentive for honest reporting. The law also could require that the beneficial owner of all properties be declared. Well-considered tax policy can correct for market failures, generating a double benefit tax revenue as well as improved economic efficiency. Perhaps the most important market failure the world faces today concerns climate change. We do not price carbon. Greece has a rich potential abundance of renewable energy, both solar and wind. Besides, developing these industries would reduce its consumption of oil. One of the country's industries is oil refining, so if Greece consumed less, there would be more to export. Thus, a high tax on non-renewable energy would simultaneously generate revenues and improve Greece's balance of payments. We have repeatedly observed that one of the problems of the Eurozone was that it eliminated the power to adjust the nominal exchange rate. But, again, in the absence of that power, tax policy could have been deployed. Because Greece produces relatively few goods, consumption taxes, especially on luxury goods like high-priced cars, which have to be registered in the country and are imported, would have been progressive, could have raised substantial revenues, and would have gone some way in correcting the trade deficit. Privatizations. There is an alternative way of raising revenues, and that is selling state assets, i.e., privatization. Of course, such sales do not directly or necessarily improve the balance sheet of the country and its government. Earlier in this chapter, we emphasized the importance of not just looking at a country's debt, but at its balance sheet, liabilities in relationship to its assets. The Troika and the Eurozone more broadly didn't do this. In the case of privatizations, too often they looked only at cash flow, without regard to the long-run consequences. When a country sells its assets in a fire sale, its net worth is decreased with long-run consequences, either less revenues for the government, because it doesn't own an asset that yields returns, or greater costs because it now must, for instance, pay rent for office space, having sold its own buildings. The best case for privatization is when the government has proven itself incapable of managing an asset well, and where there are several competitors for the asset, each of which would improve the efficiency of management. The worst case for privatization is when the asset is sold to a monopolist, who uses his market power, his power to raise price above the cost of production, to exploit consumers, with consumers and firms even worse off under even an efficient monopoly than under an inefficient government operator. Moreover, privatization gives rise to an unhealthy political dynamic. The monopolist uses its profits to buy political influence, which extends and enhances its market power. Privatization can thus result in increased corruption in addition to a less competitive and overall less efficient economy. In Europe, corruption is more likely to take the more sophisticated form of campaign contributions rather than cash-stuffed paper envelopes, but it is corruption nonetheless. When the privatization results in foreign ownership, further problems arise. First, changing taxes and regulatory structures that affect the profitability of the foreign enterprise may generate enormous political pressure from the governments of its home country. What would otherwise have been a domestic matter becomes an international affair. When the new owner of the asset or its government has political power over the country, as the Troika does over the crisis countries, the interests of the citizens may not be well served, as the provision on tax withholding on cross-border flows dramatically illustrates. Moreover, the flow of profits out of the country can even have an adverse effect on the balance of payments, especially if there is a fire sale. The benefits of the inflow in the short run are more than offset by the long-term capital outflows from the repatriation of profits. There is one special case of privatization that is particularly problematic: when the enterprise buying the asset is partially or totally owned by a foreign government. One has to ask, in what sense is it a privatization if the purchaser is a public entity? It is hard to simultaneously argue that governments necessarily are less efficient and that one should sell one's assets to another government. In the case of Greece, the problems with privatization have already become evident. Some of the privatizations, past and proposed, have been to enterprises owned in part by the German government at the subnational level. As I have noted, a German company held a significant stake in the management of the Athens airport until 2013, and the proposed privatization of regional airports is to a company in which German public entities are a major partner. The German state of Hesse, the largest shareholder, owns some 34% of the company. There is another unsavory aspect of at least one of the privatizations that have occurred under the Greek programs, that of the regional airports referred to earlier. One of the partners in the privatization is one of the oligarchs, anomalous since one of the main structural reforms in the Greek program should be weakening the oligarchs' power. That the Troika faces conflicts of interest should be obvious. So, too, it should be obvious that neither these conflicts of interest nor the public relations issues that result have been well managed. These failures undermine confidence in the entire Troika program, not just in Greece, but in all of the crisis countries, and raise troubling questions about whose interests are being served by the programs. Cutting spending. The second part of restoring fiscal balance, after raising revenue, is cutting spending. As we noted earlier, the debts of Ireland and Spain increased not so much through ordinary spending as through bank bailouts. These two cases are so important that we will focus on them in the next section of this chapter. The spending cuts that the Troika has imposed in the crisis countries, like the tax increases, have not been well designed. Like the tax cuts, the Troika should have focused on cuts that would have had the least adverse effects on GDP and on societal well-being. Ordinary citizens are the most dependent on public expenditures like schools, publicly provided medical care, social programs, and welfare benefits. The rich can take care of themselves. Of course, in any country and in any program, there are inefficiencies, but the Troika programs went well beyond squeezing out such inefficiencies. And there are other obvious options for cuts if there were the political will to pursue them. In the 21st century, military conflicts in the heart of Europe have been rare. This may have a little to do with the European Union itself, a lot to do with the United Nations and changed attitudes toward war, and some to do with NATO. In any case, most of the country's defense posture would be little affected by major cutbacks in defense expenditures. In any real attack, they would have to rely on NATO. There exists also a massive set of inefficient subsidies, some hidden within the tax code, often to well-off business groups, the elimination of which would lead to a more efficient economy and more equal society. Most countries, including the crisis countries, for instance, have large energy subsidies, and in particular for fossil fuels. The irony is that a very large fraction of spending at the EU level, more than 40% of the EU budget, goes to distortionary agricultural subsidies. much of which goes not to small farmers, but to large agribusinesses. Pensions. In the case of Greece, the Troika has focused on cutting public sector pensions, which it views as outsized. It appears that this is true for some Greek pensions. Others are not even enough for survival. One cannot retire in dignity with a monthly pension of under the poverty line of 665 euros, yet 45% of Greece's retirees are attempting to do that. Indeed, a higher fraction of older Greeks were at risk of poverty in 2013, some 15%, than the Eurozone average, and in early 2012, well before the demands of 2015 that almost led to the Greek exit, or Grexit as it is called, Greece was actually spending less per person, 65 and over, than were Germany and most other Eurozone countries. But pensions are rightly thought of as a form of deferred compensation. The individual performed work, for which he is paid in two ways, wages today and a pension in the future. The pension is part of the contract. Both before and after the Greek crisis of the summer of 2015, the Germans argued that Greece's debts should not be restructured. A contract is a contract, even though it was patently clear that the debt would have to be restructured. Somehow this belief in the sanctity of contracts did not extend to pensions. Not paying a promised pension fully is, in effect, tearing up the contract. Worse still, cutting pensions affects the most vulnerable members of society, in contrast with a debt contract, where the lenders are financially sophisticated and understand the risks of default. Today, around the world, there is a great deal of concern over wage theft. After the worker has performed his work, the employer doesn't pay what is promised. The worker can't, of course, get back his time and effort. That is why wage theft is viewed as an egregious crime. But reducing pensions from their promised level is wage theft, merely in a different form. Greece's Council of State, its highest administrative court, recognized the illegality of the proposed pension cuts. To the Troika, the violation of these individuals' basic rights seemed an annoyance. Its response was to demand other reforms that would fully compensate for the fiscal impact of the Constitutional Court ruling. Future pensions are, of course, different from past commitments. The level of such pensions should be seen as part of appropriate compensation packages, what is required to attract talented people to perform the important business of the public sector. Again, the Troika hasn't framed the matter this way. If those in the public sector are not appropriately compensated, then the public sector won't be able to fulfill its necessary tasks. Citizens will then feel, justifiably, that they are not getting their money's worth out of their taxes, and tax compliance will decrease. Another vicious circle begins, where the Troika is clearly more a part of the problem than of the solution. Saving the banks. The financial sector was at the center of the Great Recession, and it has been at the center of the Euro crisis. As we've seen, a real estate bubble fueled by excess housing credit brought down Spain, and as is typical after the bursting of such a bubble, many who had taken out loans couldn't repay, and the weakened banks curtailed lending. The cessation of a major engine of economic growth, real estate investment, combined with the curtailed lending ensured that recession would follow. In turn, government attempts to prop up the banks, combined with falling tax revenues and increased social expenditure as the economy went into recession, put the government in a precarious fiscal position. The Eurozone had been constructed on the premise that each government was responsible for its own banks. Consider the case of Spain. As Spanish banks weakened, they had to pay very high interest rates. The banks faced a crisis. They might not even be able to borrow. Depositors might withdraw their funds, and the high interest rates might drive them into insolvency. The banks and the government were intimately intertwined, as we noted in Chapter 5. What gave depositors in banks some confidence that they could have their money when they wanted it was the backing of the government. But the weakening of the fiscal position of the government weakened confidence in the banks. At the same time, the weakening of the government's fiscal position meant it could only borrow at a high interest rate. Many investors were not willing to lend at all. To keep interest rates on government bonds from soaring even further, Spanish banks had to buy and hold on to large amounts of government debt. The decline in the price of Spanish government bonds then meant a worsening of Spanish banks' balance sheet. To an outsider, it was apparent that what was going on was a bootstrap operation. Banks lent the government money, typically by buying government bonds, and the government guaranteed the banks, allowing them to get access to money from markets at lower rates, so long as the government guarantee had much worth, and to lend some of that money to the government. Eurozone policy toward Spain and some other crisis countries was in many ways predicated on this bootstrap operation, wherein lending to the government would help bail out the banks, and lending to the banks would help bail out the governments, as the banks bought government bonds when no one else was willing to do so. The Eurozone stepped in with a variety of measures to help Spanish banks, though the Spanish government was ultimately supposed to bear the downside risk. But if the Spanish government could have borne the downside risk, it could have rescued the banks on its own. It was precisely because of the interlinking of the two that outside help was needed. Not surprisingly, the effect of such measures was at best temporary. A confidence game. What finally restored stability, but not strong growth, to Europe was Draghi's promise in 2012 to do whatever it takes to support the European sovereign government bond market. Sovereign spreads, the higher interest rates that Greece, Spain, and other crisis countries had to pay relative to Germany, came down. Even Greece's spread fell from 27.3 percentage points in February 2012 to 12.0 by the end of the year. Italy, Portugal, and Spain, though never experiencing a spread as large as Greece's, fell as well, to 3.2, 6.0, and 4.0, respectively. The increase in bond values improved the balance sheet of banks. It was a confidence game that was seemingly costless and has worked, at least for a while. As we noted earlier, no one knows, of course, whether the ECB in fact can and will do whatever it takes, if that day of reckoning arrives when a periphery country, in the face of a sudden loss in confidence in that country's bonds, needs ECB support. Any existing confidence in the ECB's promise would, of course, be greatly eroded were Greece or some other member to leave the Eurozone precisely because the ECB had not done whatever it takes. In the Greek crisis of the summer of 2015, the ECB showed itself resolutely unwilling to back Greece unless its government acceded to the demands of the Troika. As the negotiations ground on, the ECB went so far as to stop acting as a lender of last supply, forcing Greece's banks to shut down for 3 weeks. Hardly evidence of a willingness to do whatever it takes. More evidence of the political role of the ECB discussed in Chapter 6. If there is an exit from the euro of one or more members, the knowledge that the euro is not a binding commitment among its members, a commitment that will never be broken, will make the Draghi confidence trick far less likely to work the next time. Bond yields could spike, and no amount of reassurance from the ECB and Europe's leaders would suffice to bring them down from stratospheric levels. Even if the ECB were willing to do whatever it takes, it is not clear, short of a massive debt restructuring, that the ECB could save the day. The IMF is consistently brought in to provide liquidity when there is a lack of confidence by markets. In a very large fraction of cases, the IMF fails to restore the economy to health for 2 reasons. First, the IMF is a senior creditor. That is, it gets paid back before anyone else does. Thus, loans by the IMF worsen the risk profile of all other creditors. They stand further down the queue. The IMF rescue, therefore, makes these bonds even riskier. Secondly, the IMF typically supplies the funds with a long list of conditionalities, just as the Troika has done with its other members. Usually, these conditionalities are misconceived, both the macroeconomic/fiscal conditions and the structural ones. As in Greece, they almost guarantee a bigger economic downturn. And of course, as the economy's prospects grow dimmer, there is little reason that market confidence will be restored. Bailouts and debt restructurings. Who is really being helped? The first symptom of the crisis was the high interest rates paid by Greece on government debt, sometimes referred to as sovereign debt, followed by Greece being closed out of the market. No one would buy any new bonds that the Greek government might try to issue. The leaders of the Eurozone realized they had to do something, for if Greece didn't pay back the loans that were due, it could spell troubles, not just for Greece, but for the rest of Europe. Many of the Greek bonds were held by German and French banks. The Eurozone's immediate response was to provide credit, not so much to help Greece, but to help their own banks. But at what interest rate? To demonstrate to German taxpayers that they would not be subsidizing Greeks, the Troika demanded a high interest rate, so high that it was clear from the outset that Greece's ability to repay the debts was low. If they had chosen a lower rate, that might not have been the case. At the time the crisis broke out, Greek debt was around 109% of GDP, lower than U.S. debt at the end of World War II, 118%, much lower than Japan's debt now, 246%, and the UK's debt at the end of World War II, which reached some 250%. If one manages to grow the economy, increase GDP, and keep interest rates low, this debt-to-GDP ratio can be brought down, and dramatically so, as both the history of the United States and the UK demonstrated. But if one imposes stifling conditions and charges high interest rates, then the economy will stagnate, and the debt-to-GDP ratio will increase. Some in Germany and elsewhere claim high interest rates were necessary to discourage moral hazard, the risk that governments would spend recklessly and then turn to Europe for assistance. But no government would willingly put itself through the torture that Greece has endured. Moreover, whatever mistakes in lending occurred earlier, punishing Greece today doesn't rectify yesterday's mistakes. The real moral hazard problem arises for banks, who have an incentive to induce countries to borrow excessively, knowing that current politicians benefit from the increased spending and future politicians pay the price. Repeated bank bailouts encourage this kind of behavior. The Mexican, Latin American, and East Asian bailouts, each of which bears the name of a country, are really bailouts of the European and American banks that lent recklessly. These bailouts, of course, not only distort incentives but are expensive. They are, in fact, just one of the many forms of subsidy to the financial sector, especially the big banks, sometimes hidden in the lower interest rate they pay to those who provide them funds because of anticipation of the bailouts. If instead of just bailing out failing banks, the government took shares in those banks, then the country's fiscal position would be that much stronger when the banks rebounded, and perhaps the banks would be more prudent in their lending. True to history, Germany and the Troika did little to address the bank's moral hazard in the case of Greece and some of the other European bailouts. Indeed, as we saw in the case of Ireland, the ECB demanded, secretly, that Ireland bail out its banks. Whatever the reason, Germany's demand for high interest rates was well in excess of those at which Germany could borrow. This dealt a blow to any notion of European solidarity. What does solidarity mean if one country is able and willing to make a profit off its neighbor in its time of need? As it became obvious that Greece could not make the repayments, new loans were needed, with new conditions, ever more onerous. Of the total lent to Greece, less than 10% ever got to the Greek people. The rest went to pay back creditors, including German and French banks. It may be nice that the German and other European governments bailed out their banks, though whether that is good policy is another matter, but the Greeks rightly asked why it should be done so much on their backs. A fresh start, an alternative to depression-generating austerity. Debt restructurings are an essential part of capitalism. If a country, or a firm, or a family, is temporarily facing difficulty in servicing its debt, then a short-term loan to help it through the troubled period makes sense. But if there is a long-term problem, the loan needs to be written down. The individual needs a fresh start. Typically, a country has a bankruptcy law to allow this fresh start. The same principle applies to nations, but there is no international law for restructuring debt, though, as we noted earlier, there is now a move within the United Nations to create such a framework, and a resolution establishing a set of principles for debt restructuring was overwhelmingly passed in September 2015. Debt restructuring improves a country's fiscal position because the government doesn't have to spend as much servicing the debt. The money not transferred abroad can be used to stimulate the economy. Of course, of the array of possible actions, restructuring is most disliked by the creditor countries' governments, and even more so when the debt is owed to official bodies. The severe austerity and the other features of the Troika programs makes little sense even from the perspective of the creditors. It's like a 19th century debtor's prison. Imprisoned debtors cannot make the income to repay. So, too, the deepening depression in Greece will make it less and less able to repay. Debt restructurings are not a panacea. They do not resolve all of a country's problems. But without a debt restructuring, a write-down of what is owed, over-indebted countries can't return to health. In the case of Greece, the IMF has recognized the need for a debt restructuring, but even with a restructuring, unless there is relief from the extreme austerity measures now in place, the prospects for the country remain bleak. One shouldn't feel too sorry for the private sector creditors. Typically, they have been well compensated for their risk in terms of interest rates well in excess of the safe interest rate. For example, the rate on U.S. Treasury bills. If they have not been well paid, it reflects a lack of due diligence on the part of the creditors or a bout of irrational optimism. Of course, creditor governments don't like admitting to their citizens that they, or their country's banks, have to take a loss. There are strong incentives for pretend and extend. Pretend that the debtor is only having a temporary problem and extend the loan so as not to recognize the loss. But the costs of this charade are usually high, especially to the indebted country, and that has proven to be the case, particularly in Greece. Germany has been insisting that there be no restructuring of Greece's debt, only that there be another bout of pretend and extend. The problem with pretend and extend is that it provides no framework for a resumption of growth. It condemns the debtor country to never-ending misery. There is no fresh start. Moreover, Germany's refusal to restructure put Greece in the impossible situation of having to agree to a program that it knew would not and could not work. The Troika program was incoherent. The Germans simultaneously said there must be no debt write-off and that the IMF must be part of the program. But the IMF cannot participate in a program where debt levels are unsustainable, and the IMF had already determined that this was the case for Greece's debts. Could Greece proceed in a restructuring on its own? There is an argument that Greece should begin the process of debt restructuring on its own, if Germany doesn't accede. Even the IMF says that debt restructuring is absolutely necessary. Whether or not the current program is well implemented, it will lead to unsustainable levels of debt. The Greeks might take a page from Argentina, exchanging current bonds for GDP-linked bonds, where payments increase with Greece's prosperity. Such bonds align the incentives of debtors and creditors. As we saw in earlier chapters, after Argentina restructured its debt and devalued, it grew rapidly. the fastest rate of growth around the world except for China's, from its crisis until the global financial crisis of 2008. Of course, Greece and Argentina are different economies. Argentina benefited from both a debt restructuring and a devaluation. If Greece only had a debt restructuring, would that be enough? Argentina benefited, moreover, from a large increase in exports as a result of the commodity boom. There are, however, some striking similarities. Both countries were being strangled by austerity. Both countries under IMF programs saw rising unemployment, poverty, and immense suffering. Had Argentina continued with austerity, there would have just been more of the same. The Argentine people rose up and said no. Greece is in a similar situation. If conditions continue as is, it will mean depression without end. Concluding comments. This chapter has focused on the macroeconomic and financial sector dimensions of the programs that have been imposed on the crisis countries. It is these that have predominantly determined the fate of the crisis countries. It is macroeconomic austerity that has led to the dismal performances. And while in some respects Greece was not typical of the crisis countries, in most it was private sector misconduct, not public sector profligacy, that brought on the crisis, Greece exemplifies the failures on the all-important macroeconomic front. Greece had the biggest and fastest fiscal consolidation among the advanced European economies in the aftermath of the global financial crisis, ruthlessly cutting back expenditures and raising new revenues. In the summer of 2011, as the first signs of the failure of the austerity policy emerged, Europe's leaders recognized that they needed a growth strategy. They promised Greece one. They didn't deliver. There was only more of the same. The bailouts of Spain, Greece, and the other countries in crisis appeared aimed more at saving the European banks that had lent these countries money than at restoring the crisis countries to health. It seemed aimed more at saving the euro than at preserving the well-being and economy of the crisis countries. In the end, then, it was not so much European solidarity that engendered the help that Germany provided to its neighbors as self-interest. A restructuring of Greek debt might have been the most economically sensible thing to do when the crisis broke out in 2010, with Germany providing direct help to its own inadequately regulated banks. But for German politicians, it was easier to vilify Greece and provide indirect assistance to German banks through a bailout loan called a Greek bailout, and then impose policy conditions on Greece that would seemingly force it to repay what was borrowed. In the end, the economic policy didn't work. It didn't work for the debtor countries or for the creditor. It didn't work for the Eurozone as a whole. Greece couldn't repay. And the Greeks paid an enormous price for Germany's political gambit. With the ongoing euro crisis, it is too soon to tell whether it worked for Germany's politics, for Merkel and her government. It would have been easy to restore Greece to growth, deep debt restructuring, simply recognizing that money that can't be repaid won't be repaid. A primary surplus of 1% by 2018, not the 3.5% Europe has demanded, and reasonable structural reform focused on the central issues facing the economy today, which I will describe in greater detail in the next chapter. The short-run economic consequences of the misguided programs in Greece and elsewhere are already evident. The longer-term consequences in terms of slower growth and lower GDP will only be seen over time. The best evidence is that a country that goes through a deep downturn never bounces back to make up for what is lost. What is lost forever. The social and political consequences, not just in Greece, but throughout the Eurozone, are also almost inevitable and potentially disastrous. Indeed, already some of these are evident, with the growth of more extreme parties. The centrist parties, both the center-left and the center-right, that had staked their reputation on the success of the Troika programs and on the idea that the euro would bring prosperity for all, have been discredited. More than 60% of voters in Spain, Greece, and Portugal have rejected the austerity parties. The Irish government was all but turned out. While these effects are felt most strongly in the crisis countries, they are also present elsewhere in the Eurozone, most notably in France and Italy. And the failures in the Eurozone almost surely have contributed to broader skepticism about the value of European integration, evidenced most starkly in the strong support for leaving the EU in the UK. In Spain and elsewhere, separatist parties calling for the breakup of long-established nation-states are in the ascendancy, reversing a 200-year trend of national political integration within Europe. While this chapter set forth the Troika's macroeconomic policies, the next outlines the structural reforms they imposed on the crisis countries, explaining why they too failed and how there were alternatives that would have worked so much better. Academics for austerity. An aside. While the austerity programs described in this chapter have largely been driven by politics and politicians, not surprisingly, academic economists have raised their voices. The vast majority have sided with the views expressed here. Austerity has never worked. When the government reduces demand, output falls, unless something else fills the gap. It's that simple. And because it is so simple, we haven't spent much time in the text explaining why exactly austerity has never worked. Here, we consider how austerity doctrines have sometimes garnered support outside of ideologues and those special interests who might benefit from austerity, and why the IMF and the Troika could have repeatedly gotten it so wrong in predicting its effects. In the immediate aftermath of the financial crisis, 3 economists championed the seemingly paradoxical notion of expansionary contractions. The Academy rewards counterintuitive analyses. They argued that there were important instances where, when governments had contracted government spending, the result was that the overall economy grew. The notion that there could be expansionary contractions was a chimera. A series of papers showed major flaws in their analysis. The IMF, which had supported austerity-style policies in the past, in fact reversed itself. It pointed out that when governments contract spending, the economy contracts. The big flaw in the pro-austerity study was confusing correlation with causation. There were a few countries, small economies with flexible exchange rates, where a contraction in government spending was associated with growth, but in these cases the hole in demand created by the government contraction was filled in with exports. Canada in the early 1990s was lucky because the United States was going through a rapid expansion, the recovery from the 1991 recession. Canada benefited, too, from a flexible exchange rate that enabled it to sell its goods more cheaply to the United States. There is a moral to the story. If you are in a recession and you want to recover, choose your neighbors carefully. If they are having a boom, you can use that to restart your economy. But for the European crisis countries in the aftermath of 2008, such contractionary expansions were not an option. Europe as a whole, the main trading partner of each of the crisis countries, was experiencing slow growth, if not a recession. Because each of the crisis countries was part of the Eurozone, none could lower its exchange rate, and because of the flawed policies of the ECB, the euro exchange rate with the rest of the world was actually very strong. In this context, austerity would produce what it usually does: a slowdown, if not a recession or depression. The fact that in a few instances austerity was associated with economic expansion only meant this. In these instances, but for the austerity, the expansion would have been stronger. In some cases, in spite of the expansion of trade, the economy remained below full employment. In such cases, austerity had worsened the level of unemployment. The austerity had not caused the reduction in the unemployment. An analogy might be useful. When Ronald Reagan became President of the United States, the government undertook two policies almost simultaneously: a large tax cut and very tight monetary policy. The economy went into the deepest economic downturn, the worst up to that point since the Great Depression. It would be wrong to infer that the tax cut caused the economic downturn. It simply made the economic downturn less bad than it otherwise would have been. Before the 2008 crisis, some argued that increased government spending did not increase GDP. The empirical work leading to this conclusion focused on years in which the economy was at or near full employment. When the economy is at or near full employment, there is no room for GDP to increase. Thus, an increase in government spending necessarily crowds out other forms for spending. But such analyses have no bearing in a post-crisis world experiencing massive unemployment. In the Eurozone, unemployment stands at 10.2% as this book goes to press. In fact, when there is already a high level of unemployment, there is a multiplier. That is, reductions in government spending can lead to reductions in GDP that are a multiple of the cutbacks. Another strand of academic work cited by austerity advocates focuses on the consequences of the debt that arises when government spending is financed by borrowing. Kenneth Rogoff and Carmen Reinhart argued that countries with debt-to-GDP ratios in excess of 80% would grow more slowly. Upon closer scrutiny, there were major spreadsheet and other technical mistakes in their work. More significantly, however, Rogoff and Reinhart failed to test whether growth was lower at higher debt ratios in a way that was statistically significant, and whether this was true always or only under certain conditions. Such a test would have helped to identify the different conditions under which an increase in debt might make a significant difference. There was a further statistical problem. They had failed to show causality, whether low growth had caused the deficits and debts, as was the case after 2008, or, as they claimed, the deficits or debts had caused low growth. By itself, the debt-to-GDP ratio does not tell us much about debt sustainability. The ratio may not even be a good measure of a country's resilience, its ability to withstand shocks, or its overall economic strength. As noted earlier, the United States had a debt-to-GDP ratio of 122% after World War II. In the succeeding decades, the country experienced its most rapid growth, this in spite of the fact that war spending does not provide the foundations for future growth as well as does other types of investment. A country that borrows to make productive investment in education, technology, or infrastructure enhances its future potential. For most countries, the returns on these public investments far exceed the cost of capital. Thus, such investments, even when debt-financed, strengthen the country's balance sheet and make it more capable of withstanding shocks. Explaining the magnitude of the downturn. Olivier Blanchard, when he was chief economist at the IMF, observed that the economic downturn in Greece was greater than could be accounted for by the amount of austerity that had been imposed. He was, of course, correct in the sense that Troika models had very badly estimated the effects of their policies. He was saying something more, though. Normal multipliers, which translate a change in government spending into a change in GDP, would have predicted a much smaller decline in GDP than had actually occurred. Yet, when the depth of the economic downturn was plotted against the level of austerity imposed, the Greek case did not appear unusual. Yes, the amount of austerity imposed on Greece was greater than that imposed on any other country, but given the magnitude of the austerity, the magnitude of the downturn was much as one would have expected. While there were many limitations in the standard models that help explain why they did so badly in predicting the magnitude of the multiplier, and why Blanchard and others were surprised at the depth of the downturns, the most significant were 1. The failure to analyze carefully the financial sector, and 2. The failure to analyze carefully the distributive consequences of the policies. The models typically had no banks. This was an especially curious omission, for if there were no banks, there would be no central bank. And how, then, could we have had the banking crisis of 2008? The focus in the standard models was on the money supply, not on credit. The euro crisis and the way it was managed, however, led, as we saw in Chapter 5, to a massive contraction of the supply of credit, especially to small and medium-sized enterprises, and this, private austerity, compounded the effects of the public austerity. Inequality and distribution. The standard models also ignored how increasing inequality affects macroeconomic performance. Indeed, some economists were positively hostile to even discussing the distribution of income. The crises and how they have been managed have had adverse effects on inequality. In Spain, as we observed earlier, inequality before the crisis had been going down. In the aftermath of the crisis, it increased. Inevitably, unemployment increases inequality both directly and indirectly, as wages fall and as government services upon which ordinary citizens depend decrease. Since those at the top spend a smaller percentage of their income than the rest, an increase in inequality lowers aggregate demand and thus economic performance. This is especially so when, as now, monetary policy is unable to stimulate the economy. In recent years, the IMF has stressed how inequality weakens growth. Thus, while the IMF had begun to recognize the importance of inequality for economic performance, and while its own research had provided convincing evidence that government cutbacks would lead to significant contraction, even its research department had failed to ascertain fully the effects of the austerity programs, because their models did not adequately incorporate the dramatic weakening of the financial sectors in the crisis countries and the increase in inequality, and had overestimated the growth in exports and underestimated the impact of the decrease in demand for non-traded goods. But the IMF was only one member of the Troika, and worse, the Troika programs did not seem to consider the possibility of these untoward effects being as large as they turned out to be, even as they were unfolding, and seemed reluctant to reconsider their programs, even as evidence mounted that they were not working in the way anticipated. Chapter 8. Structural Reforms that Further Compounded Failure. The Troika program imposed structural reforms on the crisis countries as a condition for providing assistance. Structural reforms simply refer to changes in the structure of the economy and in the individual markets within. For instance, labor markets and financial markets. All countries are constantly in need of structural reform and transformation as the economic situations that they confront change. After the financial crisis of 2008, there was a broad consensus that there was a need for deep structural reforms in financial markets throughout the advanced countries. In the crisis countries, the Troika demanded, as a condition for providing assistance, a melange of reforms, ranging from the trivial to the counterproductive, with little focus on the truly important. The most demanding reforms were those imposed on Greece, and they were remarkably ineffective, sometimes even destructive. There is an old adage about Nero fiddling while Rome burned. Greece was in a depression. Its people were starving. Surely there should have been a sense of urgency. Doctors triage at the hospital, first looking to the death-threatening problems, later attending to less important matters. But not only did the Troika fail to prioritize, many of the most important changes that should have been on the reform list were not. Blaming the supply side. The Troika has argued that the crisis is in no small measure the consequence of structural problems, and as such they had to be attended to right away. But structural problems don't suddenly arise. There were no changes in the structure of the afflicted countries that could account for their going from near full employment pre-crisis to massive unemployment after 2010. As we noted in Chapter 3, some of the crisis countries had, before the crisis, even grown faster than the average for Europe as a whole. Without any of these structural reforms, Greece grew at a faster rate, 3.9%, than the EU, 2.6%, from 1995 to 2007, until the global crisis, and so did Spain, 3.8%. The Troika might claim that, even if the structural problems didn't cause the crises, reforms would help the economies recover. It is not, however, structural impediments that are holding the crisis countries back. It is, as we have seen, the Eurozone itself. Because structural problems thus cannot be and are not the cause of the crisis, structural reforms within the individual countries cannot and will not be the cure. The Eurozone's leaders disingenuously pretended such reforms would make the citizens of the crisis countries better off. It is now obvious that they did not do that, and it should have been obvious at the time that the Troika imposed these demands that they would not. Some of the reforms seemed intended at increasing the likelihood that creditors would be repaid by reducing the current account deficit, what countries had to borrow, and converting the deficit into a surplus so that the country had the euros to repay. In the absence of flexible exchange rates, as we noted in Chapter 4, the only way to correct current account deficits is to have a real exchange adjustment, that is, to lower the prices of the goods that the country sells abroad. But as we shall see, some of the reforms seem as motivated by advancing the business interests within the dominant countries in the Eurozone as anything else. And ironically, the reforms as a whole, the combination of structural and macroeconomic reforms, turned out to be counterproductive, in particular, weakening Greece to the point where it could not pay back what was owed. The Troika's structural reforms, from the trivial to the counterproductive. As we have noted, the structural reforms were a grab bag, ranging from the trivial to the counterproductive. Focusing on the wrong thing. While some of the reforms might be justified as helping correct the unsustainable trade deficit of the individual crisis countries, many could not be. To correct the trade deficit, it should have been obvious that the Troika should have focused on tradable goods, exports and imports. Too often, however, the Troika did not do so. It did not even focus on non-traded inputs into the traded sector. Instead, much of its attention was centered on non-traded consumer goods, like taxicabs and bread. Lower prices in the non-traded sector, especially of certain consumer goods, may have affected the living standards of Greeks, though, as we shall see, even that might not be true, once one includes all the effects, including that on employment. But such changes only have a negligible effect on the current account. In some cases, the reforms may have even worsened the trade deficit. Trade deficits can be reduced by improving the real exchange rate, by lowering the price of the goods the country exports. There are 3 ways of doing this. 1. Lowering wages and hoping that the lower wages get translated into lower prices. 2. Lowering the cost of other inputs, in particular non-traded intermediate inputs, like electricity, by increasing competition in those sectors. Or 3. Improving technology and competition in traded goods. Technology. Improving technology is important, but typically cannot be done overnight, and the Troika policies probably set back the agenda. Firms in economies on the verge of collapse are thinking about survival, not about investing in R&D. And government investments in infrastructure, education, job training, or even technology, all of which might have increased productivity, had to be curtailed under the onslaught of austerity. All of these compounded the adverse effects of the Eurozone structure itself discussed in Chapter 5. The migration out of the crisis countries of some of their most talented young people hurt productivity not only in the short run, but also in the long, and the flow of capital out of the crisis countries meant that the cost of capital facing firms in these countries soared, if they could get finance at all, making productivity-enhancing investments even harder. And prohibitions against industrial policies by which lagging countries might hope to catch up to the more advanced partners in the Eurozone, made closing the technology gap all the more difficult. The trivial. When it came to promoting competition, the Troika mysteriously focused on non-traded consumer goods rather than on traded goods or non-traded that might possibly have had an effect on trade. But even then, their choice of what to focus on was most peculiar. No one has fully articulated how many of the seemingly trivial reforms struck the fancy of the Troika, how they entered the hit list. Here, I describe a few of the more controversial ones in the Greek program. Fresh milk. Somehow, if one believed that the worst problem facing Greece was the definition of fresh milk, Greece would really have been in good shape. Greeks enjoy their fresh milk produced locally and delivered quickly, but Dutch and other European milk producers would like to increase sales by having their milk, transported over long distances, appear to be as fresh as the local product. In 2014, the Troika forced Greece to drop the label fresh on its truly fresh milk and extend allowable shelf life. Under these conditions, large-scale producers elsewhere in Europe seem to believe they can trounce Greece's small-scale producers. In theory, Greek consumers would benefit from the lower prices, even though the lower prices might mean lower quality. In practice, the new retail market is far from competitive, and early indications are that the lower prices were largely not passed on to consumers. The size of a loaf of bread. Or consider another seemingly strange debate in the middle of a depression. The Troika demanded that Greece change its regulations concerning the size of bread loaves. In the past, loaves could only be sold in specified sizes: 0.5 kilo, 1 kilo, 1.5 kilos, and 2 kilos. There is a long-standing literature explaining how such standards actually increase competition because they facilitate comparison shopping. But the Troika wants stores to be able to sell any size loaf. Somehow they see this as a competitive restriction. I have never heard a good rationale for the Troika's position on this matter. But even if one couldn't defend Greece's previous regulations, it is preposterous that the Troika held an entire country hostage over things like this. Pharmacies. There are some restrictions on competition that the elimination of which, if done well and sold well, might have been beneficial. But again, the Troika botched it. A major complaint of the Troika concerned restrictions on drugstores, pharmacies. For instance, Greece required that each pharmacy be owned by a pharmacist and did not allow over-the-counter drugs to be sold outside of pharmacies. The Troika claimed that Greek regulations led to high drug prices. Again, it was somewhat mysterious why the Troika would get so exercised over this when there were so many more profound problems. Allegedly, the drugstore reform was intended to help consumers by increasing competition, thereby lowering prices. But why was the Troika suddenly so concerned about ordinary Greeks as they pushed policies that led real incomes to fall by a quarter and forced even very poor Greeks out into the streets? The sudden and seemingly isolated concern for the ordinary Greek citizen seemed out of sync with other aspects of what the Troika was doing. Nor would lower prices for over-the-counter drugs do anything for Greece's balance of payments. Perhaps doubts about the Troika's motives fed into resistance to the reform. The widespread perception in Greece is that many of the drugstores are mom-and-pop stores, owned by someone in their neighborhood, eking out a basic living, not living high off monopoly pricing. They saw the large number of pharmacies as evidence of competition and were befuddled by charges of lack of competition. Many Greeks felt some solidarity with their neighborhood pharmacy. They were willing to pay a slightly higher price and even to support the regulatory system which allowed that. They may have understood that allowing others to sell over-the-counter drugs might have lowered profits, that the reduced profitability of running a pharmacy might lead to fewer pharmacies, and thus to even higher prices for prescription drugs and less accessibility to medicines when they were needed. For people with this view, the Troika seemed to have another agenda, akin to that in the fresh milk case, opening up Greece to multinational chains and strengthening grocery stores, including chains, that could now sell these products, which might provide lower prices, but at the same time would be destroying the livelihood of thousands of Greeks. The Troika could have taken steps to reassure the Greek people that the true agenda behind pharmacy reform was simply to lower prices for consumers. The fact that the Troika failed to convince most Greeks of these aims showed the deep popular distrust about their motives. No one gave the Troika the benefit of the doubt. Contributing to the distrust was the fact that many of the regulations the Troika was so vehemently demanding that Greece change, such as on closing hours, were similar to those elsewhere in Europe, including Germany. When Germany's finance minister, Wolfgang Schäuble, was confronted with this fact, his response was, in effect, that Greece was in dire straits. It couldn't afford these inefficiencies. Germany could. But he never explained how more trading hours would lead to a smaller trade deficit or even a higher GDP. These were regulations affecting a non-traded sector, and so were irrelevant for its exports. Money not spent on Sunday will be spent some other time. There is no evidence that these restrictions have any effect on national savings rates. Making Greeks even more suspicious that the Troika had another agenda than just increasing the well-being of the Greek people was the fact that they failed to sustain an even more important reform, one that brought down drug prices even more. The e-government drug price initiative of Prime Minister George Papandreou, which would have resulted in lower prices by increasing market transparency, went by the wayside once he was forced from office. Weakening labor. The alternative to increasing competitiveness through improved productivity was lowering wages. I suspect that while many were horrified at the increased unemployment in the crisis countries, secretly many in the Troika thought of this as almost a necessary means to the long-run end of making the euro work. As we noted in Chapter 4, higher unemployment would lead to lower wages. Lower wages would lead to lower prices, and this process of internal devaluation would eventually restore equilibrium to the current account and bring the economy back to full employment. It was a very costly way of achieving what flexible exchange rates would have accomplished. Not satisfied with the huge decreases in labor costs, in the case of Greece, reductions of about 20%, that the market had brought about on its own, just through the high unemployment that the Troika policies had engendered, the Troika demanded reform to labor institutions, in the euphemism of the day, to create more flexible labor markets. In the reality of the day, the reforms would weaken workers' bargaining power, lower wages still further, and increase profits. The Troika even put into question their commitment to the basic right of collective bargaining, the core labor standards that have been agreed to by almost all of the countries around the world. The language in which European authorities shrouded their demands was often obscure, but the intention seemed clear. So clear that in 2011, one of Papandreou's loyalists, a bright and devoted economist, resigned from the government rather than be a party to this abnegation of basic workers' rights. Here is what the Troika demanded of the Tsipras government, to which it reluctantly agreed, with the interpretation of Yanis Varoufakis, Greece's former finance minister, in brackets. The Greek government agreed to undertake rigorous reviews and modernization of collective bargaining, brackets, i.e., to make sure that no collective bargaining is allowed, brackets. Industrial action, brackets, i.e., that must be banned, close brackets, and in line with the relevant EU directive and best practice, collective dismissals, brackets, i.e., that should be allowed at the employer's whim, close bracket, along the timetable and the approach agreed with the institutions, i.e., the Troika decides. Close brackets. On the basis of these reviews, labor market policies should be aligned with international and European best practices and should not involve a return to past policy settings which are not compatible with the goals of promoting sustainable and inclusive growth. Brackets, i.e., there should be no mechanisms that wage labor can use to extract better conditions from employers. Close brackets. But there was something strange as the Troika continued to make these demands on labor market reform on Greece. By 2015, the current account deficit had largely been eliminated. Indeed, according to the ECB, its competitiveness was above the average for the Eurozone. Any further cuts seemed punitive, and as we shall shortly explain, even counterproductive. Almost surely they would lead to even further decreases in GDP. The Troika policies highlight general principles. 1. The rules of the game. The terms under which unions can bargain matter, and they matter a lot. And 2. Who sets the rules matters, and can matter a lot. If the finance ministers are setting labor laws within any country, one will wind up with different labor laws than if labor ministers set the rules. No country should want the finance ministry to set its labor laws. Our democracies are designed to make sure that weight is given not just to the interests and perspectives of the financial markets, and thankfully so. And even more so, no country would want its labor laws to be written by the parliament of another country, let alone the finance ministry of another country. While, as we have noted, the government of the crisis country always accedes to the demands, they do so with effectively a gun at the head. The feared consequences of not doing so are simply too great not to accede. Counterproductive reforms. The Troika sold the reforms on the grounds that they would help the economy grow. Greece showed dramatically that they had the opposite effect. Some of the structural reforms, including those we discussed earlier in this chapter, had an even worse outcome. Local firms would be displaced by large European multinationals, in which case the reform would increase the profits of the multinational, lowering the income of those within the country. While consumers still benefited from the lower prices, this time there was another adverse effect. The transfer of profits from within the country to outside meant that spending on non-traded goods decreased, with a multiplier on national income and jobs. That is, income in the crisis country went down by a multiple of the profits that were effectively transferred abroad. Consumers who had jobs benefited slightly from the lower prices, but if, as to be expected, tax revenues fell alongside GDP, they were worse off as a result of the cutback in government services and systems of social protection. On net, many, especially in the lower rungs of society, were worse off. Some much worse off. Of course, those individuals who lost their jobs suffered enormously, twice over, both from the loss of their job and the decrease in public services. Many of the structural reforms demanded by the Troika could, especially in the aggregate, have an adverse effect, even narrowly, on the current account. If Greeks start buying Dutch milk, imports are increased and the trade balance worsens, and similarly for many other so-called structural reforms. Reforms that would have mattered. In each of the crisis countries, there are reforms that might have led to a stronger economy, both in the short run and the long. Industrial policies. Most advanced countries are in need of a structural transformation of their economy, from the sectors, mostly manufacturing, that were dominant in the past to those that will define the 21st century. Because the pace of productivity increase in manufacturing is greater than that of demand, global manufacturing employment will be decreasing, and because of globalization, the share of this global employment that will be captured by the advanced countries, including those in Europe, will be diminishing. A few countries, like Germany, may be able to maintain a niche, at least for a while, especially if they can manage to have an undervalued currency. Germany has benefited from being wedded to the weaker countries of the Eurozone, for the net effect is that the euro, the currency today, is weaker than, say, the German mark would have been. But most of the advanced countries will have to restructure themselves away from manufacturing toward new sectors, like the more dynamic service sectors. And even those that continue to have significant presence within manufacturing will have to restructure from low-skilled to high-skilled manufacturing. Markets, on their own, are not very good at restructuring themselves. The move from agriculture to industry in the late 19th and early 20th centuries was often traumatic. Those in the older sectors saw their incomes and wealth evaporate and had little access to capital markets. They couldn't make the investments required to shift from the old economy to the new. But much the same is true as the economy moves from manufacturing to the service sector, and especially as it moves toward an innovation and knowledge economy. Creating a learning economy is not easy, and the government needs to play a central role. At the center of America's knowledge economy are its first-rate higher educational institutions, many of which were established more than 100 years ago, some hundreds of years ago, and even they achieved much of their greatness as a result of migration from Europe around World War II, and with massive government support in the war and afterward for research. So, too, the culture and ecology of Silicon Valley, with its venture capital firms and close nexus between universities and enterprises, was created over a span of decades. Without a concerted government effort, those countries that are behind will remain behind. There is a range of government policies, called industrial policies, discussed briefly in Chapter 5, which have proven effective in pushing economic restructuring. In the case of the United States' move from agriculture to an industrial/manufacturing economy, the war effort itself was the industrial policy. It pulled people out of the rural sector to fight the war and to urban areas to make armaments required for the war. After the war, the government provided free higher education to all who had fought, which was essentially every young person, to ensure that they had the skills required for the new economy. In the last half-century, the U.S. government has once more played a central role with its major investments in technology. But, again, as we saw in Chapter 5, the kinds of industrial policies that have worked so well around the world are largely precluded within the Eurozone, and the austerity measures imposed by the Troika have forced a scaling back in public expenditures that might have facilitated such a structural transformation. Promoting equality. Markets on their own often produce excessively high levels of inequality, levels that are, or should be, socially unacceptable and actually undermine economic performance. Sometimes this is because governments do too little to offset the intergenerational transmission of advantage. Sometimes this is because governments do too little to offset the agglomerations of political and economic power that can be self-perpetuating. Economic inequality leads to political inequality, which leads to writing the rules of the market economy in ways that perpetuate and extend economic inequality in a vicious circle. Some of the crisis countries emerged from long periods of fascism with relatively high levels of inequality, and it would take a concerted effort on the part of the government to create a more inclusive society. But, again, many of the Troika policies lead to more inequality and a less inclusive economy. Before the crisis, Spain was one of the success stories in bringing down wage inequality. Since the crisis, inequality and poverty have been growing there as they have in the other crisis countries. In Greece, the Troika emphasized that the fiscal adjustment is fairly distributed across the society and protects the most vulnerable, and that the lowest income and lowest pension earners, as well as the most vulnerable and those requiring family support, will all be protected and compensated for the adverse impact of the adjustment policies. Yet, As we have seen, well-being indicators have all pointed downward since the adoption of the program that was so confidently predicted to restore growth. By the end of 2014, some 36% of Greeks were at risk of poverty or social exclusion. The rate is the highest in the Eurozone and some 10 percentage points higher than currency union's average. The proportion of Greeks below the poverty line, 50% of the median income, has also increased from 12.2% in 2009 to 15.8% in 2014. This may not sound so dramatic until you remember that median incomes also decreased significantly. Thus, the increase in the poverty rate shows the disproportionate burden of the Troika programs on those at the bottom. But the Troika not only did too little to help those at the bottom, they did too little to prevent the concentration of wealth and income at the top. There were alternative policies in which the burden of adjustment would have been more fairly shared, and in which the increase in poverty would have been smaller. Rebalancing power. In Greece and elsewhere, the Troika should have focused on the major concentrations of economic and political power and sources of economic rents, which in turn contribute so much to inequality. Instead, the important reforms that would curb the Greek oligarchs were largely left off the agenda. The Troika was quiescent as proposals were put forward to roll back initiatives of the Papandreou government on transparency and e-government, which would have dramatically lowered drug prices, put a damper on nepotism, and curbed the ability of banks to lend to media that they or their friends owned, money that distorted the political process. So, too, the Troika could have pushed for the progressive property tax aimed at the oligarchs that I discussed in the last chapter, rather than the tax they insisted upon, a non-progressive one that hurt so many who were already suffering so much. Such a comprehensive and progressive property tax would, of course, have been resisted by the oligarchs who own so much of Greece's wealth, and that makes it precisely the kind of issue on which the Troika should have weighed in. But, often, as one looked at the details of the Troika programs, one wondered what side the Troika was on. Was it just an accident, a slip, that they opted for a property tax that would have inflicted pain on ordinary Greeks, rather than one that would have hit the oligarchs? The Troika made token measures to seem as if they were equally tough on the rich, measures that they surely knew would be ineffective. For example, they insisted on the elimination of all preferences for the shipping industry. Greece's constitution provides favorable treatment for shipping, testimony both to the importance of the industry and to the political influence of the rich shipowners. But there are special problems in taxing shipping, and the Troika's insistence that shipping be taxed at normal rates seemed insensitive to these complexities, so it was virtually guaranteed to raise little revenue. If there were ever an industry that was movable, this was it. Shipping can easily relocate to a low-tax jurisdiction. The absence of international cooperation in taxation of corporations that operate across boundaries has, in fact, made tax avoidance a central part of the business model of every multinational. While the Troika has criticized tax avoidance in Greece, dominant countries in the Eurozone have been among those most adamant against changing the international framework for taxation in ways that would reduce tax avoidance. And the head of the European Commission, Jean-Claude Juncker, in his role as Premier of Luxembourg, perfected that country's role as a center for tax avoidance. While the tax on shipping that they are demanding, which is unlikely to raise much revenue but is likely to hurt Greece's GDP simply because much of it may move out of Greece to other jurisdictions, is being presented as an example of the Troika's strong anti-oligarch stance. What they are doing to small businesses in Greece is hard to fathom. They are forcing small businesses which can't move to pay a year's tax in advance. Reforming the financial sector. The fourth structural reform that the crisis countries needed was reform of the financial sector. Non-crisis countries needed such reforms themselves. The financial sector had failed before the crisis to perform the basic services that it is supposed to provide: allocating capital, providing funds to small and medium-sized enterprises, and managing risk. Rather than serving society, it had harmed society. Europe might take pride that such abuses were less than in the United States, that the financial sector hadn't taken so much from the rest. In the United States, they took close to 8% of GDP in the years before the crisis, as opposed to Europe, where the share remained under about 6% and given back so little. But it is not much to crow about. In Greece, for instance, the banks remained largely in the hands of the Greek oligarchs. These have continued in their practice of connected lending, lending to their other business interests and those of their friends and family. Particularly invidious was their lending to the media that they owned, which often lost money but enhanced their political influence. In doing so, they enriched and empowered themselves economically and politically. As it became clear during the crisis that the Greek banks would have to be recapitalized, it made sense to demand voting shares for the government. This was necessary to ensure that connected lending, including to the oligarchic media, be stopped. But when the Papandreou government proposed this, the Troika resisted. He nonetheless persisted, but when he left office, after the Troika adamantly opposed his initiative to put the program to a referendum, these efforts were undone. Rather than a restructuring, though, what happened was a weakening of the financial sector in the crisis countries. As we have noted, an almost inevitable consequence of the structure of the Eurozone itself. Had the Eurozone recognized this problem, they could have undertaken countervailing measures. They could have created a fund for lending to small and medium-sized enterprises, and at various times there were discussions about establishing such a fund. But the Troika undertook actions that weakened the banks in the crisis countries even further, as we have noted repeatedly. The shutdown of the Greek banks was the most obvious case of this, and by repeatedly discussing a haircut for depositors, they convinced those depositors to move their money out of the crisis country banks. In practice, this was not only a counterproductive policy, at least from the perspective of increasing GDP, but it was also an inequalitarian policy, for large corporations could easily heed the warning and move their money out. Small businesses and ordinary individuals that could not easily access banks abroad were left behind. Climate change. A fifth structural reform that is needed in the crisis countries, as it is needed everywhere in the world, is responding to the reality of climate change. Especially in the absence of a price for carbon, the market on its own won't do this. Before the crisis, several European countries had embarked on strategies to move toward renewable energy. Countries like Greece and Spain had the potential to produce solar and wind power that they could export to the rest of Europe. The private sector on its own won't make these investments, not now, without an adequate carbon price. Europe could have helped countries to restructure their energy sectors to be less dependent on fossil fuels, but that would have required spending that was beyond the budget envelope of these countries. It was investment spending that would have yielded high social and perhaps even private returns. Europe could have underwritten these investments, and in making these investments it would have stimulated economies, the opposite of the ineffective structural reforms on which the Troika focused. These investments also would have improved current accounts by lowering the cost of energy, increasing export competitiveness, and reducing the need for countries to import oil and gas. Concluding comments. In many ways, the programs imposed on Greece and the other crisis countries reminded me of the programs, marked by excessive austerity and a myriad of structural reforms, imposed on Indonesia and other emerging markets in crises in earlier decades. In the case of Indonesia, for instance, there were dozens and dozens of conditions, each with precise timelines. many seemed at first blush strange. Why, in the midst of a depression, where the unemployment rate in the main island of Java was reaching 40%, was the IMF discussing the clove monopoly? So, too, why in the midst of Greece's unemployment, with youth unemployment peaking above 60%, was the Troika talking about how old milk can still be called fresh, or how bread should be sold? In both cases, the conditions were, at best, not well explained, and this undermined confidence in the program and the political will to ensure that it was effectively implemented. Sometimes it turned out that the conditions reflected special interests who had successfully bent the ear of the authorities imposing the conditions. While there has been no disaster on par with the IMF's unforgivable destruction of Indonesia's private banking sector, the destruction of the Greek banking system was almost comparable. In 2011 alone, 17% of the deposits fled, and by the end of 2015, the assets of Greek banks were down nearly 30% from their 2010 peak. The flight was facilitated, of course, as we noted in Chapter 5, by the single market principle in the absence of a banking union, but it was aggravated by Troika policies. The Eurozone claims Spain is a success simply because growth has returned, even as youth unemployment remains high. It is not a success if one looks at the country's balance sheets, its investments in infrastructure and human capital, even its GDP, which in 2015 was still more than 2% below what it was in 2007, 8 years earlier. It is not a success if one assesses the human suffering. Similar stories can be told about the other crisis countries, even Ireland, which is held up as proof that the Troika programs can work and had strong growth in 2015, 7.8%, is not a success when measured by these broader gauges. GDP per capita, adjusted for inflation in 2015, was only 3.4% higher than in 2007, and this for the best-performing country. Even looking narrowly at the sustainability of their debt, all of the crisis countries have done poorly and are far worse off than they were before the crisis. From 2007 to 2015, Spain's gross debt-to-GDP ratio has increased from 36% to an estimated 99%. Greece's from 103% to 178%, and is expected to explode to over 200%. Cyprus's debt-to-GDP ratio has increased from 54% to 109%, and even the star performer, Ireland, has seen its debt-to-GDP ratio almost quadruple, from 24% to 95%. But the Eurozone programs have been a success, in the sense that the German and French banks have been repaid. Some may have even been saved from an early demise, and current account balance has been achieved, necessary if there is to be a transfer of resources from the crisis countries to those that they owe money. Perhaps the real goals of Germany and the other creditor countries have indeed been achieved. The need for growth. European leaders have recognized that Europe's problems will not be solved without growth, but they have failed to explain how growth can be achieved with austerity and with the ill-conceived and often counterproductive structural reform measures they have been pushing. Instead, they argue for restoring confidence and that the restoration of confidence will bring about a restoration of growth. However, because austerity has destroyed growth and lowered standards of living, it has also destroyed confidence, no matter how many speeches are given about the importance of confidence and growth. Confidence will only be restored when there are fundamental reforms in the structure of the Eurozone itself and in the policies that it has imposed on those partners in the Eurozone in crisis. But that, I suspect, will only happen when there is a greater sense of political cohesion and social solidarity than is evident today. Europe, and especially Germany, which has played a central role in the formulation of these policies, has a quite different take on these policies. Like medieval bloodletters, Germany and its associates in the Eurozone argue to stay the course. What is needed, they say, is more austerity and structural reform. This course will only bring a continuation of the current suffering. Things may improve, slightly, but by any standard, other than a comparison with the bottom of the downturn, Europe's performance has been dismal, and there is only more in store. Many in the crisis countries have survived only by drawing on their savings, some by selling the family silver, others by selling the family home, but it is a strategy of mere survival without hope. We presented in this and the previous chapter an alternative to what Europe has done, even within the confines of most of its current rules. Even within its strictures, there were policy choices that could have been made. Those that were made exacerbated the downturns, making them longer and deeper with far more suffering. These rules didn't dictate the speed with which fiscal balance had to be restored. Just as Greece has become the poster child for bad behavior by a Eurozone member, the Greek program has become the poster child for the mistakes of the Troika. The Eurozone rules didn't dictate that Greece would be instructed to go from its huge fiscal deficit to an unconscionably high 4.5% surplus in very few years. Nor did they dictate the harsh foreclosure policies, pushing an increasing fraction of Greece into poverty. So too for the structural reforms. As an alternative to the trivial, distracting, and counterproductive reforms pushed by the Troika, there were meaningful reforms that might have set Greece on the path toward shared prosperity. It would still not be as rich as Germany, but it would not be facing the abject poverty and depression it faces now. There is nothing in this alternative program that required a Nobel Prize to construct, nothing based on information not already available to the Eurozone authorities at the time they designed their programs. Rereading the successive memorandum of agreement between Greece and the Troika, one is bewildered. Their forecasts were consistently so wrong, but made with such conviction. In the first and succeeding memorandum, they would write, "The design of the program makes it robust to a number of unfavorable developments. The fiscal program is based on conservative assumptions. The fiscal adjustment is fairly distributed across the society and protects the most vulnerable. The recovery strategy takes into account the need for social justice and fairness, both across and within generations. The Greek program rests upon very strong foundations." Was it irrational optimism? A belief that things would really work out that way? Or bureaucrat hypocrisy? They knew what they were supposed to say, and the incongruence between the world and these words was of little moment. Call it cognitive dissonance run wild, or dishonesty, as you will. There is something in the last memorandum, signed soon after the Greek voters had rejected essentially the same program by an overwhelming vote of 61%, a vote supported by the Greek government, which provides more than a hint that it was sheer hypocrisy. The agreement begins by affirming, "Success requires ownership of the reform agenda program by the Greek authorities," and suggesting that there is that ownership. As I looked at these programs, I saw the same two forces that had constructed the failed IMF programs in so many of the countries around the world that I described in Globalization and Its Discontents. Corporate and financial interests in alignment with and supported by ideology. But this time it is playing out within the very borders of Europe. While the Troika could have crafted a program that worked, or at least one that failed less badly, the structure of the Eurozone itself made the tasks difficult at best. This, then, is the situation facing the Eurozone. They have constructed a monetary arrangement characterized by divergence rather than convergence, where crises are likely not to be rare occurrences, not once-in-a-lifetime events to be studied in history courses, but frequent events that have to be constantly dealt with. And the interests and ideology of the dominant powers have propagated policies that are extraordinarily painful for those within the crisis countries. The first crises were fomenting within the Euro's first decade. Even then, there was a mixture of causes, reflecting the Eurozone's diversity, associated with public sector profligacy in only one, Greece, but private sector misdeeds and misallocations in others, and bad luck, with economic fortunes turning against them in still others. While some in Northern Europe like to blame the problems of those in the South, Ireland and Finland are reminders that culture and geography are not the driving forces. Finland, with one of its leading firms, Nokia, facing problems, and with a recession in its neighboring country, Russia, is expected to have a GDP per capita in 2017 that is less than 93% of that a decade earlier. The Eurozone system does not even work for the hardworking, well-educated, highly disciplined Finns. And since the countries of Europe are all tied together, even the well-performing economies will be dragged down. The double-dip recessions are no surprise. It is not a pretty picture, and of this we can be sure. The reforms made since the beginning of the euro crisis do not suffice. Some, in the half-finished state that they are likely to remain for years, may make matters worse. The counterfactual. Even defenders of the Eurozone's austerity and misconceived structural reform policies have to admit that things have not gone as had been anticipated. In the discussions prior to the euro, it was thought there was a trade-off. A single currency would bring higher growth, for instance by lowering interest rates because of the reduction of exchange rate risk, but there would be slower adjustment to a disturbance. Chapter 3 showed that for the Eurozone as a whole, there was no burst of growth after the launch of the euro, but that after the crisis, performance was dismal. The evidence suggests that the benefits were nil, but the costs, as the crisis was managed, were palpable. Still, some ask, wouldn't things have been even worse for Greece and the other crisis countries were it not for the euro and the help that these countries got from their Eurozone partners? Economists refer to such matters as counterfactual history. We know what has happened. We can only speculate about what might have been. Of course, in the years preceding the creation of the euro, not everything had gone smoothly. There was exchange rate volatility. Some countries faced bouts of high inflation. Post-fascist Spain had had high unemployment. Many were buffeted by the same global forces that led to episodic recessions. Still, none suffered as they have suffered in the euro crisis. Take Greece, the poster child for what has gone wrong. Looking at the IMF database since 1980, the last 35 years, its deepest downturns prior to the euro were in 1981 to 1983, when the economy shrank almost 4%, and 1987 and 1993, when it shrank by 2.3 and 1.6%, respectively. But in the euro crisis, in a single year, the economy shrank by 8.9%, 2011, and that was followed by year after year of continued contraction. Greece had had bouts of unemployment. It reached 12.1% in 1999, but that was less than half of its peak above 27% in 2013. The cost-benefit ratio as the euro has been managed for the crisis countries is clear. Slight benefits during the short span of time between the establishment of the euro and the 2008 crisis as they benefited from the flood of money coming in, creating the imbalances from which they would subsequently suffer so much, but far outweighed by the costs in the years after the crisis. Had they known back in 1992, when they signed up for the euro, what they know now, And had the people of Europe been given a chance to vote on joining the euro, it is hard to see how they could have supported it. But that is a different question from that confronting Europe today. That question is, having created the euro, where do they go from here? The next 4 chapters describe what has to be done. Part 4. A Way Forward. Chapter 9. Creating a Eurozone that Works. The euro can and should be saved, but not at any cost. Not at the costs of the recessions and depressions that have afflicted the Eurozone, the high unemployment, the ruined lives, the destroyed aspirations. It doesn't have to be this way. One can create a Eurozone that works, that promotes prosperity and advances the cause of European integration. The halfway house in which Europe finds itself is unsustainable. There either has to be more Europe or less. There has to be either more economic and political integration or a dissolution of the Eurozone in its current form. Those who originally promoted the euro realized that in its original stage it was incomplete and that more would have to be done. A successful euro required and would lead to more Europe. And more has been done. But what has been done so far is not nearly enough. What is required is not beyond the grasp of Europe. Most of what is entailed has already been widely recognized, but it requires more Europe than the existing arrangement, and certainly more Europe than those who say that the Eurozone is not a transfer union are willing to countenance. The reforms in structure and policy that I describe will make the kinds of crises that have become a regular feature of the Eurozone less frequent and less severe. But there still may be crises. I argue that a quite different set of emergency policies would be of benefit to the Eurozone as a whole, but especially to the crisis countries. The depressions that have marked the euro crisis, with their long-lasting effects, are avoidable. Reforming the structure of the Eurozone. Reforms of the structure of the Eurozone itself should aim at an economic system that can simultaneously achieve full employment and robust growth in each of the member countries with sustainable current account deficits in the absence of flexible exchange rates and independent monetary policies. There needs to be a fundamental commitment of the Eurozone to maintain the economies at full employment. Markets do not, on their own, maintain full employment, and markets on their own are not, in general, stable. In the absence of government intervention, there can be persistent unemployment and high instability. Most critics of the euro crisis policies have focused on austerity, and rightly so. But without appropriate reforms in the structure of the Eurozone, the institutions, rules, and regulations that govern it, restoring the countries to full employment will lead to unmanageable current account deficits. We saw how the Eurozone's current structure leads to divergence and actually creates current account deficits and crises. The Eurozone needs to be reformed so that all countries within the Eurozone can attain and maintain full employment. The current Eurozone structure does not allow this. As we saw in the previous chapter, while the programs that have been imposed on the crisis countries are intended to eventually lead the country back to full employment, the path is extraordinarily costly with uncertain success. What is certain is that these programs will lower the crisis country's potential growth for years to come. It is also certain that these programs have other effects, such as increasing divisiveness within and between countries and giving rise to unpalatable political dynamics. 6 structural changes. Changes in the basic rules governing the Eurozone and their shared economic frameworks are essential. Structural reform number 1. A banking union. This reform is one on which the European leaders already agree. A common banking system, a banking union, entails more than common supervision. It entails common deposit insurance and common procedures for what should be done with banks that cannot meet their obligations, called common resolution. Of these 3, the most important is a common deposit insurance fund. Without it, money will flow from the banking system of weak countries to the banks in strong countries, weakening further those already having problems. But without a common regulatory system, there is the worry that a system with a common deposit insurance scheme could be open to abuse. But, as I explain below, a common regulatory system has to be well designed so that it can encourage expansion in those countries that need it and constrain lending in overheated economies. Later, we will explain how this can be done. Without such flexibility, broadening mandates and instruments, a common regulatory framework will act as an automatic destabilizer. That is, when the economy is weak, it makes the economy even weaker. Indeed, Chapter 5 showed that under the current system, the private austerity arising from the contraction of bank lending was a key contributor to the depressions in the crisis countries. But inflexible implementation of banking regulations would exacerbate the already present downturn. In any economic downturn, there is an increase in non-performing loans, defaults. If regulators respond rigidly, banks will be forced to contract lending, and that will exacerbate the economic downturn. While rigid enforcement of standards makes sense for a bank in isolation, when weaknesses are a reflection of an economic downturn, it's counterproductive. The economic slowdown arising from decreased lending will lead to even more defaults, in a downward vicious spiral. The incongruence between the pace of markets and that of politics presents a problem for the euro's survival. Many European leaders recognize that eventually a single banking framework, with common regulations, deposit insurance, and resolution, will be necessary. But others argue that such a dramatic reform must be done carefully in a step-by-step process. First, there must be common regulations, and when the regulatory system has been proven, Europe can go on to the next stages. Were there not an ongoing crisis, such an argument would have merit, but those with capital in, say, the Spanish banks will not wait. The benefits of waiting are nil, the risks are substantial. And so, while European leaders dither, the banking system will be weakened, and with the weakening of the banking system, there will be a weakening of the economies. And there can be strong effects. Once the capital has left the country, once the banking system has been weakened, it may take a long time to restore the banking system and the country to health. Structural reform number 2. Mutualization of debt. Just as creating a banking union is necessary if there is not to be divergent and destabilizing movements in capital, some form of mutualization of debt is necessary if there is not to be divergent movements in labor. Place-based debt makes little sense in a world in which individuals are mobile. Individuals can simply walk away from debts incurred by their parents or by profligate politicians or by misguided decisions of the ECB. The movements in population are not only destabilizing, they are inefficient, undermining the very rationale for free mobility of labor. Mutualization of debt could be accomplished through a number of institutional mechanisms, such as having the ECB issue a Eurobond, underwritten by the Eurozone as a whole, with the revenues on lent to different Eurozone countries. There are already proposals on how to design such a system in a way that won't lead to excessive borrowing. The amount of mutualized debt could be limited, with safety valves for debt associated with cyclical fluctuations, recognizing that when a country goes into a recession, it may be desirable to run a large deficit. The funds coming in from the new debt issues could be spent only on investments in, for example, infrastructure or education. There could be a requirement, too, that, except when the economy is in recession, any increase in debt over a certain level be subject to a referendum within the country. The position of some in Europe against such mutualization, claiming that Europe is not a transfer union, is wrong on 2 counts. 1. It exaggerates the risk of default, at least the risks of default if debt is mutualized. At low interest rates, most of the crisis countries should have no trouble servicing their debts. Of course, in the absence of debt mutualization, there is a serious risk of partial default, which has already happened in the case of Greece. The irony is that existing arrangements may actually lead to larger losses on the part of creditor countries than a system of well-designed mutualization. 2. Any system of successful economic integration must involve some assistance from the stronger countries to the weaker. Recognizing this, Europe itself has provided substantial funds to new entrants. These are called the Structural Funds and Cohesion Fund and include multiple programs. One program, the European Regional Development Fund, provides €40.2 billion to Poland, the top recipient, from 2014 to 2020. The reforms just described are key to preventing divergence. Later in this chapter, I will describe further structural and policy reforms designed to promote convergence. Structural reform number 3. A common framework for stability. Europe faces two further paramount questions. 1. How to promote stability of the Eurozone as a whole, and 2. How to ensure that all of the countries of the Eurozone do well. As we have noted, for instance, the Maastricht restrictions on fiscal deficits can effectively be an automatic destabilizer. As tax revenues plummet, when the 3% deficit target is breached, there have to be cutbacks in expenditures, which lead to further declines in GDP. The current automatic destabilizers need to be replaced by automatic stabilizers at the Eurozone level. We'll shortly provide examples. Even with reforms that enabled the Eurozone as a whole to have stable output and employment on average, there will remain significant differences among countries. Some will be in recession, while others are in a boom. With the exchange rate and interest rate no longer in the toolkit, other tools will have to be found to ensure that each of the countries in the Eurozone remains prosperous. There are 6 parts of a stability reform agenda. The first involves a fundamental reform of the Maastricht convergence criteria. Second, a new growth pact supported by a European Solidarity Fund for stabilization, akin to earlier European Solidarity Funds provided for new entrants into the EU that we mentioned above. Third, a commitment to progressive automatic stabilizers that increase spending automatically when the country faces a downturn, and a corresponding ban on automatic destabilizers. Fourth, enhancing the flexibility with which monetary policy can respond to in an economic slowdown within any country. Fifth, in recognition of the fact that markets on their own may create instability, instituting regulations that try to control market-generated instability. And sixth, more active counter-cyclical fiscal policies, reducing the burden that has been imposed on monetary policies in recent years. 1. A common fiscal framework. Beyond a suicide pact. If the Eurozone is to work, that is, if it is to provide a framework within which countries can prosper and countries can persistently attain full employment, the first necessary reform is a common fiscal framework. This reform will require more than, and fundamentally differs from, an austerity pact or even a strengthened version of the Stability and Growth Pact, the reform that Germany seems to have had in mind, as it calls for stricter enforcement of more stringent budgetary rules. The Germans have emphasized the need for all the countries of Europe to follow the rules, and in particular the budgetary constraints, the 3% limit on deficits. They worry that without such rules, strongly enforced, there will be economic chaos. The Eurozone will be able to function. Germany's stance is predicted on the belief that profligate government spending leads to crises, and that it led to the current Eurozone crisis. That is simply wrong. Better budget rules. One can still have fiscal discipline by focusing on the structural deficit, what the deficit would be if the economy were at full employment. Many of the crisis countries' deficits would appear in a markedly different light when looked at from this perspective. The most important reform, however, involves creating a capital budget, distinguishing between government spending on consumption from that on investment, with constraints on spending centered on consumption. A government should behave not like the Swabian housewife, but like the modern firm, which looks at its balance sheet and undertakes debt if the returns on the investments that it finances exceed the cost of capital. 2. A solidarity fund for stabilization. Addressing the underlying problems of Europe is at its core a collective action problem for Europe, requiring European-wide resources, more resources than are currently available to the afflicted countries. A year after the beginning of the Greek crisis, it was already apparent that the austerity measures imposed at the very beginning were not helping the economy recover. The leaders of Europe had committed themselves to helping Greece grow. They obviously didn't do that, and one of the reasons is that they lacked the tools. They had set aside funds to help rescue banks and countries that were in trouble in the European Stability Mechanism, but it was focused on the moment of crisis itself, when a bank was collapsing or a country was shut out of capital markets. Even for the crisis countries that have done everything that they were told to do, the return to prosperity has been slow. What is needed is enough funding to help countries facing adverse shocks to maintain full employment and grow again. This means, for instance, common funding for unemployment insurance, especially the abnormal expenditures associated with a deep downturn. The Solidarity Fund for Stabilization could be used to fund unemployment and other cyclically related social expenditures, and to support active labor market policies that help move people into new jobs in a restructured economy. Even with a successful banking union and common deposit insurance, banks in crisis countries are likely to be weak. The contraction in bank lending is particularly hard on small and medium-sized enterprises, which depend on banks for finance. As they are cut off from funding, they have to lay off workers, reinforcing the downward cycle. What is thus needed is a European-wide small and medium-sized lending facility, like the United States Small Business Administration, which provides loans and/or partial guarantees for small business loans, and it should target its lending particularly to countries or regions within a country where there is a shortage of SME lending and/or the economy is showing particular weakness. Expanding existing European institutions. Some of the existing European institutions could make a contribution to stability, especially if this was seen as part of their mandate. The European Investment Bank is the largest multilateral lending institution, a European-wide institution that has successfully financed infrastructure projects around the region. While it already sees itself as having a counter-cyclical role, that aspect of its mission could clearly be greatly strengthened. Mutual insurance. I have described a variety of forms of support that Europe as a whole could provide to countries with significant economic downturns. One country might be the recipient at one time, but be among the large contributors at another. A quick look at the history of rankings and growth rates in Europe demonstrates the large variability in standings. We have already noted that many of the crisis countries grew faster in the years before the crisis than the Eurozone grew as a whole. So, too, for others. For example, from 1995 to 2000, not only did Ireland, Spain, and Greece grow much faster than Germany, with growth rates of 10.1%, 4.1%, and 3.6%, respectively, but so did France, 2.9%, and Italy, 2.0%. Germany grew at a rate of just 1.9%. Among those countries, Germany also placed second to last from 2000 to 2005, when it averaged 0.5%. 3. Automatic stabilizers. The third part of a fiscal pact for stability focuses on creating automatic stabilizers so that when the economy faces a downturn, money is injected into the system automatically. Unemployment insurance is an example. Normally, as workers lose their jobs from a negative shock, for example, a decrease in the demand for exports, they cut back their spending so that the effects get multiplied. But if workers are protected with unemployment insurance, this multiplier is short-circuited. In countries with flexible exchange rates, the exchange rate can act as an automatic stabilizer. A country facing a problem will see its exchange rate decline, and that will encourage exports and discourage imports, increasing national income. But in joining the euro, Countries gave up this automatic stabilizer, making it all the more important to strengthen other automatic stabilizers, like progressive taxation and good unemployment schemes and other forms of social insurance. Unfortunately, in recent years, these automatic stabilizers have been weakened. Indeed, the worry is that automatic amplifiers, destabilizers, have been or are being put in place. In particular, earlier, we noted that stringent enforcement of capital adequacy standards for banks would act as an automatic destabilizer, and even more so in the absence of a common deposit insurance system. These are among the reasons that Europe's current approach to creating a banking union, first having common regulation and supervision, and then, gradually, perhaps, common deposit insurance, is unlikely to work for the foreseeable future. 4. Flexibility in credit creation. Previous chapters have described how the existing Eurozone acts as an automatic destabilizer in so many ways. One of the worst is through credit. The current design leads to large pro-cyclical movements in credit, especially to small and medium-sized enterprises. That is, credit declines when the country goes into trouble, increasing the depth of the downturn. Some such changes are natural. Firms in a slowing economy will need less money to expand. But the problem in the Eurozone is that those small businesses that do want to expand, they may have customers abroad, for instance, can't get the finance they need. Some can't even get the working capital they need to function. Lack of finance is part of the process of strangulation of the economy. Chapter 5 noted that the failure to account adequately for the resulting private austerity may help explain why Troika predictions have so consistently been off the mark. If there is to be stability in the Eurozone, this has to be reversed. The Eurozone took away two forms of flexibility, in the exchange rate and in the interest rate. But while it is inevitable that the ECB set a single interest rate for the Eurozone as a whole, there doesn't have to be the same rigidity in the application of regulatory standards, especially when it comes to macro-prudential regulations. That is, regulations aimed at stabilizing the overall economy. There needs to be not just a broad mandate to focus on employment growth and stability, but also more flexibility in the way that the Eurozone's banking system is run. Capital requirements, the amount of capital banks have to hold in relationship to their lending, can be tightened in those countries, regions, facing excess demand. This would force a reduction in lending, which in turn would dampen inflationary pressures there. Similarly, capital requirements could be loosened in those countries facing weak demand. This will strengthen lending, stimulating the economies that need it. There are a host of other regulatory provisions that can be adjusted according to the macroeconomic circumstances of the particular country or region. As another example, lending standards for mortgages should, for instance, be tightened at a place or time where there appears to be the risk of a bubble forming. The key is that there needs to be more flexibility in the way that the Eurozone's banking system is run. One of the major lessons of the 2008 crisis was that earlier notions of monetary policy were misconceived. They were not only excessively narrow in the mandates that they imposed on central banks, but also in the instruments that they provided, suggesting, for instance, that the only instrument should be the short-term interest rate, and even when the need for more tools was recognized, the need for flexibility in their use was not. A key reform for creating a viable euro is creating an ECB and European financial regulatory authorities with broader mandates and more instruments that are more flexibly managed. 5. Regulating the economy to prevent excesses. As we've seen, in several Eurozone countries, recent downturns have been a result of real estate bubbles breaking. These bubbles were the result of private sector failures, of a kind that have repeatedly occurred. Excessive credit expansion and excessive risk-taking is frequently the source of economic volatility. Financial markets on their own are simply not stable. In other words, an important part of preventing recessions and depressions is to prevent the excesses that give rise to them. Successful control of this excessive expansion needs to be a joint undertaking of the ECB, banking regulators and supervisors, and the broader regulators of the financial system. This won't be possible in the regime of light or self-regulation that prevailed prior to 2008. It won't be possible either if the ECB only focuses on inflation as conventionally defined. There are tools that the ECB and financial regulators already have or should have that can prevent or at least control the size of these bubbles. 6. Stabilizing fiscal policies. While the proximate cause of so much of the economic volatility that has afflicted market economies is the excesses of the financial sector, in some cases, central banks condone, if not instigate, this bad behavior. After the tech bubble broke in the early 2000s in the United States, aggregate demand slumped. Politics seemingly did not allow the construction of an effective fiscal surplus, putting the burden on monetary policy, and the United States resorted to the favorite instrument, lowering interest rates. The Bush administration was enthralled with deregulation, and the combination of low interest rates and deregulation was a toxic cocktail. Ben Bernanke and Alan Greenspan, both former chairs of the Federal Reserve, may have been pleased at the scorecard by which central bank governors are usually judged. Inflation was low, largely the result of China's low and competitive prices along with its exchange rate policy of stable and slow appreciation, and the economy was near full employment. But if one dug deeper, it was obvious that they had turned a blind eye to the excesses that were building up. The same can be said for William Frederick Wim Duesenberg and Jean-Claude Trichet, the first two governors of the ECB, during whose terms the imbalances that created the euro crisis occurred. One cannot simply leave the burden of macro adjustment on monetary policy, regardless of how much faith the neoliberals have in this instrument, if it is used correctly, to stabilize inflation. Fiscal policy, directed at needed investments, needs to be put more in the center of macro stabilization. The United States and the EU both need large amounts of investment for retrofitting their economies for global warming. Both need large investments in education and technology if there are going to be continuing increases in standards of living. Reduced investments in basic research, as a percentage of GDP, may well result in a slower pace of innovation in the future. Recently, Robert Gordon has suggested that we are moving into an era of much slower pace of increase in standards of living, but this is at least in part a consequence of decisions being made on both sides of the Atlantic to invest less in basic research, technology, and education. It is from these that future increases in standards of living will largely come. This runs counter, of course, to conservative ideology focused on downsizing the government. Thus, on both sides of the Atlantic, in some countries, the downturn has been met by cutting taxes for corporations and rich individuals, matched by cutbacks in government spending. This book has explained why these policies predictably led to lower output today, but when the cutbacks are in critical public investments, they also lead to lower output in the future. The key point is that if fiscal authorities are doing their job well, there will be less pressure on the monetary authorities to create, or at least tolerate, the excesses of which they have so often been a part. Structural reform number 4, a true convergence policy toward structural realignment. The absence of the exchange rate mechanism in Europe means that real exchange rates can get out of alignment as a result of differences in the rates of growth or productivity or prices across countries. This kind of misalignment occurred in the years before the crisis, partly caused by the euro. There are 3 parts of the strategy to respond, each reflecting part of the analysis of the underlying causes of the misalignment. 1. Discouraging surpluses. Generally, one would expect the exchange rate of the Eurozone as a whole to be such that it achieves current account balance for the region as a whole. Any country or region maintaining large current account surpluses or deficits poses a risk for the entire global economic system, That is why the IMF and the international community have continually talked about global imbalances and tried to get countries not to have them. Surpluses pose a risk because for every surplus there must be a deficit. That is, if some country exports more than it imports, some other country has to import more than it exports, and deficits have to be financed. There can be a sudden stop, in which those supplying such finance suddenly take the view that there is a significant risk that the loan will not be repaid and refuse to provide further finance or even to roll over existing loans. These sudden stops are a major source of crises. But if the Eurozone as a whole typically has a zero balance, that means if some country runs its economic policy in ways that result in a surplus, necessarily other countries have to have a deficit. The surplus country, in a sense, creates, through its actions, deficits elsewhere. The surplus countries impose costs on others, an externality, through, in effect, the creation of their deficits. Those trade deficits create, in turn, a risk of instability. For instance, the sudden changes in market moods can result in an abrupt stop in the flow of funds to finance these deficits, setting off a crisis. Even short of a crisis, trade deficits make it more difficult for the deficit countries to achieve full employment because trade deficits subtract from domestic aggregate demand. On net, some of the demand is being met not by production at home but by imports, and weak domestic aggregate demand leads to unemployment. To offset the effects of weak aggregate demand, governments in the post-Keynesian world typically resort to government deficit spending. Thus, the surplus countries, Germany in particular, can even be thought of as being a fundamental cause of the fiscal and trade deficits and the unsustainable credit expansion in other countries of the Eurozone. One can see this in another way. Follow the money. A current account surplus means that a country has to be lending, just as a deficit means that a country has to be borrowing. If the current account of the Eurozone as a whole is balanced, it means that the surplus countries, mainly Germany, are in effect lending to the deficit countries. If Germany had a surplus and the Eurozone as a whole was balanced, it was necessary that the other countries were borrowing. In some cases, it was the public sector that was borrowing, in others, the private. But their deficits were just part of the equilibrium that followed from Germany's surplus. It was, of course, only a temporary and unstable equilibrium. I have described how Germany's surpluses thus almost inevitably led to divergence among the countries of the Eurozone. This had political as well as economic consequences. It was recognized early on that differences in countries would result in, say, different monetary policies being appropriate for each. That was part of the rationale for policies to promote convergence. Differences in circumstances can also lead to large political differences. Differences in economic circumstances led to differences in interests. As we noted earlier, no difference is more important than that between a creditor and debtor, and Germany's persistent surpluses converted the basis of the Eurozone from solidarity to the conflicting relationship of creditor and debtor. Europe needs a true convergence policy, and such a policy needs to discourage surpluses. Keynes proposed a solution, a tax on surpluses. This tax would not only discourage countries from having a surplus, but the revenues from the tax could be used to help fund the Solidarity Fund for Stabilization, outlined earlier in this chapter. 2. Expansionary wage and fiscal policies in surplus countries. There are many policies that the surplus countries undertake that lead to the surpluses. In the case of China, for a long time, two policies played a central role. It managed its exchange rate and it controlled wages, for instance by restricting the scope for unionization. Low wages in turn lead to lower prices and thus a lower real exchange rate. The first tool is, of course, not available to Germany, but the second has been key. In advanced countries, there are a variety of tools for affecting wages, most importantly minimum wages and the legal framework affecting unionization and bargaining. Until recently, Germany did not have a minimum wage, and the absence of the minimum wage puts downward pressure on wages more generally. Under Chancellor Gerhard Schroeder, incomes at the bottom actually fell. While this drop was lauded as making Germany more competitive, These actions are an invidious form of competitive devaluation and beggar thy neighbor policy. They gave Germany an advantage over its neighbors because the social and economic structure of these countries would not tolerate similar inequitable wage reductions. Thus, the lowering of Germany's real exchange rate came in part at the expense of its trading partners. Moreover, the current adjustment framework puts the burden of the adjustment on the deficit country through what I described earlier as internal devaluation. It is a very costly and very asymmetric adjustment process. It is, however, typically far easier for the surplus country to take actions to reduce its surplus than for the deficit countries to reduce their deficits. In the end, the global imbalance may be eliminated through either route, but the costs of achieving the eventual balance can be markedly different. Not only should surplus countries raise their minimum wages, they should strengthen workers' bargaining rights and engage in expansionary fiscal policies. They have easy access to funding for such expansionary policies. These policies will put some upward pressure on prices, though far from runaway inflation, and that's exactly the point. There has to be an adjustment of the real exchange rate, and these policies achieve that at far lower cost than those of the current Eurozone framework. 3. Reversing the other divergence policies. In Chapter 5, I described several other policies that either create divergence or prevent convergence. For instance, Europe's strictures against industrial policies, which might enable the countries that are behind to catch up. Rich countries have an advantage over poor ones in many ways. They can, for instance, provide a higher quality education to their children. Europe can't correct for all these differences, though, in the future, with greater solidarity, it can do a far better job. But there are some differences that Europe can and should address now, including differences in the quality of infrastructure. Good infrastructure, partially financed through the European Investment Bank, can help integrate Europe further. Public infrastructure increases the returns to the private sector, and thus can have both supply-side and demand multiplier effects. Structural reform number 5. A Eurozone structure that promotes full employment and growth for all of Europe. Macroeconomics. Even if the Eurozone were to manage all of these reforms, and if the countries within it were finally to converge, or at least move closer together, full employment or high growth would not be guaranteed. Europe could have a stable economy beset by low growth and high unemployment. Indeed, that is the direction in which Europe seems to have been moving. It feels self-satisfied if it manages to prevent another crisis, even if a quarter of its young people are unemployed, and even if growth is mediocre at best. There are reforms in both the macroeconomic framework of the Eurozone and in the Eurozone structure itself that would facilitate full employment with sustainable growth. The key macroeconomic reform is changing the mandate of the ECB. In the implementation of an expanded mandate to promote full employment, growth, and economic stability, and not just be fixated on inflation, the ECB should have a particular responsibility to make sure that the financial sector is working in the way it should, not only not exposing the economy to huge risks, not only not exploiting the rest of the economy, but actually serving society through the provision of credit for productive purposes, such as lending to small and medium-sized enterprises. The ECB, like the Fed, has greatly expanded liquidity, yet little of that has gone to create new jobs or make new real investments. Much of it has gone to finance investments in fixed assets like land, providing no stimulus to the economy. Other lending has simply been part of a round robin in which the central bank transfers money to the banks, which then hold money, reserves, in the central bank. Someone from the outside looking at this whole process would be as mystified by it, just as someone would when looking at the mining sector, where large amounts of money and resources are spent digging up gold, with considerable risk to the environment that is then, at great expense, buried back into the ground in vaults. Structural reform number 6. structural reforms of the Eurozone to ensure full employment and growth for all of Europe. Here, I discuss 4 common structural reforms that can help ensure sustainable growth with full employment. Many of these reforms entail moving away from the policy framework of the past third of a century, during which neoliberalism dominated, and it was presumed that the freer the market, the better, and recognizing the critical ways in which markets often fail to produce efficient and stable outcomes. 1. Making the financial system serve society. Most of the discussion of financial sector reform, including that above under Reform Number 2, has focused on preventing the financial sector from imposing harm on others. For instance, through the instability it has brought to the entire economy as a result of its excessive risk-taking. Little has focused on ensuring that the financial system actually performs the important functions that must be performed if the economy is to function well. It is precisely this failure that is behind the alleged savings glut. Ben Bernanke attempted to blame the weakness in the global economy before the crisis on excessive global savings, especially in China. But even as he spoke about the savings glut, many firms and countries had high-return investment projects that were not being financed. It is not that there is a surfeit of savings. It is that the financial markets have failed in their basic task of recycling the savings, making sure that the savings are used productively. This function is referred to as intermediation, intermediating between savings and investment. Financial systems in both Europe and America have failed to perform this key role well. Indeed, in the United States, the financial sector has been engaged in disintermediation, taking money out of the corporate sector, resulting in fewer funds available for investment. Huge amounts, for instance, are leaving firms in the form of share buybacks. In 2014, some 4% of GDP, and in 2015, 3.5%. Moreover, much of the savings is being done by long-term savers, those saving for their retirement or money put aside by countries in their sovereign wealth funds. Many of the key investment opportunities, infrastructure and technology, are long-term investments. It is perhaps not a surprise that short-sighted financial markets are unable to intermediate well between long-term savers and long-term investments. There are reforms in the legal, regulatory, and tax frameworks of Europe that would help focus the financial sector on the long term and on doing what it should do and not doing what it shouldn't. 2. Reforming corporate governance. Firms, too, have become increasingly short-sighted, focusing on quarterly returns. A firm focused on the next quarter won't make important long-term investments in research and technology, in plant and equipment, and, most importantly, in its employees. A firm that pays its CEOs and other executives excessively and distributes too much to its shareholders through dividends and share buybacks won't have enough money left over either to pay its workers decently or to invest in the future. While these changes have been less extreme in Europe than in the United States, the differences are narrowing. Europe has to understand what led to America's short-termism and to make sure that it takes action to ensure that the disease of short-termism doesn't spread more to Europe. It is perhaps not a surprise, given the importance of financial markets on both sides of the Atlantic, that the short-term myopia of the financial markets has spread to the rest of the economy. Some of Europe's institutions, like social partners, stakeholder capitalism, where firms are not exclusively focused on the well-being of shareholders, narrowly defined, have successfully proven a bulwark against the extremes found in the United States, where CEO pay has now risen to be 300 times that of the typical worker. There are, however, other factors that have contributed to rampant short-termism. For instance, the growth of stock options within the compensation packages of executives. While corporate executives claim that they are an important part of their incentive system, there is in fact little relationship between pay and performance. The stock of an airline will go up, for instance, when the price of oil goes down. Stocks more generally go up when the interest rate decreases. The growth of stock options, in turn, is related to deficiencies in corporate governance and in the rules governing transparency and disclosure. Many shareholders do not realize the extent to which CEO stock options have diluted the value of their holdings. Again, there is a rich and important agenda to reform the rules of the game. This rewriting of the rules in ways that might result in firms focusing on the long term would lead to an economy with higher and more stable growth. 3. A super Chapter 11 for bankruptcy. A regular feature of capitalism is that firms and households get too indebted. They need a fresh start. That's why virtually every modern economy has a bankruptcy law, a procedure for the orderly discharge and restructuring of debt. When, however, there is an economic downturn, such as has plagued Europe for the last several years, then many firms and households wind up over-indebted. In the United States, there is an expedited procedure for firms to go through bankruptcy. Their debt is written down quickly so that the firm can continue producing and jobs are not lost. This is called Chapter 11. When many firms and households are simultaneously going bankrupt, it is even more important to have an expedited process, a super Chapter 11. For in the absence of such an expedited process, there can be economic paralysis. Such a super Chapter 11 is particularly important in the crisis countries right now. 4. Promoting environmental investments. A Eurozone that works has to have not just high growth, but sustainable growth, and sustainability entails not just economic sustainability, but environmental sustainability. Once one recognizes the huge investments that are needed to retrofit the economy for climate change, one sees the foolishness of any claims that there is a savings glut. But as we have seen, it will be hard to incentivize firms to make green investments if there is no price of carbon, that is, if those who pollute are not forced to pay the consequences of their pollution. That is why it is important for there to be a high, European-wide price of carbon. Structural reform number 7. A commitment to shared prosperity. One of the central problems facing the advanced world today is the increase in inequality. As we have noted, inequality affects the performance of the economy in numerous ways, but the Eurozone framework limits what can be done to address it. Free mobility of capital and goods without tax harmonization not only can lead to an inefficient allocation of capital, but it can also reduce the potential for redistributive taxation, leading to high levels of after-tax and transfer inequality, and in some instances, even market income inequality. Competition among jurisdictions can be healthy, but there can also be a race to the bottom. Capital goes to the jurisdiction that taxes it at the lowest rate, not where its marginal productivity is the highest. To compete, other jurisdictions must lower the taxes they impose on capital. Thus, the scope for redistributive taxation is reduced. A similar argument applies to skilled labor. The Eurozone's structure has not only led to more money after tax at the top, but also to more people in poverty at the bottom. As the crisis in Spain, Greece, Portugal, and elsewhere illustrate, it is the poor who suffer the most from instability. Moreover, one of the major factors contributing to increasing inequality is high unemployment, such as has arisen in all of the crisis countries. The failure of the Eurozone to create a true stability framework has thus contributed to inequality. The EU, and this analysis thus goes beyond the Eurozone, must adopt two further sets of policies. First, it needs to limit the race to the bottom, the kind of tax competition that worked so well for a few countries like Luxembourg, but at the expense of others. This is a real example of an externality, of an action by one country that imposes harms on others. And yet Europe has failed to take adequate action, partially because many in Europe are enamored of the idea of low taxes and a small state, and this kind of race to the bottom suits them fine. Secondly, given the easy mobility around the European Union, the major responsibility for redistribution must lie at the EU level. The EU should follow the United States in levying taxes based on citizenship, whether individuals are domiciled or resident. and they should impose an EU-level tax on all incomes over a certain threshold, say €250,000, at a modest rate like 15%. The funds could be used to bankroll efforts such as resettlement of migrants or foreign assistance. This would perhaps do far more to create political integration in Europe than the euro itself. A true growth and stability agenda interacts strongly with other elements of the reform agenda. The only sustainable prosperity is shared prosperity. Reforms in crisis policy. These structural reforms are necessary for the long-run viability of the Eurozone, but they will not be sufficient. Even with a well-designed Eurozone structure, there will be shocks that lead some of the countries within the Eurozone into a recession. It should be obvious from previous chapters that how Europe has responded has typically exacerbated the downturns rather than restored the afflicted countries quickly to full employment. Dismal policies lead to dismal results. It is imperative that there be a set of reforms in the policies for crisis countries. But as we noted earlier, even the best of policies won't work unless they are accompanied by or preceded by the structural reforms I've described. The importance of discretion and flexibility. There are two important aspects of the policy framework that I have noted briefly earlier. Germany has emphasized the importance of obeying the rules. Of course, obeying the wrong rules can lead to disaster. The wrong rules within the Eurozone have led to its poor economic performance. But it is hard to design a set of rules that is appropriate for all countries in all circumstances. Indeed, we need to admit the limitations in our knowledge. And even if we had a policy framework that was ideal for the economy of 1990, that framework may not be appropriate in 2016. In its response to the euro crisis, the Troika, in fact, exercised considerable discretion, but their choices have been frequently wrong, too frequently, in too many important areas. At the time that they imposed the programs, they exuded enormous confidence. They seemed to believe that they knew precisely the consequence of each policy. Afterward, the IMF has often owned up to the mistakes, but the other members of the Troika have been less forthcoming. If the Eurozone is to work, it has to recognize the large differences among the countries, and policy frameworks have to be sufficiently flexible to accommodate these differences. There has to be a greater ability to adapt to differences in economic circumstances and beliefs. Some countries, for instance, are more committed to equality than others. Some are more worried about the consequences of unemployment than others. Even within the United States, each state has wide discretion to pursue different policies. The basic principles are understood. Those arenas that do not give rise to external effects on other countries should be reserved to the individual countries. This principle is sometimes referred to within the European Union as subsidiarity. Some aspects of harmonization may have some slight economic benefit, but there is still a social cost in reducing the country's own degree of discretion. Getting the right balance is difficult, but at least in some areas, the programs that have been imposed on the crisis countries have excessively reduced their economic sovereignty, with little justification in terms of reducing adverse externalities. Below, I discuss two necessary changes in the policy frameworks for addressing countries in crisis. Crisis policy reform number 1, from austerity to growth. European leaders have recognized that Europe's problems will not be solved without growth, but they have failed to explain how growth can be achieved with austerity. Indeed, they assert that what is needed is a restoration of confidence. Austerity will not bring about either growth or confidence. Europe's sorry record of failed policies, after repeated attempts to fashion patchwork solutions for economic problems it was misdiagnosing, have undermined confidence. The reforms to the structure of the Eurozone that I described earlier, including the mutualization of debt, the banking union, and the Solidarity Fund for Stabilization, would provide space for a return to growth. There could be a mutually reinforcing expansion of government spending on, say, growth-enhancing public investments. This could be coupled with government assistance for private lending that would support private investments. There are two further aspects of this policy reform. 1. Recognizing the limits of monetary policy, the concerted use of fiscal policy. Europe, like the United States, has relied on monetary policy in its response to the recent economic crises. It has more than relied on monetary policy. Both in the United States and Europe, there has been austerity. Monetary policy simply can't fill the void, and the reliance on monetary policy has resulted in even greater inequality. The big winners are the wealthy, who own stocks and other assets that have increased in value as a result of low interest rates and QE. The big losers are the elderly, who put their money into government bonds only to see the interest rates generated virtually disappear. In Europe and America, there has been mediocre growth, stagnation, and the beginning of what I predicted in my book Freefall would be the Great Malaise, now also called the New Mediocre by the IMF. Indeed, the reliance on monetary policy is setting the economy up for future problems. Because the credit channel hasn't been fixed, too much of the liquidity that has been created has gone to creating bubbles, threatening future economic stability. For those firms that have access to capital at low interest rates, even though wages have stagnated, in some cases the cost of capital has fallen even more, inducing these firms to use more capital-intensive techniques of production, contributing, over the long run, to unemployment. 2. Recognizing the principle of the balanced budget multiplier. Even with restrictions on the size of the deficit, the government can stimulate the economy. Increases in spending matched by increases in taxes increases GDP, because the stimulative effect of the spending is greater than the contractionary effect of the corresponding amount of taxes. And if the spending and taxes are chosen carefully, say welfare payments for the poor and inheritance taxes of the rich, then the multiplier can be large. That is, the increase in GDP can be a multiple of the increased spending. Public investments in infrastructure and technology may increase the returns on private investments and thus stimulate it. Indeed, there are some taxes, like pollution taxes, that can even stimulate the economy even as they improve societal well-being by improving the environment. A tax on carbon emissions, for instance, will induce firms to spend money on emission-reducing investments. Other taxes, like those on luxury cars, all of which are imported into a country such as Greece, improve the country's current account by discouraging such imports, improve the distribution of income, since taxes on these goods are only paid by the rich, and may promote domestic employment, since they encourage shifting of spending from these imported goods to other goods, some of which are produced by the country itself. Unfortunately, as we noted in Chapter 7, the hidden, and in many cases not so hidden, agenda of much of neoliberalism has been simply to reduce the size of government. Crisis Policy Reform Number 2. Toward Debt Restructuring. For most Eurozone economies, these reforms would, for now, suffice. But there may be some, like Greece, where the cumulative impact of past mistakes, their own and those forced upon them, is such that more is needed. The high debt represents a stranglehold on the country's growth. In the past, there have been 3 ways that countries have dealt with high debt-to-GDP ratios. Many countries have engaged in inflation, so the real value of the debt declines. This is particularly effective if the debt is long-term. A second way is to grow the economy. If GDP goes up, the debt-to-GDP ratio goes down. Debt becomes relatively unimportant. But as we've seen, the Eurozone has taken these 2 strategies out of the toolkit. The ECB won't allow inflation, and the Troika won't allow indebted governments to spend in order to invest in their country's future. Indeed, as we've seen, the austerity programs have lowered GDP, thus making existing levels of debt less sustainable, explaining how debt-to-GDP ratios are consistently worse now than they were at the beginning of the crisis. That leaves only the third alternative, debt restructuring. Debt restructuring is an essential part of capitalism. As we have noted, typically, a country has a bankruptcy law that facilitates the restructuring of debts in an orderly way. After the Argentine crisis, there were calls for the creation of a sovereign debt restructuring mechanism. One of President George W. Bush's many sins was to veto that initiative. In the subsequent years, when there were no sovereign debt crises, there was little concern about the issue. If some country needs debt restructuring to enhance growth, it should be done quickly and deeply. It is important that the debt write-down be deep. Otherwise, lingering uncertainty about the possibility of another debt restructuring will cast a pall over the recovery. By the same token, as we noted earlier, the costs to the economies doing the restructuring may be less than widely assumed, and the benefits can be significant. Both theory and evidence suggest that countries which do such restructuring can later regain access to global financial markets, often quickly. But even if going forward countries have to rely on themselves rather than turning to foreigners for funds, any adverse consequences may be far less than the benefits they receive from immediate debt restructuring. A deep debt restructuring provides more fiscal space for expansionary policies, so long as the government does not have a primary deficit. Money that would have been sent abroad to service the debt stays at home. Argentina has also shown that there is life after debt and that there are large benefits to the reform of monetary arrangements. With these changes, Argentines escaped a years-long death trap where unemployment had soared as high as 22.5% in 2002, levels approaching those in Greece today. After the changes, Argentina's GDP grew at an average of 8.7% from 2003 to 2007 until the global financial crisis, and unemployment came down to an estimated 6.5% in 2015. Because of the uncertainty about future growth, and therefore of whether a given level of debt is really sustainable, GDP-indexed bonds, which pay off more if the country does well, can be useful in a debt restructuring. Such bonds represent an effective form of risk-sharing between a country and its lenders. These can be thought of, at the sovereign level, as the equivalent of the conversion of debt into equity at the corporate level. These bonds have a further advantage. They align the interests of creditors and debtors. With GDP-linked bonds, Greece's creditors do better if Greece does better. Under current arrangements, Greece bears all of the consequences of the mistaken policies imposed on it from outside. With GDP-linked bonds, creditors like Germany would have an incentive to think twice about these policies. Concluding comments. I have outlined a set of changes to the structure and policies of the Eurozone that would enable the Eurozone to work, to bring shared prosperity to this region. In one sense, they are modest. They fall far short of the degree of economic and political integration that defines the United States and other federal structures sharing a common currency. But what is required is far more than what exists today. I have focused on economic reforms that would result in convergence among the European countries and create shared prosperity. These changes would at least hold open the promise of an increase in solidarity among European countries rather than the divisiveness that has marked recent years. Especially the joint projects, such as infrastructure projects linking Europe closer together and the solidarity funds for stabilization, are likely to promote political integration. But more needs to be done. The teaching of history in school, for example, should be broadened so that students learn not just about the legacy of strife in Europe, but also about the continent's joint battles to establish human rights and democracy. The euro was supposed to set the stage for further political integration. Many thought it would speed up such integration. Today, we have noted, it is having just the opposite effect. Some suggested that Europe had put the cart before the horse. Closer political integration, with a broader consensus on what good policies look like, is more likely to make a common currency system viable. There are a host of political reforms, widely discussed within Europe, that would strengthen the EU and the Eurozone, often, however, at the expense of the politicians who dominate today on the national stages. Not surprisingly, Many of these reforms are resisted by politicians who prefer the security of being a big fish in a small pond to the prospect of playing an uncertain role in a politically more important Eurozone. It was simply naive to believe that sharing a common currency would change these political dynamics. Some may look at my list of reforms and argue that it is far from minimal. I believe that reforms that fall short of this comprehensive agenda will substantially increase the likelihood that the euro fails. And if it survives, it will survive without bringing the benefits that were promised. I have repeatedly emphasized that the euro was not an end in itself, but a means to broader ends. So far, the euro not only has failed to achieve those broader ends, but has had the opposite effects: poorer growth and more divisiveness. These or similar reforms are necessary to prevent the divergence, instability, stagnation, growth in inequality, and increase in unemployment that have marked the euro. They are intended to cope with the consequences of the absence of exchange rate flexibility and having a single interest rate prevailing over a diverse region, to make it more likely that the Eurozone will perform well in spite of the inherent limitations on adjustment that follow. The absence of these normal market mechanisms makes it all the more important that the Eurozone economic system does not face further impediments, further sources of instability and/or stagnation. Doctrines and policies that were fashionable a quarter-century ago are ill-suited for the 21st century. The reforms of this chapter are designed to free the Eurozone from its unfortunate historical legacy and to give it sufficient flexibility to address new problems and to incorporate new ideas as they evolve. The ECB, under Draghi, has demonstrated more flexibility than many thought possible, and has done some critical things that many in Germany think is not within its mandate. Still, the ECB remains far more constrained, far less well adapted to the economic realities of today than the Federal Reserve. Many in Europe would agree on the merits of many, if not most, of the reforms I have outlined. But they would say Europe is a democracy and democracies move slowly. Thus, the argument is put, be patient. But the timing and sequencing of reforms are critical, and this is especially so when there is a mismatch between economic and political integration. The creditor-debtor relationship between Northern and Southern Europe is corrosive. Unless the reforms I have suggested, or something else along a similar line, are made, this corrosion will only deepen. The damage that is being done will be hard to undo. Markets are impatient, and they will not wait until, perhaps, further reforms are made. The fact that there might be a banking union with common deposit insurance in 2017 is no reason not to take out money from a Spanish or Greek bank now. The downward spiral has already been costly, and even if the decline is arrested, the slow recovery will exert its toll. Europe's future potential growth is being lowered as a result of the mistakes being made today. There are important hysteresis effects. The generation entering the labor force today will not be building up their skills, creating the human capital that would make them more productive in later years. The term hysteresis simply refers to asymmetries in time and adjustment costs. Undoing the imbalances that the euro created in just a few years is taking years far longer than the time required for them to build up, and the costs of undoing these imbalances is far greater than the benefits received as they were built up. So, too, once capital or talented young people leave a country, it is often hard to get them back. Much of the economic debate is about which asymmetries are important. For example, the inflation hawks worry that once inflation increases, bringing it down is costly. The benefits of a short period of high inflation, if any, are far less than the costs of bringing it down. The evidence is that the asymmetries that we are focusing on are far more important. From what I have seen, however, there is little likelihood of sufficient progress in undertaking the deep reforms in the structure of the Eurozone at sufficient speed. Delay is costly in another way. As Europe struggles with a flawed Eurozone, which is bringing the economic travails that I have described, Other crises emerge, most notably the threat of a breakup of the nation-state in Spain, the threat of the departure of the UK, and the onslaught of migrants, especially from the Syrian conflict. The persistent euro crisis and the conflict over how it has been managed makes it more difficult to develop consensus policies in any of these areas, which would be extraordinarily difficult in any case. That is why Europe needs urgently to begin thinking about alternatives to the single currency arrangement, the alternatives that I outline in the next 2 chapters. Perhaps doing so will increase their resolve to do what it takes to create a Eurozone that works. Chapter 10. Can there be an amicable divorce? The last chapter described an agenda to make the euro work, and I believe that making the reforms suggested is the first best course. However, while I think it is eminently doable, there is more than a small probability that it will not be done. In that case, there are only 3 alternatives. First is the current strategy of muddling through. In other words, doing the minimum to keep the Eurozone together, but not enough to restore it to prosperity. Second is the creation of the flexible euro, described in the next chapter. The third option is a divorce, which Europe should strive to be as amicable as possible. In this chapter, we discuss what a friendly separation could look like, not necessarily into 19 different currencies, as existed prior to the Eurozone, but into at least a few, 2 or 3 different currency groupings. The central message of this chapter is simple. An amicable divorce is possible. In fact, some of the institutional innovations that would facilitate that divorce, making use of 21st century technology, would also in time improve the overall performance of the economy. And to demonstrate the argument that such a divorce can be done without high costs, either to the country leaving or to the rest of the Eurozone, I illustrate the analysis by looking at the case of Greece. But a similar analysis would apply to any other country contemplating leaving the Eurozone. Is a Greek exit, or Grexit, possible without destroying Greece's economy or imposing high costs on the rest of the Eurozone? If Greece could manage, presumably so could countries that are far better off. There will, of course, be costs. Monetary arrangements matter, and leaving the Eurozone is a big change. But there are huge costs in the current strategy of muddling through, as shown in Chapter 3. For the Eurozone as a whole, we calculate them in the trillions of dollars. For Greece, in depression without end, the losses today give but a glimpse of the losses going forward. A rational calculus has to set these known and persistent costs against the risks of a divorce. At least with a divorce, even if there is a rocky start to the new life, there is the upside potential of an end to depression and the start of real growth. This chapter suggests that in a reasonably well-managed, amicable divorce, Greece would do far better than it is doing under the current programs imposed upon it by the Troika. There are, of course, political dimensions that economic calculus ignores, and those political dimensions are multifaceted. The divorce would restore dignity to the Greek people, who have been treated shabbily by Germany and the Troika, and it would restore democracy. Cyprus's acceptance of the Troika demands, after 62% of the population had voted in a referendum against the austerity program, removed all doubt that their economic sovereignty had been forfeited. The final section of the chapter explains that if there is to be a limited breakup of the Eurozone, it makes more sense for Germany to leave, instead of the countries around the periphery. We conclude with some remarks about why it is so important to have an amicable divorce. How to leave the euro and prosper. There are several difficulties in managing an exit, managing the fiscal deficit, the current account deficit, and the debt, creating and maintaining a stable banking system with a stable supply of credit to finance new investments, and creating a new financial transactions system. The 2008 global financial crisis and the subsequent discussion of financial sector reforms highlighted the failures of financial markets and the enormous consequences of these failures for the economic system. These included excessive volatility in credit creation, with a misallocation of capital and a mismanagement of risk, more credit going to the purchase of fixed assets rather than to the creation of productive assets, excessive and volatile cross-border flows of short-term capital, leading to volatility in exchange rates and trade flows, excessive charges for the running of the payments mechanisms, and an array of socially unproductive practices, from market manipulation to insider trading to predatory lending. I've described the macroeconomic consequences, where misguided credit flows to the periphery countries created the imbalances from which Europe is suffering still. A monetary union is about money, and more generally, a country's financial system. It was dysfunctions in the Eurozone's financial system that led to the crisis. It was restoration of financial stability upon which the ECB and the Troika focused, with seemingly little regard for the consequences of the lives of the people affected. Hence, as, say, Greece departs a failed monetary financial system, the relevant question is, what would replace it? The normal presumption has been that Greece would go back to the drachma, with all the problems associated with that. Those depicting this alternative typically ignore that in the last, say, 2 decades of the drachma, Greece grew far faster with lower unemployment than in the almost 2 decades since entering the Eurozone. But much has happened in the past 4 decades. Modern technology provides the basis of a new financial system. Greece doesn't need to go back to the past. It can create the financial system of the future, the kind of financial system that current special interests within the financial sector, wanting to preserve the huge rents that they garner for themselves, have prevented us from creating. The following sections describe briefly the key elements of such a system, a low-cost medium of exchange for facilitating transactions, and a system of credit creation focused on the real economy, managed in a way far more conducive to macroeconomic stability than the current system. Creating a 21st century financial transactions system. Our banking and monetary system serves multiple purposes. One of them is as a medium of exchange. The world has several times made a change in the prevailing medium of exchange. Gold was once used. Then, at least in the United States, there was a move to the bimetallic standard, where gold and silver were used. And finally, we moved to paper or fiat money. For years, it has been recognized that it would be far more efficient to move to e-money, away from currency. A Grexit could provide an opportunity for doing so in a way that would facilitate the Grexit and strengthen the Greek economy. As various pundits considered the potential Greek exit from the Eurozone, articles in the press appeared about the logistics and whether it would be possible for Greece to get enough currency printed, how they would manage a switchover to the drachma, dealing with the conversion of bank accounts, designing, printing, and delivering a new banknote, and how to impart value to the new currency. Greece could not very well begin printing money before it leaves the Eurozone, and it was not clear what would happen in the interim. People who ask these questions apparently have not noticed what has happened to our payments mechanism, the way we transact with each other. Currency, those funny pieces of paper, with faces of famous people or buildings on them, are mostly a relic, just as gold and silver were once the key part of the payments mechanism, but are no longer. We now have a much more efficient electronic payments mechanism, and in most of the world we could have an even more efficient one if it were taken out of the hands of the monopolistic financial system. Electronic transfers are extraordinarily cheap, but banks and credit card companies charge exorbitantly for the service, reaping monopoly profits as a result. Electronic money is more convenient for people on both sides of the transaction, which is why it has become the dominant form of payment. It saves the costs of printing money, which has increased as the sophistication of counterfeiters has increased. It has a further advantage, especially in countries like Greece, where small businesses predominate. It significantly curtails the extent of tax avoidance. With electronic money, Leaving the euro can, in principle, be done smoothly, assuming there is cooperation with other European authorities. Upon a Grexit, the Greek euro would instantly come into being. It would be the money inside the Greek banking system. In effect, this money would be locked in. But anybody could transfer the money in his bank account to that of anyone else. Thus, everybody has, in effect, almost full use of his money. The Greek euro would be just like any other currency, with a well-defined value relative to the ordinary euro. Most individuals today have accounts. Only the very poor are unbanked. And in recent years, governments and NGOs, like the Gates Foundation, have been making great efforts to bank the unbanked. The government could quickly create new bank accounts for the few people who remain unbanked. In most countries, government pension payments are now transferred through bank accounts, partly to reduce the risk of stolen checks, partly to reduce the outrageous charges that are sometimes charged by check cashing services. Credit. Creating a banking system that serves society. Earlier in this chapter, we noted the successive changes in monetary arrangements, in the medium of exchange. A big advantage of the use of fiat money was that one could regulate the supply. When gold was used as the medium of exchange, when there was a large discovery of gold, or when the gold supply increased as Spain conquered the New World, there would be inflation, as the price of gold would fall relative to other goods. If there were few gold discoveries, then there would be deflation. Both caused problems. Deflation, for instance, would redistribute income from debtors to creditors, increasing inequality and imposing hardship. America's election of 1896 was fought on the issue of the money supply. The debtors wanted to increase the money supply by moving from gold to gold and silver, a bimetallic standard. While the modern financial system based on fiat money didn't suffer from the vagaries of gold discoveries, it suffered from something even worse: volatility in the creation of money and credit by the banking system, without adequate regulation, giving rise to the booms and busts that have characterized the capitalist system. Banks effectively increase the supply of money by increasing the supply of credit. In a modern economy, central banks regulate, typically indirectly, banks' creation of money and credit. They are supposed to do it in just the right amount. So there is a Goldilocks economy, neither under or overheated, but just right. Targeted regulation of credit creation. There is a problem in this system. Because the central bank's control mechanisms are typically very indirect, the economy is often over or underheated. Sometimes there is too much credit creation, leading to an excess of aggregate demand, and prices rise. There is inflation. Sometimes there is a lack of demand and prices fall. There is deflation. Part of the reason for this failure is that while central banks can regulate the supply of credit reasonably well, they can't, or more accurately don't, regulate the use to which the credit is put. Much of the credit goes to buying pre-existing assets, like land. What determines whether the economy is over or underheated is the purchase of new goods and services, whether for consumption or investment. Thus, after the 2008 crisis, there was a massive increase in liquidity as the Fed pumped money into the economy, but relatively little of this went to buy goods and services in the United States. So, in spite of the huge expansion of the money supply as conventionally measured, the economy remained weak. In short, even with fiat money, there may still be a deficiency of domestic aggregate demand, a deficiency that could be easily corrected. There are individuals and firms who would like to spend but cannot get access to credit. As I have repeatedly noted, that is one of the central problems in Greece and Spain. The ECB, with its belief in markets and its misunderstandings of monetary policy, has devoted little attention to the flow of credit. A near-zero interest rate does not mean businesses can get access to credit at such a rate, or at any rate. In spite of the single market, there is not a single lending rate. Indeed, the disparity in lending rates is part of the divergence built into the Eurozone system. The individual countries which have given up control over their own monetary system have no way of trying to equalize the cost of capital to firms, households, or even to government. This is the unlevel playing field that is inherent in the current euro system. The impact of divorce on the flow of bank credit. The banking system is central to the provision of credit. There is the worry, won't leaving the euro lead to the crash of the banking system and, at minimum, a severe heart attack for the economy? Indeed, from all accounts, it was the threat that this would happen which led the Greek government to give in to the demands of the Troika in the summer of 2015. But again, this is false fear. The traditional view of banking was based on a primitive agriculture economy, farmers with excess seed, with harvests greater than they wanted to consume or plant the next season, could bring the seed to the bank, which would lend, at interest, the seed to some farmer who wanted more seed than he had, either for consumption, say because he had a bad harvest that year, or planting. The bank had to have seed deposits in order to lend. In effect, those worrying about where Greece would get the money necessary for running its banking system have in mind this corn economy. The Greeks have no corn to put into the new banking system, and why would any foreigner put his corn into the new Greek banks? But this reasoning again totally misses the nature of credit in the 21st century. In a modern economy, banks effectively create credit out of thin air, backed by general confidence in government, its ability and willingness to bail out the banks, which includes its power to tax and borrow. The euro, however, has limited those abilities, and in the absence of a banking union, has thus undermined national banking systems. Restoring domestic control over credit creation. Once we restore a country's economic sovereignty, as the country, say Greece, leaves the eurozone, its ability to create credit is largely restored. Think of this most directly as occurring through a government bank. It can add money to the payments mechanism by lending money to a small enterprise with a proven reputation that wants to build a hotel on an island where the demand for hotel rooms has persistently exceeded supply. The government simply puts more money into the bank account of the enterprise, which the enterprise can then use to pay contractors to build the hotel. Of course, in providing credit, there is always a risk of non-repayment, and standards have to be established for evaluating the likelihood of repayment. In recent decades, faith in government's ability to make such evaluations has diminished, and confidence has been placed in the private financial system. The 2008 crisis, as well as other frequent crises that have marked the last third of a century, have shown that confidence has been misplaced. Not only didn't the banks make good judgments, as evidenced by the massive repeated bailouts, but they systematically failed to fulfill what they should have seen as their major responsibility, providing credit to businesses to create new jobs. By some accounts, their real lending amounts to just 3% of their activities, by others to some 15%. But by any account, bank finance has been absorbed in other directions. There were always obvious problems in delegating the power of credit creation, backed by government, to private institutions. They could use their power to benefit their owners through what we defined earlier as connected lending. Regulations circumscribed this, motivated by the experience of bad lending perhaps more than by the implicit corruption and inequality to which such lending gives rise. But circumscribing connected lending didn't address the key underlying problem. Credit is scarce. Giving private banks the right to create credit with government backing gave them enormous economic rents. They could use this economic power to enrich themselves and their friends. Russia provides the quintessential example. Those with banking licenses could use that power to buy enormously valuable state assets, especially in natural resources. It was through the banking system that the Russian oligarchs were largely created. In Western countries, matters are done more subtly, but creating enormous inequality, though not on the magnitude of Russia. In many cases, they lend money to those whom they trust and judge creditworthy, with collateral that they value. In short, The bankers lend money to those who are similar to themselves. Even if Banker A can't lend to himself or his relatives, Banker A can lend to the relatives of Banker B, and Banker B can lend to the relatives of Banker A. The fallibility of their judgments has been demonstrated repeatedly. Overlending to fiber optics at one moment, to fracking at another, to housing in a third. There is a second danger to the delegation of the power of credit creation to private banks. Throughout history, money lenders have had a bad reputation because of the ruthlessness with which they exploit the poor, especially at moments of extreme need, where without money they, their children, or their parents might die. At such times there is an enormous asymmetry in bargaining power, which the moneylenders sweep in to exploit. Virtually every religion has tried to proscribe this exploitation, prohibiting usury, and in some cases even interest. Somehow, in the magic of neoliberalism, this long history was forgotten. Bankers not only didn't suffer from the stigma of being called moneylenders, they were elevated to being the paragons of capitalism. In the enthusiasm over their new virtues, as linchpins in the workings of the capitalist system itself, it was simply assumed that such exploitation would not occur, perhaps in the belief that competition would ensure it couldn't happen, perhaps in the belief that with the new prosperity of workers, citizens wouldn't let it happen. All of this was wishful thinking. Freed of constraints, bankers, our 21st century moneylenders, have shown themselves every bit as ruthless as the moneylenders of the past. In fact, they are in some ways worse, because they have discovered new ways of exploiting both the poor and investors. They have been moving money from the bottom of the economic pyramid to the top. The financial sector has enriched itself on the back of the government's credibility without performing the societal functions that banks were supposed to perform. In doing so, the financial sector has become one of the major sources of the increased inequality in Europe and around the world. Even given this history, the government may want to delegate responsibility for making credit decisions to private enterprises, but it should develop strong systems of incentives and accountability, such that the financial system actually focuses on lending for job and enterprise creation, and so that it does not make excessive profits as it performs these functions. This can be put another way. The government should be adequately compensated for its backing. In effect, in the current system, all the value of the underlying government credit guarantee is captured by the private sector. Credit auctions. Here is one possibility for addressing this issue and providing for greater economic stability, one that a country leaving the Eurozone and its strictures and legal frameworks could avail itself of. First, the central bank, government, auctions off the rights to issue new credit. The amounts would be added to the money that is within the financial system. The magnitude of net credit that it allows to be added each month will be determined by the country's central bank on the basis of its assessment of the macroeconomic situation. That is, if the economy is weaker, it will provide more credit to stimulate the economy. The winners of the credit auction then allocate this money to borrowers on the basis of their judgments about repayment capacity, within the constraints that the central bank may impose, described below. Note that in this system, banks cannot create credit out of thin air, and the amount of money being created each month is known with considerable precision. The winners of the credit auction can only transfer money from their account to the borrowers' accounts. Conditions would attach to selling the rights to lend to the banks. Minimum percentages of the loans would go to small and medium-sized enterprises and to new enterprises. A maximum would go to real estate lending, perhaps apportioned by location on the basis of local changes in prices, to purchases of other existing assets, or to those engaged in speculative activities like hedge funds. None would be allocated to socially proscribed activities, like those contributing to global warming or associated with the promotion of death, such as cigarettes. In short, there would be minimum standards for social responsibility. There would be limits on the interest rates charged. discriminatory lending practices and other abusive practices by credit card companies would be proscribed. So, too, would connected lending. There would be further restrictions to ensure that the loan portfolio of the bank is safe and sound, and there would be strict supervision by government regulators to ensure compliance with the regulations governing any such program. In a 21st century banking system, a bank's ability to lend is, in a sense, given only temporarily. It is conditional on compliance with the rules and standards established. The government would allow for entry into the banking system. Indeed, separating the depository and lending functions and the open auction of rights to issue credit should make entry easier, and thus competition more vigorous than under current arrangements. Still, since lending is an information-based activity and the gathering of information is a fixed cost, one would like stability in the new banking system, and this will require that banks not live on the edge, that is, they be sufficiently well capitalized and sufficiently profitable. By saying sufficiently profitable, I do not mean the 25% return on equity that one of the European banks, Deutsche Bank, famously came to expect as normal. Hence, entry of enterprises with sufficient capital and who also satisfy other conditions that enhance the presumption that they would be responsible lenders would be encouraged. The system of auctioning of credit would ensure that banks not earn excessive returns. Most of the value of the public's backing to the creation of money/credit would be captured by the public, rather than as now by the bankers. At the same time, the new system of credit creation ensures that the social functions of finance are more likely fulfilled, at least better than under current arrangements. This is an example of how to create a 21st century banking system, responding to the advantages of electronic technology, doing things that would have been far harder to accomplish in earlier decades. A banking system more likely to ensure responsible lending and macroeconomic stability than the current system, and without the huge rents and exploitation that have contributed so much to the inequality that has stalked advanced countries around the world. But this reform is about more than curbing bankers' exploitation. It is about enhancing macroeconomic stability. One of the major contributors to macroeconomic instability is the instability in credit supply, and in particular to the supply of credit for the purchase of produced goods and services. The 2008 crisis demonstrated that all the advances in markets and our understanding of markets has not led to greater stability in this crucial variable. In fact, quite the opposite. Our system not only enhances stability in this critical variable, it provides the basis of a virtuous circle leading to an increase in overall stability of the economy. One of the most important reasons that small businesses don't repay loans is macroeconomic fluctuation. Loans simply can't be repaid when an economy is in depression. Ensuring greater macro stability than under the current regime would do more than anything else to ensure the viability of the banking system. Whence bank capital? The beauty of the modern credit system is that it doesn't really require the same kind of capital as it did before. Recapitalizing a destroyed banking system in a Eurozone country would not require gold or borrowing to buy seeds as it did in the old days. As we have seen, the government itself can simply create credit through a government bank, or it can delegate credit creation through the auction mechanism just described. The fact that the money created by the government can be used to pay the taxes that are owed to the government, and that the government has the power to levy taxes, ensures the value of the credit it has created. Indeed, because the credit that has been created is electronic money, the movement of which can easily be monitored, the government has not only the ability to levy taxes, it also enhances the ability to collect taxes. The only reason for bank capital in this world is as a partial guarantee that the bank has the capacity to repay the credit. The bank's purchases from the government of the right to issue credit are only temporary, and the credit thus created has to be repaid to the government. The fact that the bank will lose its own capital has, in addition, strong incentive effects, incentivizing the bank to make good decisions about to whom to give the credit and to monitor the loan well. But if the government is doing an adequate job of bank supervision and has imposed appropriate regulations, for example, on connected and excessively risky lending, the amount of capital required will be limited. And that fact alone should lead to more competition in the market for the provision of credit, reducing the excessive returns currently received. Managing the current account deficit in an amicable divorce. The euro crisis was brought on by Greece not being able to finance its trade and government deficit, or more particularly, not being able to roll over the debt it owed. Greece has relied massively on Eurozone help, though, as we have noted, the vast majority of so-called aid actually went to European creditors, not to Greece. This is itself good news for Greece, or any of the other crisis countries, about the ability to manage on its own. With an appropriate debt restructuring, discussed later in this chapter, the country would be little the worse off, even were its partners not to extend a helping hand in an amicable divorce. Indeed, freed from the conditions imposed as part of the assistance, freed from austerity and counterproductive structural reforms, the country would actually be in better shape. At this juncture, some half-decade after the onset of the euro crisis, there is even better news. Greece, the worst afflicted of the crisis countries, has virtually eliminated its trade and its primary fiscal deficit. If the elimination of those deficits had been the sole objective of the Troika programs, and one cared nothing about the costs of achieving these goals, then the Troika programs could be declared a success. But the goals were broader. It was to have Greece be able to stand on its own, at full employment, with growth. But, on the contrary, Greece is in a deep depression. And as this book has shown, the costs of achieving the reductions in the trade and fiscal deficits has been absolutely enormous. Looking forward, on net, money will be flowing the other way. Money will be going not from Germany and others in Europe to Greece, but from Greece to Germany and others in the Troika. This reverse flow is scheduled to go on for decades. Greece will not need help from outside, and won't be getting any. Outside the Eurozone, Greece, or any of the other crisis countries, would be able to use the flexibility of its exchange rate, the fact that the value of the Greek euro may be less than that of the euro, to correct any trade imbalance and to strengthen the economy. As we've seen, the origins of the trade deficit largely arise from the inability to adjust the exchange rate. As the exchange rate falls, exports become more attractive and imports less so, and typically, though sometimes not right away, this enables the current account deficit to be brought to manageable levels, if not to actually be eliminated. Moving to a Greek euro would accomplish this de facto devaluation. Greek exports some commodities like olive oil, and its mining sector is large as well. But as in any modern economy, Greece sells not only goods, but services. In fact, services account for 80% of GDP. Greek tourism alone makes up some 7% of GDP. The effective devaluation would give Greece a competitive edge in this space, where consumers are price sensitive, and that edge would increase its foreign exchange revenues. Of course, over the long run, there are other things it could and should do. It could, as we've discussed, develop its renewable energy capacities. A devaluation would enable it to derive more Greek euros from the sale of this energy to the rest of Europe. It also could develop itself as the Sun Belt of Europe, as Florida and Arizona have done in the United States, an attractive place for retirees, particularly if it strengthened its healthcare sector, and businesses, like American Express, that are electronically based and can locate essentially anywhere. A further concern: will those who export to Greece be willing to accept Greek euros in payment? They almost surely would, particularly if financial markets developed to hedge against changes in the value of the Greek euro and the ordinary euro. Of course, there will be some fluctuations in the value, just as there are fluctuations in the value of the many currencies within the EU, the Swedish krona and the British pound. But modern financial markets know full well how to manage those risks. Managing the current account deficit through trade chits. There is another reform that would simultaneously resolve any doubts about the acceptability of the Greek euro and help the adjustment process, an idea that has been suggested even for the United States, which has had a persistent current account deficit, contributing to the weak U.S. economy, by none other than Warren Buffett. It would assure, too, the necessary flow of trade credit. In this proposal, alternatively called trade chits or Buffett chits, government would provide to any exporter a chit, a token, in this case electronically recorded, the number in proportion to the value of what was exported. To import a Greek euro worth of goods, there would be a requirement to pay, in addition, a Greek euro's worth of chits or trade tokens. There would be a free market in chits, so the demand and supply of chits would be equal, and by equating the demand and supply of chits, one would automatically balance the current account. In practice, the value of the chit might normally be very small. For instance, before the turmoil that hit the Greek economy beginning in early 2015, Greece had a current account surplus, in which case the value of the chit would be zero. But this system would be a way of managing the high level of volatility in market economies. With the free flow of capital, the exchange rate is determined by the vagaries of the market, and those capricious changes in exchange rate then drive exports, imports, the trade deficit, and borrowing, and in doing so, give rise to macroeconomic instability. With the system of trading chits, the trade deficit can be controlled, enhancing overall stability. In the analysis above, where every import needs a chit, there is either a trade surplus or trade balance. The government could use this system to limit the size of the deficit or surplus as well. For instance, if it wants to limit imports to be no more than 20% greater than exports, it can issue 1.2 import chits for every euro of exports. When there would be an excessive surplus, every import would be granted an export chit. Then every export would require a chit. This would automatically bring exports down to the level of imports. By issuing both import and export chits, the trade balance can be kept within any pre-specified bounds. The fact that the country could thus stabilize the size of the trade deficit or surplus has an enormous macroeconomic advantage. It facilitates macroeconomic stabilization itself. It means, for instance, that a small country doesn't have to suffer from the vagaries of its external balance, its net export position. These fluctuations impose enormous costs on society, of which the market, in generating them, takes no account. But deficit/surplus stability also engenders longer-term stability, for as we have seen, national indebtedness, built up over many years, can suddenly become unsustainable. The market sees the world through very myopic lenses. It is willing to lend year after year until it suddenly changes its mind. By limiting the trade deficit, a country is, in effect, limiting national borrowing. This framework thus reduces a key source of instability. The experience of Europe and elsewhere has shown that it is not so much government borrowing that gives rise to crises, but national borrowing. In some cases, the national borrowing was government borrowing, Greece, but in many other cases, Ireland and Spain, it was private borrowing. When a crisis hits, the debt quickly moves from the private balance sheet to the public's. Moreover, we can see how this system would help strengthen the Greek euro. In the absence of the chit system, an increase in the demand by Greeks for imports, that is, for, say, German euros to buy German cars, would lead to a fall in the price of the Greek euro. But now, with imports discouraged by the necessity of also paying to purchase a chit, the increased demand for imports would be reflected in an increased price of a chit, rather than a decrease in the value of the Greek euro. The Greek euro will be stronger than it otherwise would be. The dramatic fall in the value of the Greek euro that might have otherwise been expected in the event of a Grexit is thus avoided. Managing the fiscal deficit. Outside of the Eurozone, Greece, or the other crisis countries, could not only manage its trade deficit without assistance, it could also manage its fiscal deficit. Higher growth would generate more tax revenues, and a debt restructuring, described below, would reduce the drain of the nation's resources abroad. Over the longer term, prudent use of trade chits would prevent the buildup of large external debts, whether public or private. Interestingly, today, even within the Eurozone, Greece does not have a significant problem financing its fiscal deficit. The country can easily survive without the funds from the IMF and the Eurozone. Greece has done such a good job of adjusting its economy that, apart from what it's paying to service the debt, it had a surplus by 2014. The turmoil of the summer of 2015 strained finances somewhat, but by the beginning of 2016 it had returned to balance, and it is expected to have a large surplus by 2018. An amicable divorce would, of course, recognize that, nonetheless, assistance in the path towards creating an independent currency would be very helpful. There will be bumps and uncertainties in the process of leaving the Eurozone. Europe should help with adjustment assistance in the transition. Solidarity would suggest that the money be in the form of grants. Even if such assistance were not forthcoming, the transitions could be managed with relative smoothness. Money is needed by the government for three purposes: to finance the purchase of domestic goods and services, to service the debt, and to finance the purchase of foreign goods and services. The first is at least conceptually easier to address. The government can, in effect, issue credit to itself, in the manner described earlier, in our discussion of how government can issue credit to other parties. The subsequent increase in aggregate demand would be beneficial to the economy. Critics will raise a concern about inflation, but the crisis countries have been facing deflation, a deficiency of aggregate demand. If there is a need for government finance beyond the amount that would restore the economy to full employment, then the government will have to raise taxes. The information available through the electronic payment mechanism will, however, enable it to do a much better job of collecting the taxes already on the books, making the necessity of raising tax rates even less likely. The need for funds for servicing the debt will be greatly reduced through debt restructuring, which should be an important part of any amicable divorce. This is discussed in the next section. The need for foreign exchange can also be easily addressed if the other parts of the program, including the use of Buffett chits, are adopted, for then there will be no real shortage of foreign exchange. Managing debt restructuring. Most of the crisis countries have a large debt, denominated in euros. As I discussed in the last chapter, in some cases such as Greece, it is already apparent that debt has to be restructured. But that will be all the more so after the country leaves the Eurozone, for it is likely that the currency, for simplicity we will continue calling it the Greek euro rather than the drachma, will be worth less than the ordinary euro, which we will still refer to as just the euro. I explained in Chapter 7 that debt restructurings, bankruptcy, are a central feature of modern capitalism. Still, they are often contentious. The Greek government could do a few things to smooth the process. First, the government should declare all euro-denominated debts payable in Greek euros. Such redenominations have happened before. When the United States left the gold standard, debts denominated in gold were redenominated into dollars. Indeed, upon entry into the Eurozone, debts that had been denominated in drachmas got converted into euros. If the Greek euros trade at a discount relative to the ordinary euro, it would be tantamount to a debt restructuring, but one done smoothly, without recourse to the complexity involved in ordinary debt restructurings. Interestingly, The system of chits described earlier would reduce the extent of the decline in the exchange rate. In a few cases, Greece is one, there will have to be explicit debt write-offs. So, too, if there are debts owed under contracts issued under foreign laws, in which case the crisis country cannot simply redenominate. With a truly amicable divorce, other EU countries should agree that debt issued under other EU jurisdictions could be redenominated. In case of private debts, the government should pass a law providing for expedited restructuring. The United States has recognized the importance of giving corporations a fresh start, and doing so quickly in Chapter 11 of its Bankruptcy Code. When many companies are facing default, as may well be the case if their euro-denominated debt is not redenominated, this is all the more important. As we noted in the previous chapter, the crisis countries in Europe need to adopt some variant of this idea, and this is true whether they do or do not leave the Eurozone. This chapter is focused on an amicable divorce, and with most of Greece's debts owed to its European partners, one hopes that they would understand the importance of giving a fresh start, the importance and necessity of a deep debt write-off, and rather than confronting the country with a barrage of lawsuits, would use their own powers and influence to limit the scope for such suits from private creditors. With a backdrop of European solidarity, they could proceed with a debt restructuring that went well beyond the minimal set of principles adopted by the international community in 2015, enabling the debt restructuring process to be even smoother and more successful. The advantages of a German departure. The previous discussion described a number of institutional reforms and innovations that would lay the groundwork for a smooth transition of any one of the crisis countries out of the Eurozone. Our analysis suggests, too, that simply having Greece leave will not resolve the problems of the Eurozone, either now or over the long run. There are other countries in depression and recession from which they will not emerge any time soon. Rather than having each of the crisis countries leave one by one, or the countries of the Eurozone stick together, mired in an ill-fated near stagnation, there is an alternative solution. Germany, and perhaps some of the other northern European countries, say Netherlands and Finland, should the country soon recover from its current problems, could leave. This would be an easier way to bring Europe back to health. The departure of some of the northern countries would allow an adjustment of the exchange rate of the remainder relative to that of the northern countries. That adjustment would help restore current account balance without having to resort to recessions or stagnation to suppress imports. The lower exchange rate would increase exports and reduce imports, which would stimulate growth. The increased growth would provide more revenue to the government, bringing an end to austerity. The downward vicious circle that has been part of Europe since the onset of the crisis would be replaced by a virtuous circle of growth and prosperity. The increased strength of the economies in southern Europe would enable them to service their debts and even pay down some of the debt. With the departure of the northern countries, the currency in use by the southern countries would still be the euro. That of the northern countries we will refer to as the northern euro. Because debts are owed in euros and the countries in the south had retained the euro, there would not be an increase in leverage, as there would be if the southern countries left the eurozone, with all the adverse effects attendant to the increase in leverage. Meanwhile, in northern Europe, the stronger northern euro would work wonders to eliminate the persistent trade surplus, which has been problematic not only for their partners in the eurozone, but for the global economy. Germany would then be forced to find other ways of stimulating its economy, doing some of the things suggested in the previous chapter, like increasing wages at the bottom, reducing inequality, and increasing government spending. In the current environment, monetary policy, even that of the northern countries, would be relatively ineffective. And so if Germany wishes to maintain full employment, it would have to rely on fiscal policy. With firms, households, and even governments in the north owing money in euros, and the value of the northern euro appreciating relative to the euro, There would be an automatic deleveraging of the economy, which would stimulate growth. This would partially offset the contractionary effects of the elimination of the trade surplus. Concluding comments. This chapter has described how one can manage an amicable divorce. We have shown how each of the central problems facing the crisis countries could be addressed in such a separation. Current account deficits could be eliminated or even turned into surpluses. Governments would be able to finance their expenditures. The economies could be returned to full employment after years mired in recession and depression, with neither inflation nor deflation. I have described a system that would enable even the traditional weak economies from building up the foreign debts that have repeatedly precipitated crises. Even within this framework, there will be decisions to be made, at least in the early years of transition. I would suggest that they aim for a current account surplus, tilt public spending toward investment, run a small fiscal surplus, and, if necessary, use the balanced budget multiplier to ensure aggregate demand. Of course, matters seldom go smoothly. As always, there are likely to be hurt feelings, some finger-pointing. Who's to blame? Would the marriage have gone differently if only? If only Greece had behaved better, if only the Troika had not been so abusive. The Greeks will almost surely exhibit acts of a person in an abusive relationship, sometimes referred to as the battered woman syndrome. They will say, if only we had been more accommodating, if only we had. The previous chapters have said, however, that what is at fault was the structure of the Eurozone itself. I explained how it is unlikely that the outcome would have been much different if Greece's negotiators had been more accommodating. Over the course of the crisis, Greece has had negotiators with a panoply of styles, and none have fared well. There really is no need for self-recrimination. Many within Europe will be saddened by the death of the euro. This is not the end of the world. Currencies come and go. The euro is just a 17-year-old experiment, poorly designed and engineered not to work. There is so much more to the European project, the vision of an integrated Europe, than a monetary arrangement. The currency was supposed to promote solidarity, to further integration and prosperity. It has done none of these. As constructed, it has become an impediment to the achievement of each of these goals. And if the reforms to the Eurozone discussed in the last chapter are beyond the reach of the Eurozone today, it is better to abandon the euro to save Europe and the European project. Chapter 11. Toward a Flexible Euro. Looking at Europe today, we might say that it is in a pickle. It wants to preserve the euro, even though the euro has not been working. It would like to pretend that if only member countries had obeyed the rules, if only there had not been that American-made financial crisis, all would have been well. But in its heart of hearts, Europe must know that this is not true. Countries that obeyed the rules also went into crisis. It was not just countries of the southern periphery, but also Ireland. Even virtuous Finland is having trouble adjusting and has had unacceptably high unemployment, 9.3% in early 2016. The nature of the market economy is that stuff happens, and the stuff that happens affects different countries differently and requires large adjustments. The euro makes those difficult at best. While Northern Europe castigated the countries of the South for the fiscal profligacy of the so-called garlic belt, troubles in Finland showed that the problems were deeper and different. Finland has been one of the success cases of Europe. After having been a near vassal of Russia, its GDP per capita in 1960 was but $10,500, adjusted for inflation, 68% of that of the United States at the time. Then, through heavy investments in education, it grew to the point that by 2007, its per capita income was $42,300, or 93% of that of the United States. But then a series of problems befell the country. In the fast-changing world of high-tech, its leading company, Nokia, lost out to competitors. Finland had close ties with Estonia, which was badly hit by the 2008 crisis, and after the fall of the Berlin Wall, Finland had profited by strong trade with Russia. But sanctions with that country hurt Finland as well as Russia, which also suffered from the decline in oil and gas prices. Finland's GDP shrank by 8.3% in 2009, and in 2015 it was still some 5.5% below its 2008 peak. In the absence of the euro, Finland's exchange rate would have fallen, and the decrease in imports and increase in exports would have stimulated the economy. In the absence of the fiscal constraints imposed by the Eurozone membership, it might have borrowed to finance government expenditures that would stimulate the economy. Instead, it got caught up in the wave of austerity afflicting Europe. Divisive cuts in wages of public sector employees were somehow supposed to mysteriously increase the competitiveness of Finland's exports. Instead, the wage cuts decreased demand, deepening the downturn. In short, the euro medicine worked little better in well-behaved Finland than it did in the more recalcitrant patients of the South. The alternative entailing more Europe, creating a eurozone that works, is almost surely the best path forward for Europe, but it appears too much for at least some of the countries in the eurozone to stomach. On the other hand, the alternative discussed in the last chapter, the amicable divorce, is equally unpalatable. For those who saw the euro as the next and critical stage in European integration, divorce would be a sign of giving up, of resignation. I argued that this view was misguided. Sharing a common currency is not, or should not be, at the heart of the European project. But perception is, at least to some extent, reality. If significant numbers of people within Europe see even an amicable divorce as at least a temporary surrender, then it could set back the agenda for European integration. Here, I want briefly to discuss one last alternative, which I call the flexible euro. It entails recognizing that there has been some progress in creating Eurozone institutions since the euro crisis broke out, though not enough to make a single currency system work. The flexible euro builds on these successes, in the hope that one could create a system in which different countries, or groups of countries, could each have their own euro. The value of the different euros would fluctuate, but within bounds that the policies of the Eurozone itself would affect. Over time, perhaps, with the evolution of sufficient solidarity, those bounds could be reduced, and eventually the goal of a single currency set forth in the Maastricht Treaty of 1992 would be achieved. But this time, with the requisite institutions in place, the single currency might actually achieve its goals of promoting prosperity, European solidarity, and political integration. The basic idea. The basic idea draws upon chapters 9 and 10, recognizing the gaps in the Eurozone structure that exist now and are likely to persist in coming years. We can use some of the tools that we would use in the case of an amicable divorce to arrange for sufficient policy coordination so that the fluctuations in the various euro currencies would be limited. We make use of the observation made in the last chapter that by and large, in the 21st century, we have moved to a digital economy, and accelerating that process would increase efficiency and facilitate tax collection. Rather than a single currency for the entirety of what is now the Eurozone, there would be several groupings, each with their own currency. Each country or country grouping would create an electronic currency, along the lines described in Chapter 10. Money could be easily transferred from one person's account to another, for instance, upon the purchase of goods and services. Firms would pay into these accounts their workers' wages. They would similarly pay their suppliers and be paid by their customers. I described in Chapter 10 how money could be added to or subtracted from within the electronic system, for instance, through the creation of new credit or a decrease in the supply of credit. I described, too, a system by which net payments to and from abroad could be kept balanced. Exporters would receive chits in addition to payments in the local euro into their account, and those who wanted to import would have to buy a corresponding number of chits, in addition to making payments out of their accounts. The system of marketable trading chits would ensure that the value of exports equaled the value of imports. There would be no net flow in or out of the payment system. As we saw in Chapter 10, countries could decide to allow a trade deficit or insist on a trade surplus simply by changing the ratio of chits one received for a euro of exports relative to those needed for imports. In this system, the value of one country's euro could vary relative to that of another's, and even more, the value of that country's euro plus the associated value of a chit. This is the flexibility in exchange rates that the current system lacks. At the same time, I explained how the system of chits would likely limit the variability of the value of one euro currency against another. Stabilizing relative exchange rates. There are many ways that Europe could collectively work to limit the extent of the movements in exchange rates in our system of flexible euros. I discussed these in Chapter 9, so I shall be brief here. Limiting surpluses. First, the countries, most especially Germany, that have traditionally run trade surpluses, imposing large external costs on their European neighbors and global economies through the resulting imbalances, could commit to reducing those surpluses. They would do this by the same chit system. Not only would this reduce global imbalances, but the same reasoning that suggested that the Greek euro will be stronger than it otherwise would have been, with chits limiting trade deficits, implies the German euro will be weaker than it otherwise would be with chits limiting the magnitude of the surplus. Eurozone leaders, if they wished, could thus achieve close to parity among the different national or regional euros simply by adjusting the chit system. More efficient sharing of the burden of adjustment. Earlier chapters noted that trade imbalances were caused by the rigidity in real exchange rates that follows from the rigidity in nominal exchange rates. The Eurozone approach of trying to achieve the desired real exchange rate adjustments through magical productivity adjustments, for example, in structural reform programs, or through internal devaluation, simply has not worked and has been very painful. Part of the reason for the failure of adjustment is that Germany has insisted on an asymmetrical adjustment process, that the burden of adjustments be borne by the deficit countries through lowering wages and prices. This in spite of all the evidence and theory that downward adjustments are far more costly than the reverse. It would be far better if Europe could commit itself to an asymmetrical process, but this time with the opposite bias. The surplus countries should follow policies, for example, fiscal and wage policies, that lead to upward adjustments of wages and prices. Productivity convergence. We have seen, too, in previous chapters, how Europe has put in place a process of productivity divergence as the sources of finance in weak countries sour and as public investments in infrastructure, education, and technology plunge. Europe already has some institutions in place to do the opposite, and it says it is committed to doing more. For instance, the European Investment Bank can strengthen investment in weak countries. If the Eurozone follows through quickly on its commitment to create a real banking union with common deposit insurance, it would do much to prevent the extremes of divergence in access to private finance. But small and medium-sized enterprises in weak countries would still almost surely be at a competitive disadvantage. Again, a Eurozone SME lending facility, directed especially at weak countries, could help rectify these disadvantages. If Europe created a solidarity fund for stabilization, or assumed more responsibility for social expenditures like unemployment in afflicted countries, it would free up the budgets of these countries to make more of these forward-looking investments. So, too, if Europe were to encourage industrial policies rather than proscribe them, the lagging countries would have a better chance of converging toward the leading ones. The economic rationale. Previous chapters have explained the problems with the single currency system of the Eurozone. Large trade imbalances on the part of the periphery countries built up in the years before the crisis, and the system did nothing to stop the buildup. It then imposed a painful and costly adjustment in the aftermath of the crisis, where the costs were typically borne by the deficit countries. If we look inside the countries, matters are even worse. Workers and small businesses are paying the price of this asymmetric adjustment process, but it was others who benefited in the creation of the earlier imbalances. In the case of Spain, for instance, construction firms and real estate speculators. We are asking innocent bystanders to pay for the mistakes of others. The system is rife with macroeconomic externalities, where the actions of some individuals and firms impose high costs on others. Whenever there are externalities, there is a need for public action. That is obvious in the case of environmental externalities like pollution. Public action in response has led to cleaner air and rivers. It has worked. But America's banks polluted the global economy with toxic mortgages. Regulators should have done something about this, but they didn't. Within the Eurozone, something similar occurred. In some cases, Ireland and Spain, there was a real estate bubble. In others, the excesses took different forms. The system described here provides a simple framework within which macroeconomic externalities are better addressed. It is almost surely not a panacea. There will still be macroeconomic fluctuations, but if well managed, they will be less severe, and so will their consequences. This system would enable Europe to emerge from stagnation. Some might complain, aren't we interfering with the market? The Eurozone itself is a massive interference with the market. It fixes a critical price, the exchange rate. It says that there has to be a single interest rate for the entire region set by a public body, the European Central Bank. The question is, with this government-imposed rigidity, how well does the rest of the market perform? Can it assure stability? There is now more than a decade of evidence, and the answer is a resounding no. This proposal entails minimal intervention in the market, and even in doing so, uses market mechanisms. It corrects for a well-recognized externality, the market externality associated with external imbalances. Europe has gotten itself into the current mess partly by assuming that markets are more perfect than they are. Markets exhibit enormous volatility in both prices and quantities. Interest rates demanded of borrowers from different countries have moved violently in different directions, and capital and credit flows have fluctuated in ways that are virtually uncontrollable under current arrangements. Workers are told that they should simply accept being buffeted by these maelstroms that are not acts of nature, but the creations of irrational and inefficient markets. Workers should accept wage cuts and the undercutting of social protections in order for the capital markets to enjoy their freedom. The flexible euro system is intended to bring a modicum of order to this chaos, which has not even produced the higher growth in GDP that was promised, let alone the social benefits that were supposed to accompany this higher GDP. There are some fundamental philosophical differences between the flexible Eurozone framework and that of today's euro. The latter assumes that if the ECB sets the interest rate correctly and individual countries adhere to their debt and deficit limits, all will be well. It hasn't been. There is an abstract theory, called the Arrow-Debreu competitive equilibrium theory, that explains when such a system of unrestrained competitive markets might work and lead to overall efficiency. It requires markets and information that are far more perfect than that which exists anywhere on this earth. And even then, these Nobel Prize-winning economists were unable to show that the economic system was dynamically stable. It was an equilibrium theory. There was no explanation of how the economy would get to that equilibrium. In the real world in which we live, it is often better not to just rely on prices, to try, as our flexible euro framework does, to control the quantity of credit and net exports, and to regulate the uses to which credit is put and the amount of foreign-denominated debt. The management of the economy in our proposed framework relies, however, heavily on the use of prices, but not fully so. There is no micromanagement, but more macro-management than exists today. Decades ago, we learned that one could not let a market economy manage itself. That is why, for instance, every country has a central bank determining interest rates and regulatory authorities overseeing banking. Some arch-conservatives would like to roll back the clock to a world without central banks and with free banking, with no restraints. Anyone who has read his economic history knows what a disaster that would likely be. But anyone observing macroeconomic performance in recent years will see that things have not gone well. Chapter 3 showed the massive waste of resources. It would be wrong if we did not try to improve upon this sorry record. The framework provided here and in the previous chapters does this. These are modest reforms that would not upend the system, but they systematically address some of the major weaknesses of current economic arrangements, some of the major instabilities that have proven so costly to our economies and our societies. There are, of course, a large number of details to be worked out. The system is surely not perfect, but almost as surely it is better than the current system, which has imposed such high costs on so many within the Eurozone. This framework of Eurozone economic cooperation with the flexible euro could lead to greater economic stability and growth. The need for Eurozone cooperation. Just as European cooperation is required if there is to be an amicable divorce, European cooperation would be helpful to ensure smooth functioning of the flexible euro. Even if there is hesitancy on the part of some for this proposed alternative, the system is such that it can be undertaken by a coalition of the willing. Any grouping within the Eurozone could adopt the system. These countries could then work together to ensure the relative stability of movements in the local euro exchange rates, in the manner that I described earlier in this chapter. Of course, if all or even most of the countries of the Eurozone, with the exception of perhaps Germany, join this coalition of the willing, then, de facto, Germany's exchange rate itself would become flexible, for it would then be variable with respect to all of the other local euros. It would then be in the interests of Germany to join the overall system to help ensure stability of its exchange rate relative to those of the others. Given sufficient European solidarity and cooperation, the framework would result in exchange rates moving within increasingly narrow bands. With sufficient success in exchange rate coordination, in narrowing the band, it might, someday, allow Europe to move forward toward a single currency. Chapter 12. The Way Forward. This book has provided a bleak assessment of the state of the Eurozone and the prospects going forward. I have described the underlying flaws in its construction, how they were the result in part of flaws in economic understanding, but also in part of a lack of political will and solidarity. We have seen how that same lack of economic understanding and solidarity has led to the flawed response to the crisis. It is not just Europe's present that is being sacrificed, but also its future. The euro was supposed to serve the European people. Now they are asked to accept lower wages, higher taxes, and lower social benefits in order to save the euro. And it is not just Europe's economy that is being sacrificed, but, in many ways, confidence in its democracy. The Germans and other leaders in the Eurozone have put forward the idea that there is no alternative, TINA, to their draconian policies. I have explained how there are alternatives that would even make the creditors better off. In this concluding chapter, I want to address three questions. Where is the Eurozone likely to go? Why is it taking the course that it is? Is there something else beneath the surface that is playing out? And why is the European project so important? Wither the Eurozone? I have outlined 3 alternatives to the current strategy of muddling through. I know which I would prefer if I were a European: the reforms described in Chapter 9 that would make the Eurozone work. Economists have a poor record in forecasting. The Troika may have set new records in serially bad forecasting when it came to their programs around the Eurozone, but political forecasting is even more difficult. I worry, though, that even the amicable divorce or the flexible euro will be put aside as the current strategy of muddling through continues. The afflicted countries will be given just enough hope for the future to stay inside the Eurozone. Germany and others in the Eurozone will play on the strong support in Greece and elsewhere for the Eurozone. The citizens in these countries irrationally see not being in the Eurozone as being not in Europe or the EU, forgetting about Denmark, Sweden, and the UK, which are in the EU but not in the Eurozone, or forgetting about Switzerland, Iceland, and Norway, which are not even in the EU but are very much part of Europe. The political scenario going forward, then, is not pretty, with the centrist parties committed to the euro losing ground to parties more to the extreme. In the case of Spain, the continued growth of parties asking for regional independence. Throughout Europe, as the fears of unemployment spread, we are likely to see the growth of parties rejecting Europe's openness, wanting especially to close its borders to migrants. No one can be sure when the political will to stay in the euro will break in one country or another, but it is clear that there is a risk, even a significant probability that will happen. One can already see it in the votes. And when that break does happen, there is a risk of the floodgates crashing down. If any country exits smoothly, then almost surely others will join, unless before then the Troika has relented and/or these countries have recovered, and at present both of these seem remote possibilities. That these dramatic events would have profound economic and political consequences not just for Europe but for the world is an understatement. Europe's leaders viewed themselves as visionaries when they created the euro. They thought they were looking beyond the short-term demands that usually preoccupy political leaders. The future of Europe and the euro now depends on whether the current political leaders of the Eurozone can combine a modicum of economic understanding with a visionary sense of and concern for European solidarity. What is going on? The interplay between politics and economics. I have remarked several times that there is something strange about the policies imposed on the afflicted countries. Normally, lenders impose conditions on borrowers designed to enhance the likelihood that the loan will be repaid. By contrast, the conditions imposed by the Troika reduced those countries' capacity to repay, particularly in the case of Greece. As I write this, Greece is in a deep depression and has been so for years, with a 27% fall in GDP from its peak, a 24% unemployment rate, and a youth unemployment rate more than twice that. I can think of no depression ever that has been so deliberate and had such catastrophic consequences. It is thus natural to ask, what is going on? Ideology, once again. One possibility, a real one, is that the architects of austerity truly believed in the economic doctrines that they espoused, in spite of the overwhelming evidence against them accumulated over more than 3/4 of a century. Advances in behavioral economics and psychology provide some explanation for the persistence of such beliefs. The theory of confirmation bias holds that individuals discount information that is not consistent with their prior beliefs, and in our complex world, it is easy to do so. It is hard, of course, to deny the decrease in Greece's GDP, but it is possible to find alternative explanations. Greece didn't do everything that it should have done. I had seen such rationalizing on the part of the IMF in the multiple failed programs in developing countries and emerging markets. The programs were well designed, it was argued. The failure was one of implementation on the part of the country. Such arguments, I believe, are disingenuous, an attempt to shift the blame for the failure of the program to the victim of the program. Blame the victim. As we've seen in the case of the 2015 program imposed on Greece, there was an attempt to blame Greece for the poor performance and even the poor design of the program. If they had only bargained better, if they had only had a more conciliatory finance minister than Yanis Varoufakis, one who adhered better to conventions. Finance ministers always wear ties, but Varoufakis refused. One who was not so aggressive. Even many Greeks blamed themselves. I had watched Greece negotiate programs with the Troika over a half-decade, first with the mild-mannered, intelligent, conciliatory George Papandreou, then with his successor, Antonis Samaras, and finally with the Syriza government. It is hard to detect much, if any, difference in outcomes. It is not surprising that Germany and others in the Eurozone would blame Greece. They would rather hold on to their incoherent and discredited theories to reconcile what happened with what their theories predicted meant they had to blame Greece. The patient wasn't following the doctor's orders. In fact, few, if any, democracies have been able to achieve the magnitude of fiscal consolidation, reduction in the size of the fiscal deficit, in the span of a few years that Greece achieved. They succeeded in transforming a large primary deficit into a surplus in 5 years. Even the way the money was given had the effect of making Greece look more dependent on Germany and its other Eurozone partners than it was. The short-term credit, with tranches being dribbled out, helped reinforce the unfavorable image of Greece. Compare a 5-year $100 billion loan with a sequence of 5 one-year loans where the debt keeps getting rolled over. In the latter case, Greece has had to borrow $500 billion, and it still hasn't gotten things in order. Of course, in terms of money, the two are identical, but to ordinary citizens not used to the tricks of high finance, it makes a great deal of difference whether Greece has been lent $100 billion or $500 billion. The latter number seems to make it clear that Greece is on the dole. As we've seen, Greece has gotten but a pittance of the money loaned. Most of it went to private sector creditors, but it has paid a high price to preserve other countries' banking systems. The scenario is eerily similar to the predatory lending now rampant in the United States. A poor American will buy a $500 couch, overpaying by 2 or 3 times in order to get credit. Credit is provided at a rate of 200% a year. If a payment is missed, fees are added. Within a couple of years, the poor individual owes $2,000. But it's not like he's been living high on credit. His only profligacy was the $500 couch. All the rest is interest, interest on interest, and interest on the interest on the interest. In the case of the predatory lender, it is about money. The banks and other predatory lenders have figured out how much they can fleece poor people within the law. But here, something else is going on. The IMF and the other official creditors do not need the money that they are demanding, nor are they in the business of making profits. Under a business-as-usual scenario, the money received from Greece would most likely just be lent out again to Greece, typically almost immediately, to be given back again to the lenders, in a grand charade, a shell game, but one with real consequences. As each tranche of each loan gets discussed, the Troika puts in demands that Greece finds unacceptable. And, of course, politically, it is unpalatable for any Greek politician who cares about his country to simply throw people out on the street, as one Troika demand implied. But, with Greece resisting the demands of the Troika time after time, the country looks increasingly like a recalcitrant and unrepentant borrower. At least back at home, Germany's case for treating Greece so tough is reinforced. Tina. The German attitude discussed in Chapter 1, referred to as TINA, set the tone for the negotiations. On the variable most critical for macroeconomic performance, the primary surplus, there was little, if any, give. In 2015, Syriza's government succeeded in postponing the pace of tightening a little bit in recognition of the changed circumstances, but the 2018 primary surplus of 3.5% remained fixed. Germany wouldn't even negotiate with the IMF on the question of debt restructuring, which everyone knew had to occur. As we noted in Chapter 7, Greece was made to sign up to a program that all parties knew was incoherent, the pretend and extend of no debt restructuring. Some within Europe, with little background in economics, could fool themselves into believing that the program would work. When individuals come to a belief that is countered by evidence, beliefs that cannot and will not be shaken by evidence, we say that they are blinded by ideology. In recent years, we have seen ideologies shape behavior in a number of spheres of public and private life. In the arena of economics, so closely linked to politics and policies that shape society, it is no surprise that ideologies often play an important role. Failure to learn. Almost as surprising as the Troika's not learning from history, that such private and public austerity virtually always brings recession and depression, is that Europe's leaders have not even learned from the experiences within Europe. The IMF should be complimented for at least recognizing that contractionary policies are contractionary, and at least it recognized some of the mistakes in the policies that had been imposed in the cases of Greece and Ireland. Apparently, the other members of the Troika were unhappy with such honesty. The Troika, as we have noted, is still demanding that Greece achieve a primary budget surplus, excluding interest payments, of 3.5% of GDP by 2018 and beyond. That target is punitive. Ironically, not only have these policies cost Greece a depression, they have already cost the creditor countries substantial amounts and are likely to cost them still more in the future. A lack of faith in democracy. Why would Europe act in this way? Why did European leaders resist Papandreou's first proposal of a referendum or the Syriza's government's 2015 referendum, refusing even to extend by a few days the June 30th deadline for Greece's next payment to the IMF? Isn't Europe all about democracy? Papandreou believed that he would win the referendum, that a majority would support his painful measures, and he believed that that support was necessary for the effective implementation of the program. The Syriza government wanted to ensure that there was democratic legitimacy in their accepting a program that was so at odds with what so many in Greece had asked for, so at odds with the elections of January 2015. That concern for popular legitimacy was incompatible with the policies of the Eurozone, which was never a very democratic project. Most of its members' governments did not directly seek their people's approval to turn over their monetary sovereignty to the ECB. Moreover, the political accountability of the ECB, the major Eurozone institution itself, was limited. When Sweden and Denmark sought public approval to join the Eurozone, their citizens said no. Perhaps these polities understood that unemployment would rise if the country's monetary policy were set by a central bank that focused single-mindedly on inflation. In the early 1990s, Scandinavians had painfully learned the consequences of paying insufficient attention to financial stability as they experienced their worst economic downturn since the Great Depression. Today, part of the popular resistance to the euro is the concern of excessive influence of Germany and the ideas and ideologies that prevail there. In this book, we have repeatedly noted the role that neoliberalism has played in shaping the Eurozone's structure and policies. In many other countries, prevailing opinion agrees with those expressed by the research department of the IMF and by this book. Austerity is contractionary, and the Troika policies are counterproductive. But within the Eurozone, such ideas have been given short shrift. It is not, of course, that Germany runs the ECB or the European Commission, the other two members of the Troika. Indeed, the ECB has never been headed by a German, and some of its policies, such as quantitative easing, have violated its orthodoxy. Yet, somehow, the old adage that he who pays the piper calls the tune has by and large played out. With the strongest economy in the Eurozone, its dominance of policy is perhaps not a surprise. One might accordingly think that Germans would be enthusiastic about the euro. At the time the euro was created, many worried that, tethered with the profligate countries of southern Europe, the euro would be a weak currency and the eurozone would be marked by inflation. They got what they wanted, and perhaps more: a strong currency and a region bordering on deflation. But even in Germany, some polls show that almost 2/3 of its citizens think their country would be better off outside the eurozone. Though their reasons are different, they believe that they will eventually be forced to share with their poorer neighbors to the south in some bailout. Sure enough, what one saw unfold 16 years after the start of the Eurozone was the antithesis of democracy. Many European leaders in Europe wanted to see the end of Prime Minister Alexis Tsipras's leftist government. They seemed to believe that they could eventually bring down the Greek government by bullying it into accepting an agreement that contravenes its mandate. In the end, they failed to bring down the government. Tsipras was given a new mandate in 2015 with an even larger majority, but he was forced to accept conditions that were antithetical to what the vast majority of Greece's people wanted. Greece had surrendered its economic sovereignty in order to stay in the Eurozone. When I saw Tsipras returning from Brussels, having finally yielded to the demands of the Troika, the image of President Suharto surrendering Indonesia's economic sovereignty 18 years earlier to the IMF, with the IMF's managing director, Michel Camdesos, lording over the once powerful leader, came to mind. As bad as things may be now, there are proposals for further reform of the Eurozone that would make matters worse. Germany has clung to the notion that countries must live within their budgets, and if they only did so, then all would be well. And to enforce the rules, Wolfgang Schäuble, Germany's finance minister, together with Karl Lamers, the CDU, Germany's Conservative Party, former foreign affairs chief, have proposed a European Budget Commissioner with powers to reject national budgets if they do not correspond to the rules we jointly agreed. In effect, an appointed commissioner would have the ability to veto the actions of national parliaments. Ideology and power. Though few would admit it, the debate, the struggle over the euro is as much or more about power and democracy, about competing ideologies, visions of the world, and the nature of society, than it is about money and economics. This is not simply an academic debate between the left and the right. Some focus on the political battle. The harsh conditions imposed on the left-wing Syriza government should be a warning to any in Europe about what might happen to them should they push back. Some focus on the economic battle, the opportunity to impose on Greece an economic framework that could not have been adopted in any other way. It is striking how the Troika has failed to convince the citizens of Greece, Portugal, and Spain of the virtue of their policies. I believe strongly in democratic processes, that the way to achieve whatever framework one thinks is good for the economy is through persuasion. In the current case, Greek, Portuguese, and Spanish citizens seem to have a better grasp of economics than Germany's finance minister or the Troika. Even if one weren't deeply committed to democracy and democratic processes, the success of the programs being foisted on the crisis countries depends in part on ownership, on their believing that the medicine, as painful as it is the right medicine. The Troika has convinced some in the crisis countries that that is the case, more than I would have thought, given both the weight of theory and evidence against them, but the polls show convincingly that the majority have not been convinced. Anyone engaged in public policy knows how important public perceptions are. If these public perceptions are wrong, then successful policy implementation requires countering them. For instance, in all countries, tax collections depend largely on voluntary compliance. But when the tax system is viewed as unfair and biased, one should not expect increased compliance, no matter how many lectures are given about the laziness and non-compliance of Greek citizens. So, too, programs that entail alienating and demoralizing the bureaucracy that is supposed to carry them out and include cutbacks in their resources predictably won't be carried out well. In the days of the repeated crises in emerging markets, when IMF programs failed, the IMF would say that the programs were well designed. They wanted to shift blame for the failures to the countries. The problem was with the implementation. So, too, with the repeated failure of the Troika programs. It is an oxymoron to say programs are well designed when there are repeated and consistent failures in implementation. Programs must be designed so that ordinary mortals, bureaucrats constrained by resources, and political leaders constrained by electorates to whom they are responsible, can carry them out. And success requires the support of both the electorates and the bureaucracy. The Troika seems not to have recognized this. Indeed, with their anti-democratic stances, for instance against referenda, they seemed openly hostile to these perspectives. I am not so Pollyanna-ish to believe that democratic politics will necessarily lead to good economics or social policies. Americans who have seen economic policies pushed by conservatives in the United States with strong support of electorates in certain states have to recognize this. The result in some states has been austerity in an era of negative real interest rates when real returns to public investments are enormous. The repeated revival of supply-side economics, after its predictions have been strongly shown to be wrong just years earlier, provides another instance. But neither am I Pollyanna-ish about experts. It was the so-called experts in the financial sector who developed regulatory and macro-management models that led to the crisis of 2008. It was the experts who believed that the euro would lead to stronger economic performance. In much of the world, there is a growing understanding that the ideology of the right has failed, and so too its economic doctrines of neoliberalism. As an American, I have seen and experienced this. Beginning around 1980, the country began a bold experiment of lowering taxes on the top, allegedly to improve incentives and freeing the economy, deregulating, especially the financial sector. The results are now in. The bottom 90% have seen their incomes stagnate. Large proportions have seen their incomes fall. Only those at the very top have done well. And the economy as a whole has performed more poorly, with growth lower than that in the decades after World War II. The right rewrote the rules of the market economy in ways that benefited the few. That is why there is now a campaign to once again rewrite the rules, but this time to benefit the vast majority of Americans. The Eurozone was another attempt to rewrite the rules, another attempt that has led to more inequality and economic stagnation. With these ideas now having failed on both sides of the Atlantic, it is no wonder that their devotees are on the defensive and have to rely on force, or in some cases, deception and unholy alliances with anti-immigrant groups to achieve their political ends. Austerity is contractionary. Inclusive capitalism, the antithesis of what the Troika is creating, is the only way for creating shared and sustainable prosperity. But austerity is only part of a grander strategy concerning the role of the state. For instance, Wolfgang Schäuble has argued that under normal economic circumstances, the rate of public expenditure should not rise faster than the nominal growth rate. There is, however, no general theory, either in economics or in political philosophy, in support of such a conclusion. If, as is the case in most countries, government is responsible for health care, and as people become richer and live longer, they, as a democratic society, decide to devote more public spending to health care, Why should that not be done? The changing structure of our economy and society may well call for an increasing share of public expenditures. In an innovation economy, basic research becomes increasingly important, and only government can finance such research. With more and more individuals living in cities, there is a growing need for publicly provided urban amenities. With heightened inequality associated with the market economy, a stable and just society may wish to undertake more aggressive actions to combat it. With global warming and other environmental risks, the government may need to do more to protect the environment. The issue here, however, is not who is right or which view is right. What concerns me is that the economic framework of the Eurozone is being used to push for a particular set of views concerning the economy and society, and these perspectives are effectively being imposed on the crisis countries. Why the European project is so important. It is not in the interest of Europe or the world to have a country on Europe's periphery alienated from its neighbors, especially now when geopolitical instability is already so evident. The neighboring Middle East is in turmoil. The West is attempting to contain a newly aggressive Russia, and China, already the world's largest source of savings, the largest trading country, and the largest overall economy in terms of purchasing power parity, is confronting the West with new economic and strategic realities. This is no time for European disunity and economic weakness. I would argue even more strongly that all people have an interest in the success of the European project. Europe was the source of the Enlightenment, which resulted in the increases in living standards that have marked the last 2 centuries. The Enlightenment, in turn, gave rise to modern science and technology. We too often forget that for eons before, standards of living had changed little. In many parts of the world, and often even within the United States, while the fruits of the Enlightenment are readily enjoyed, its basic values are questioned. One of my friends in the Obama administration, exhausted from fighting to prevent global warming and climate change, has commented that he has to re-litigate the Enlightenment every day. Europe has been in the forefront of the battle to save the planet. A more united Europe would be better able to wage that battle. The Enlightenment was marked, too, by a new sense of tolerance, including of those who differed from oneself. The Enlightenment also gave birth to notions of basic human rights to be enjoyed by all individuals. America was lucky to have been founded just as these ideas were percolating, and so one sees them strongly reflected both in its Declaration of Independence and its Bill of Rights. The struggle to create political and social systems fully reflecting these Enlightenment values is never-ending. There are constantly new frontiers, and in many of these areas, Europe, too, has led the way, from the fight for gender equality to the fight for the rights of privacy, from the struggle for transparency in government and the right to know, to democratizing participation in all aspects of life. The moment the world is in now calls out for these values. There is the existential fight to prevent unacceptable levels of climate change. While Obama has been a strong advocate for global cooperation, with so many climate deniers in the Republican Party and in the U.S. Congress, Europe will have to play a pivotal role. Concerted action by Europe might enable the imposition of cross-border taxes on goods from countries like the United States and China that are made in a carbon-unfriendly way. The world is engaged, too, in a war against ISIS and terrorism more generally. More immediately, the world faces a humanitarian migrant crisis, a crisis that Europe saw so vividly as it flared in the summer of 2015. The imminent cause of that crisis was the war in Syria, itself part of a wider war against ISIS and terrorism. These crises pose multiple challenges both to Western values and to the European project. One is how to wage the wars against ISIS and terrorism without unduly sacrificing the very values we seek to protect. Europe will be central in ensuring a balanced and effective global response. A united Europe will be more effective in ensuring that the responses are consistent with our values. While America has long celebrated its open doors for immigrants, the reality in recent years has been otherwise. The United States took a fraction of the number of refugees from Iraq, refugees created by America's war against Iraq, than much smaller Sweden. Evidently, the Bush administration felt no moral responsibility for the millions of displaced persons that their war had created. The world needs a united Europe to formulate a humanitarian response to these migrant crises. But as our discussion in earlier chapters has highlighted, for Europe to have a consensus response with fair burden sharing will require a functioning European economy. The migrants will not want to go to countries where there is massive unemployment, and countries in deep recession or even stagnation can ill afford to accept them. Both migrants and the host country know that without jobs, these new migrants will not be able to start the new life that they crave for. And if migrants have to compete with those who have long been unemployed for jobs, there will be resentment and hostility. Ironically, the policies imposed on Greece helped to create and shape one aspect of the migrant crisis. For instance, Greece had been home to many from the Balkans. As Greece's economy plummeted, these migrants had to look elsewhere. With so many countries in the Eurozone with high unemployment, the only place for them to go was Germany and the few other countries in the Eurozone with full employment. The unbalanced flow of migrants is a predictable result of the economic imbalances the euro created within Europe. Chapter 5 highlighted how the current Eurozone structure led to divergence, but the relatively few countries doing well will also resent having the burden of refugees placed on them. But as this book goes to press, the failure to resolve the migrant crisis poses an existential crisis for the EU. A fundamental principle of the EU is free mobility of labor, but that principle, in conjunction with the divergent Eurozone, inevitably implies that the burden of migrants will lie with those like Germany that are relatively prospering. Without shared prosperity, at least more sharing that is likely to exist under the Eurozone's divergent structure, it will be difficult for Europe to abide by both its humanitarian principles and its principle of free mobility. Something will have to give. But it would be far better to change the monetary arrangements along one of the ways we have suggested. Economic divergence, especially when combined with a sense of unfairness and deep differences in views about values and economic principles, makes it difficult to forge a European consensus around other issues. Again, one sees this played out most dramatically in the migration crisis. Greece is at the frontier with Turkey and the Middle East, and after Eurozone programs have led to a 27% decline in its GDP, it is in no position to deal with the large numbers of migrants arriving at its borders. The abuse that Greece received at the hands of its partners obviously made it less trusting in dealing with the migrant issue, forcing Greece, already suffering from depression, to bear, by itself, so much of the brunt of the surge of migrants, especially those from Syria, has deepened the perception that European solidarity, or even a minimal sense of justice and fair play, have withered. Political and economic integration. Lessons from the Eurozone. Globalization has meant that the world is more integrated than it ever was. It means that what one country does has effects on others, that what citizens do in one country can have effects on citizens in others. In many ways, we have become a global community, a community with a system of global governance without a global government. There is an ongoing process of shaping that global community, and how it is shaped will reflect the values and concerns in different parts of the world. The voice of Europe, with the values that I have described in the previous paragraphs, needs to be heard, and it will be heard more clearly if the European project succeeds. It will not be heard if Europe is in disarray and if there is not shared prosperity. The experiences of the Eurozone have one further important lesson for the rest of the world. Be careful not to let economic integration outpace political integration. Be skeptical of anyone who suggests that political integration will naturally follow from economic integration, and be especially skeptical of anyone who proposes a monetary union in the absence of adequate political integration. Perhaps the one silver lining in the European cloud is that this lesson has been learned. A variety of proposals for monetary unions elsewhere have quietly been put on the back burner. Around the world, there are many efforts at advancing economic integration without commensurate moves toward political integration. The drivers of that integration and the source of the flaws in the design are often similar to those that we have seen in the creation of the euro. The euro was constructed on the simplistic premise that a single currency would facilitate the movement of capital and goods. The resulting economic integration would improve societal welfare everywhere within the eurozone. In the case of many economic changes, there are winners and losers. The changes are defended on the grounds that the benefits of the winners far exceed the losses of the losers, and that in the long run almost all will be winners. The argument for the Eurozone, too, was that everyone, or almost everyone, would benefit. The reality, as we've seen, has been otherwise. Germany is the big winner. Much of the rest of the Eurozone, especially the crisis countries, are the big losers, and the Eurozone as a whole has done poorly. The losses of the losers far outweigh the gains of the winner. The lesson is that markets are complex institutions. Simplistic tinkering based on ideology rather than a more profound understanding of how markets actually work, without a deep appreciation of the complexities, can lead to disastrous outcomes. The United States today is pushing a trade agenda across the Pacific and the Atlantic that is premised on the idea that the freer movement of goods across more borders would similarly increase the well-being of all the countries involved. Indeed, would benefit all the countries of the world. But again, with simplistic free market ideology and special interests working together, the trade agreements that are emerging, the Trans-Pacific Partnership and the Transatlantic Trade and Investment Partnership, are even more unlikely to deliver on its promises than the Eurozone's. There will be winners, the big corporations, especially the pharmaceutical companies and coal and oil companies threatening the environment. But as in the Eurozone, in its current form, the losses of the losers will outweigh the gains of the winners. The agreement would make access to generic prescription drugs more difficult, would almost surely lead to more inequality, and would make it more difficult for governments to regulate the environment, health, safety, or even the economy in the public interest. Saving the European Project. The ongoing debate over the euro, its structure and the policies and programs imposed on the crisis countries have raised deep questions about values and objectives. Too often, it seemed as if saving the banks, or even just the euro, was given precedence over human welfare. Success was measured in sovereign bond spreads, the difference between what the bonds of Greece or Italy were paying and those that Germany was paying. When those spreads came down, victory was declared. So, too, as we have noted, programs were declared successful when unemployment started to fall or GDP started to grow, not when unemployment was restored to an acceptable level or when living standards were restored to what they would have been but for the crisis, or even more modestly, to what they had been before the crisis. Remarkably, in assessing the success of the Troika programs often motivated by worries about government debt and deficits, little attention was paid to the debt-to-GDP ratio, a measure of debt sustainability that had not improved. Indeed, as we've seen, the debt-to-GDP ratio rose in the crisis countries, in some cases to levels that would normally be viewed as unsustainable because of the adverse effects on GDP. The denominator of the ratio has been reduced by more than the numerator has been circumscribed. There should be a single, simple measure of the success of any economic program, and that is the well-being of a country's citizens, and not just the 1% at the top. Well-being is more than just income, and there is more to the measurement of success than assessing what has happened to GDP or even GDP per capita. For most individuals, meaningful and decent work is an important part of their life, and an economy that denies meaningful work for large fractions of its citizens, that denies employment for large fractions, let alone a majority of its young, is a failed economy. An economic system or a set of economic arrangements that fails repeatedly to achieve well-being for large fractions of its people is a failed economic system, a failed set of economic arrangements. An economic system that leaves large fractions of the population facing high levels of insecurity, too, is a failure. For young people, the prospect of living their dreams, a life with hope and aspirations, is critical to their well-being. For old people, a retirement with dignity and a modicum of security is essential to well-being. Many older people had planned not to retire, to continue working. But with high levels of unemployment and a major slowdown, these individuals' jobs have disappeared. One might say they should have planned for this. But how could one have expected that Europe's leaders would create such a dysfunctional system, or would have imposed policies that have resulted in such dire outcomes? Advances in economic understanding were supposed to end the business cycle, or at least dampen it. Research on individual and societal well-being has shown, perhaps, the obvious. Individuals care about security and about jobs. The Eurozone and the policies that have been imposed on the afflicted countries have increased insecurity and decreased jobs. A symptom of how bad things have become in many of the crisis countries, as we have noted, has been the dramatic rise in suicides. In the most important objective of economic policy, enhancing individual and societal well-being, the Eurozone has been a disappointment to say the least. Monetary systems come and go. Monetary arrangements, like the Bretton Woods system that governed the world after 1944, was heralded at its onset as the replacement of the gold standard. It seemed to work in the years after World War II, but in the end, it did not last even 3 decades. The Euro's moment of glory was even shorter, and, as I have argued, even in the brief time that it seemed to be working, the imbalances that would eventually bring on the Euro crisis were building up, and the Euro and the associated economic arrangements were largely to blame. This book has shown that the Euro can be saved, should be saved, but saved in a way that creates the shared prosperity and solidarity that was part of the promise of the Euro. The Euro was a means to an end, not an end in itself. I have laid out an agenda of reform for the structure of the Eurozone and for the policies that the Eurozone needs to follow when one of its members faces a crisis. These reforms are not economically difficult. They are not even institutionally difficult, but they require European solidarity, a kind of solidarity fundamentally different from the suicide pact that some leaders within Europe are calling for. For all the emotions that the Euro has brought on, for all the commitments that have been made to preserve it, in the end the Euro is just an artifice, a human creation, another fallible institution created by fallible men. It was created with the best of intentions by visionary leaders whose visions were clouded by an imperfect understanding of what a monetary union entailed. This was perhaps understandable. Nothing like it had been tried. The real sin would be for Europe not to learn from what has happened in the last almost 2 decades. 3 messages emerge clearly from my analysis. A common currency is threatening the future of Europe. Muddling through will not work, and the European project is too important to be sacrificed on the cross of the euro. Europe, the world, deserves better. I have shown that there are alternatives to the current system. Moving from where the Eurozone is today to one of these alternatives will not be easy, but it can be done. For the sake of Europe, for the sake of the world, let us hope that Europe sets out to do so. This has been an Audible Studios production of The Euro, written by Joseph E. Stiglitz, performed by Alex Hyde White. Executive producer, Susie Bright. Producer, Mike Charzik. Copyright 2016 by Joseph E. Stiglitz. Production copyright 2016 by Audible, Inc. Audible Studios is a division of Audible, Inc.
Audible hopes you have enjoyed this program.